Ladies and gentlemen, welcome to the Midday Market Monitor. In today's video, we have to talk about the current sell-off that we're seeing in not only the markets, but in some of our favorite names. I also will want to do a little bit of a review of SoFi as well later on. But we have FOMC today. We have Robinhood earnings, Meta earnings, Microsoft earnings. I would like to take a look at some companies that have already reported as well. Lemonade's down on today's report. Vertiv also down today. P&G ended up reporting. SoFi, of course. And then later on, obviously, we have ARM Holdings, Qualcomm, Carvana, Starbucks, Chipotle, Lam Research, Fortinet. There's just a crazy list of companies that is going to dictate whether or not we continue to see large beats, which has been really the de facto standard in this earnings report or earnings season, but we're still very early into it, right? Microsoft and Meta, I think the market is expecting them to end up coming out and beating these numbers. However, those CapEx numbers are also likely to show unfavorable numbers for the amount of spend that they're going to see. Depending on if you're an AMD investor, an NVIDIA investor, Lumentum, Micron, all of these different types of component names for this AI build-out, could be very exciting, but obviously for the actual company's spending, are they going to see a real return on all of the spend that they're going to be putting forward? That said, we also last night ended up seeing Bloom Energy, Seagate, Teradyne, many of these companies that are also part of the AI build-outs from last night that ended up showing off just unbelievably great reports. Now, I've not seen these stocks and if they've been holding up. Yeah, see, look at this. Bloom Energy got up to 194 in the aftermarket, okay, after showing off their numbers only to sell off and bring us right back down to where we were the day before, as if they didn't just absolutely destroy expectations in a good way. I'm talking about in a good way here. If I could just quickly just breeze through these numbers really quick. Bloom Energy ended up growing their total revenue base by 165% year over year to over $1 billion. Okay. If you look at the yearly estimates now, what they ended up doing was $1 billion in 2021 entirely. That entire year is what they just put up in a quarter. It took them then roughly 4 years to then double that to $2 billion. And then next year, year over year, they're expecting to double that once again, all while their total gross margins have ticked up and expecting once again a very large increase going from 30 to 34% year over year in 2024 to 2025. So not only are they doubling revenue, but every dollar of revenue that ends up coming through was worth more than it was the year prior. Okay. On top of that, gross profit and gross profit margins looking extremely good. Not only are you putting up the highest amount of, revenue, they're going to put up 33%. That's what they just showed us. But they said that's going to be even higher than this in the rest of the guide. Now, mind you, this is Q2 for them. Okay. Meaning that the past quarters that they've had to raise guidance for leaves the potential for Q3 and Q4 to also beat expectations. All right. And we're going to talk about how much they beat expectations, but that was by a very large margin. Operating profit and operating margin also showed off new company highs. Margin 17% looked very healthy there. And if you end up looking at their operating expenses, they continue to fall and expecting to fall drastically in 2026. And that's essentially going to show roughly a 4x increase in their operating income just year over year, because it's coupled with doubling amounts of revenue and then also a large decrease in their overall expenses margins coming up. And that's eventually going to translate into net income. Currently, in the most recent quarter, they just showed off 18.6% net income margins, nearly $200 million in profits, which is more than, well, obviously a lot of these quarters that were already negative. But even in the most recent quarter that we just saw, only $76 million of profitability. Okay, we did more than double that quarter over quarter. So they're guiding extremely well. We ended up seeing EPS show off really good increases. So they raised 2026 full year guidance. And we're likely, if they continue to show out the way that they did, which was a 32% beat on revenue and 116% beat on EPS, that this guidance might even seem low by the time we actually finish the year. Okay. That's what great companies do. Great companies triple beat, and then they triple beat on top of those triple beats. And they continue to push up expectations as there's more demand than the actual supply that they have. Okay. So energy is becoming a massive bottleneck. And Elon Musk just said this in a recent interview, and we're going to listen to that here in a minute. But if you can be a cleaner option, not a clean option, a cleaner option to, potential other turbines that are out there and everything like this, maybe Bloom Energy has a solution and adds additional capacity to this AI build out that companies are looking forward to and are willing to pay their premium that is increasing on a quarterly basis. Okay. So I'm just super excited about that. I also wanted to cover Teradyne as well. Teradyne was another one of these companies that ended up showing off earnings yesterday. This is actually a much bigger company than people give it credit for. Market cap, $52 billion. Stock is up 4.5%. This is another one that popped on earnings yesterday. Bloom Energy lost a lot of that gain. Teradyne is trying to hold a little bit of it. Obviously, it got to $374 a share. We're now down to about $334. So lost about $40 a share in the after hours pricing. But once again, it's the same repeated thing that we're seeing in every single one of these AI names. Is the AI build out dead? Take a look. 87% up year over year on Teradyne, showing off not just the highest amount of revenue. That can happen to a lot of companies, okay? A lot of growing businesses. But accelerating, by the way, greatly accelerating their overall amount of revenue. Okay, 87%, not only the highest, but the fastest growth rate on top of the biggest numbers that they've ever done. On top of that, gross margin, also a brand new high, highest margin as well. Those types of S-curves of having the best margin while growing the fastest in revenue, that ends up showing up mostly in major bottlenecks, right? So whether this is through advanced packaging or some of their other products, customers are willing to pay because there is a supply shortage across the entire AI build out. That's allowing them to show off operating profit of $473 million, up to, almost a 37% margin. Net income, 31% margins, $400 million down to the bottom line. That shows up in their EPS, right? Rule of 40 ended up skyrocketing. Last quarter, they looked great, okay? But you're talking about a company that you could either buy just in this range that we're looking at here in the past 3 years or so, in a range of roughly 5 to 39%. Always below that sort of rule of 40. Now, rule of 40 is traditionally used in software names, but I'm really just looking at a combined metric, almost like a PEG ratio, but for trailing, to say, what is the growth and margin put together? That's all I'm taking a look at here, okay? That rate put together, what we're seeing is roughly 126%. I'm just combining those two metrics to get one line item to say, how well is this doing over time? 126% growth and margin put together. That's pretty great. We will cover SoFi here in a minute, okay? But Q2 2026 earnings as well for Teradyne beat by 9% on revenue, and EPS beat by 20%. Now, I've said this a lot. Not many people say this enough. EPS to beat by 20% is relatively a decent beat, but it's nothing to scream about, because EPS can be thrown off by so many different things. Mark-to-market gains on investments, different tax breaks. Like there's 1,000 things that you can do to end up boosting up EPS that really didn't show how your company was performing underneath. Okay. And same thing for revenue. You can boost revenue growth, but a lot of that might come at the expense of just giving a ton to sales and marketing. But the most common and best trait that you can see is that EPS beat by a high number, and that revenue also climbed up. Like you want revenue to grow by 10% and EPS to grow by 11%. That way you can kind of see that, no, it's margin improving as well and better than expected, but also revenue beats usually come in the line of like 2 to 4%. That's like common, good beats. 9% cannot be scoffed at. This is an unbelievable beat. And then whenever you go back to like Bloom Energy at like 31% beat on revenue, It's insane how bad Wall Street is at doing these channel checks to understand how much revenue Bloom Energy is going to do. They specifically came out and said that they're working with every major hyperscaler, NeoLab, co-location build out, all of these different things. They're working with all of them. Okay. The same thing is happening here with Teradyne. Major beats. Absolutely love this for Teradyne. I was going through some of Seagate's numbers. I don't have it all, and this was sort of the last one that I was taking a look at, but this is just, very, very quick. I didn't get around to all of their numbers, but Seagate, same sort of thing, huge beats, accelerated revenue growth. What's so funny is by the third time, it almost gets boring, right? But this is what you want from investing. This is like the epitome of beautiful investing, is that a company puts up such great results over and over and over that it's like, okay, but what's new? Well, what's new is that Seagate last quarter did 1.4 billion. Now they're doing 1.9 billion. This is real money. These are real businesses that can give back via dividend or buybacks or buy more fabs or, deliver more product to more geographies, hire more salespeople. If this is a game about getting rich, the boring compounding is exactly what you want. Okay. Look at these increases in operating margin, essentially going from 32% to what looks like here, roughly about, 43%, let's say. Almost 1.55 billion dollars in operating profit flowing down to free cash flow. Well, sorry, I thought net income was going to come up next. $1.1 billion in free cash flow, climbing up. Cash and cash equivalents, $1.7 billion. Like, it's just disgusting how much they're guiding higher and continuing to show off great numbers. Sorry, one more thing. Just forgot to share this. Let's not miss it. Beat on revenue by 4%, beat on EPS by 13%. Who is getting bored in this market, saying the AI build out is not what you want to be doing? This looks like clear beats across it's every single indicator that you could possibly want for this AI build out, and we're seeing it across the board. You could throw a dart at the component that we're building out in, whether that's optics or memory or storage or advanced packaging or energy, and like there's a lot of demand. I had Hamid on last night talking about this during our podcast yesterday, and he doesn't want to complicate things. He's not making the same people that are making assumptions about where the build out is going to stop is as likely as making the assumption that it's going to continue, because you're seeing that these companies are being very profitable. You would be betting against the likes of not just Mark Zuckerberg, not just Satya Nadella in Microsoft, or Sundar Pichai of Google, or any of these, but every single one. From the component layers, Bloom Energy telling you that they're seeing more demand for their products than they could possibly know what to do with, all the way down to the chip companies, to the energy names, to the literal grid providers saying that, we're seeing so much demand that we're going to have to batch out customers, and a lot of you are not going to be accepted because we just can't handle all of this build out. So it'll be interesting to see what happens. But yesterday was a beautiful day for the AI build out. There's a lot more to the overall markets than just AI. And that's exactly what today is going to be, a mix of both the most important names in terms of, just the markets, big tech, and sort of the CapEx AI trade. But then also we have things like, sorry, I just saw it completely just took my breath away. But then we also saw things like the fintech names like SoFi end up showing earnings, which let me go ahead and quickly watch this. Now, I have not even seen this. This was Anthony Noto on CNBC. He was live for about 3 minutes or so, almost 4 minutes. Let's have a listen.
Noto, welcome back, Anthony. It's good to have you.
Good to be here, Sarah. Thank you.
So, the quarter looked really strong. The business looks good. I guess there's some concern about the EPS guidance on the second half, but how would you characterize what's driving the business now?
We're really seeing an inflection point in the business. We've driven 19 consecutive quarters of greater than the rule of 40, which is revenue growth plus EBITDA margin. We grew revenue 40% to $1.2 billion. We had about $1 billion of cash revenue, and then our EBITDA margins were 30%. But more interesting, and the reason why I'm mentioning inflection point, is that our product per member has started to accelerate, because as we add new products like SoFi Plus and SoFi Crypto, our Everything app is really starting to generate that flywheel effect, and we're seeing good momentum across all of the businesses and increased awareness of our products and services. So we feel great about the business. We did increase revenue guidance, and I think you're right. The market really wanted us to increase EPS guidance since we beat. And the reason why we didn't increase EPS guidance is twofold. One, the growth opportunities in front of us are so significant. We're investing significantly more in SoFi USD, our stable coin. We're investing in SoFi Plus. We're also investing in big business banking, which is the combination of both fiat and crypto banking. And we're now assuming there are 2 rate hikes. I know you're just talking about that.
Yeah.
When we started the year, we assumed 2 rate decreases. And so the fact that we're beating top line growth, growing over 40% with great margins at 30% on EBITDA, we just, with the rate environment, now we're assuming 2 rate increases. It wouldn't be prudent to raise our earnings expectations without having a better view on rates.
Yeah, I mean, that's exactly what we're hearing. The revenue guidance gets upgraded, EPS gets maintained. So are you concerned that higher interest rates hurts lending origination? Is that where it translates?
No, I just think higher interest rates create some uncertainty generally. We've been able to navigate both declining interest rates and increasing interest rates. You know, we saw a 500 basis point rate increase over a 3-year time period, and we're able to that entire time period to maintain a great net interest income margin, and we still think we can do that. We want to make sure we don't short ourselves in terms of investing in the long-term benefits of the business. But when rates go up, there is some level of uncertainty, and we just wanted to leave some cushion in case that happens. And you know, our 60 cents in earnings per share is a very attractive growth rate relative to last year. The stock's also very attractive on a P multiple basis and a multiple of tangible book value. So we think it's a great time to buy the stock, but we're not going to be overly aggressive to try to get people to keep the momentum going as it relates to increasing guidance and driving momentum type of investors.
Yeah, I mean, you just said that you maintain the EPS guidance because of the investment you're making in the business. So how are you thinking about that reinvestment versus returns over the next year or so?
Yeah, no, great question. What we've said to the street for the last handful of years since we went public is that we're going to deliver a 30% incremental EBITDA margin and invest the rest back into the business. So that means for every $100 of incremental revenue that we drive year over year, we're going to drop 30 cents to the bottom line, have a 30% margin, which we have, and reinvest 70 cents back into the business. And that ultimately is going to allow us to compound growth in revenue for a lot longer time period. The margin profile of the business is going to be about 20 to 30% margins on a net income basis. And we will always be able to capture that margin. What we won't be able to capture is the top line growth. And what we're seeing from our members and product appeal, we want to invest in that and drive it, as well as building future growth opportunities. So we want to maximize the top line. We're being prudent. We are dropping some to the bottom line, but we don't want to underinvest. So investors can expect us to drop 30% incremental EBITDA margins, and that will lead to a 30% net income margin over time.
So if the midterm outlook is maintained, 30% revenue growth between now and 2028, and midterm growth EPS growth in the midterm growing at roughly 40%, 38 to 42%. If that's maintained and they continue to shoot for that outlook, aside from a looming major change in the macro that forces them to change their guidance, which they've been extremely resilient. One of the things that I think people are downplaying a lot is that SoFi has just said that they are going to essentially change their outlook to see 2 rate hikes this year, not keeping it flat. Mind you, at the beginning of the year, they called for like 3 rate cuts in 2026. So with the same guidance, and actually they've increased it ever so slightly, they went from 3 cuts to no rate change to 2 rate increases. And the revenue expectation went up, EBITDA and EPS stayed flat, but a lot of that was tax implications, these sort of things. they're making major build outs in their business, right? They're taking a lot of that new revenue growth and spending it on SMB, on loan platform business, on crypto, on SoFi USD, on SoFi Tech Solutions. All of these different businesses that they've only recently entered, big business banking being another one, they're going to cost a lot of money. But there's also been some major changes that I wanted to cover that maybe people didn't catch, and I certainly didn't catch the first time I listened to the call regarding credit cards, spend, the whole flywheel happening. So I do want to do a full SoFi review. I want to do that a little bit later, but I did want to have a listen to, where is it? Actually, you know what? Maybe we just jump into the SoFi thing. Yeah, I'll just do the SoFi one then, and then pivot back to Elon, because Elon's full interview, I know a lot of people have maybe seen what they were talking about recently, but he recently had this prediction that there was not going to be a need for money in 2036, and I really wanted to review some sections of that podcast as it's been recently fully released, the 1.5 hour long podcast or whatever. Okay, let's go ahead and SoFi, by the way, down 7.2%. There is a little bit of movement in these stocks right now. I don't see let's see if there's any news on the reason why. Kevin Hassett says, we expect Warsh to do the right thing, saying that their confidence in the Federal Reserve chair has never been stronger. That's the thing too, right? Going back to some of the discussion on rate hikes and rate cuts, we have a lot of fear right now baked in that there's going to be a rate hike, because Citadel came out and said, we expect a 25 basis point hike. Okay. This spooked the market. Right now, there's a 33% chance that we end up seeing a rate hike. Most people, 66.3%. So it's really, 2/3 chance that we stay absolutely still. And then a 33% chance that it moves in a worse direction for SoFi. But that's also baked into their expectations. So staying flat right now would be a little bit of good news for the company that we would need to see. But it's funny how much the chance of a rate hike is actually set right now, 33%, because this is what, the analysts are saying. This is how they're split. These are the companies that are saying that they're going to hold rates, okay? No changes at all. Bank of America, Barclays, Bloomberg, BMO, CIBC, Citi, Goldman Sachs, the list goes on and on and on. And then the people who say that there's a 25 basis point hike, Citadel. Come on now. So are we putting all our chips on, no rate change? Well, just putting Kalshi. So there's a couple interesting ones. Gergiven Capital is just Gergiven. That's just him. He's just making a little joke in there in case you guys saw that one. He's saying that there's going to be a hold on rates. But also Kalshi's company is not making a prediction on rates. They're taking the sentiment of the crowd. Okay. He's just putting in that Kalshi is also on that list, saying that the average person in the prediction markets is also betting that there's going to be no rate change. I think it's roughly the same percentage of what the Fed watch is at, though. Did Citadel create the fear? Yes. That's why that's why the talk of even any potential rate hike this time came out I think it was 2 days ago. Citadel came out and said that they were expecting a 25 bip hike, and everyone's treating it as gospel. They have been right a lot in the past, but Po Buddy's nerfed. All right, let's go ahead and talk about SoFi. So like I said, SoFi stock is down roughly 7%. At one point, this was down nearly 10%. you would make it out to be as if they just missed their numbers greatly. The people who have been around for a long time or even watched the stream earlier today would already know that this is the sign of a triple beat. Now, it doesn't mean that the every single number was perfect. We all know that SoFi's tech platform is a massive flop right now. They want to get it back off the ground again, but it is a struggling part of their business. On the other side, things like lending and financial services are doing way better than expectations, that it's making up for it. So let me take a sip of water. We can go through predictions for Hood as well. I do have predictions. Let's go through SoFi's Q2 2026 update, starting with members. So if you guys didn't see, we added 1.1 million new members, exact on my prediction for where I thought that SoFi would add for 34.6%. How did I guess? Well, every single quarter we grow by 34+%. Okay. It's been a consistent for 8 quarters in a row now that they've just been able to compound at a certain percentage, which is roughly about 7.5% quarter over quarter, every single quarter for just years. So pretty wild. They ended up showing off that unaided brand awareness, and I didn't like the way that they did this. They showed Q2 instead of Q1 as well. You had to go back and look at Q1. Q1 unaided brand awareness was 10%, 10 flat. So we grew by roughly 40 basis points or so on the unaided brand awareness. That was really good. New members coming onto the platform as well obviously helps. They've been doing a lot of sales and marketing as well, as you can see with the different, celebrities and athletic programs that they've been doing. That's been really exciting. They just recently announced that they're now like a primary sponsor of Notre Dame. Okay. Total products as well, as members grow by 34%. Any growth that happens underneath 34%, we don't want to see, but anything above, which is what we've really just seen, nearly 41 point something percent, is a really, really good sign for more products per member than what we had before, meaning average revenue per user goes up and the total customer acquisition or lifetime value to CAC, LTV, ends up getting extremely in SoFi's favor. That was the initial flywheel of what SoFi wanted to do. And now we're really starting to see that take off. We've spent, a year and a half in this sort of gully of having much lower products per member than what we initially expected. Now we're blowing past expectations, which was around 1.5 members or products per member. Now we're starting to climb way past that. So really good sign there. In another sign here, this is the financial services productivity loop. This is what people look to and say, like this is what got me into this company. Okay, that someone comes on board for SoFi and they get a SoFi money account, they get SoFi Invest, and they start to make their way through these products. And maybe they only need a SoFi money account for now. And then they end up getting a credit card, and then they end up getting a loan, and they get a new career. So then they go back to SoFi Invest and then back over to a personal loan to fix up their kitchen or something. This sort of flywheel that happens keeps people within the platform and constantly cross-buying across all of their different products while they add on new products. So this time you can see SoFi Crypto there, SoFi Plus, SoFi Coach, all of these new products that will essentially either help bring someone to another product of SoFi's, or that product alone will end up making new revenue, like SoFi Invest does, being like $10 a month per person. Okay, let me just, I had to change the temperature in my dang house. Okay, there we go. Now, total revenue for SoFi ended up climbing roughly 42%. This is the company that is down 7%. They beat on expectations versus what Wall Street had assumed. Okay. They also show off a rule of 40. This is directly from their own earnings presentation. Not only did they put up 40% growth rates, they did it on 30% adjusted EBITDA margins, 70 rule of 40, almost twice as high, holding up that great growth almost for 4-5 quarters in a row. So really, really great there. On top of that, fee-based revenue mix, this was one of the signs that people pointed to as being a little bit negative for SoFi, because it did decrease from 2025, even though it's up from Q1. Q1 was roughly 36%. We're now at fee-based revenue being 39%. For anyone new to SoFi, essentially what this means is that, money that comes in through a personal loan or money that comes through a home loan, well, it's extremely profitable. It's only profitable while the customer is paying. Okay. Customer stops paying, that product becomes instantly extremely unprofitable. And that's how banks go, bankrupt. And banks don't hold very high PE ratios or premiums because they have a tendency to bankrupt. It happens, right? Bear Stearns, Lehman Brothers, you can go through the list and find a few, as early as like Silicon Valley Bank. And I'm sure there's been some that are even more frequent than that. That being said, that does not talk about the fact that fee-based revenue, which is like just collecting fees for service, whether that's a debit card that's tapping on a machine or making a transaction like an options trade on SoFi Invest, that, if someone doesn't do well in that trade or they buy the wrong object, that doesn't change SoFi's financial situation. So fee-based revenue is where we want to go, okay? Even though that this percentage dropped year over year, the fee-based revenue still continues to climb drastically, 25% year over year. And we're expecting that if that continues on that annualized base, we're going to crush the numbers of what we've seen before. All right. On top of that, lending revenue, we ended up seeing climb to over 50% year over year growth rates, $725 million of overall revenue on the lending side. This came in way, way higher than expectations. Okay. Like I had it being back like what we've seen in previous quarters, like roughly, in the 400 millions. On top of that, we're going to expect, pretty high growth, but it leans more to the sort of more risk-based revenue, less fee-based revenue. So it's a little bit more risky to do this, but you're only doing this if you feel very confident about, the customers that you end up having. Remember, SoFi brings on a customer that has an average income of $150,000. That's brand new, by the way. That's updated. So even as they've been able to scale, they've been bringing on these high-value customers. And those customers also have over roughly 740 FICO scores. So these are affluent, high FICO individuals. Now, this is the actual originations that we've seen SoFi build off of, right? We did roughly 14.8 billion total originations across personal loans, student loans, and home loans. Mind you, on the personal loan side, 3.1 billion of that came from the loan platform business. That means, 7.6 billion was originated on behalf of their own balance sheet. That's higher than most of the quarters that we've seen, let alone, inclusive, like going back to March of 2025, we did more for SoFi's own balance sheet this quarter than we did for every segment for March of 2025, let alone the loan platform business, right? Which is there to try to bring in more fee-based revenue and lower those risks. What this essentially shows us is that, by next quarter, if they keep up this pace, we're going to do more originations than all of 2025 in 3 quarters. We're practically there on student loans, and we're definitely going to pass that in home loans as well. So really crazy amount of originations whenever you put them side by side versus the years that we've seen prior. On top of that, they also highlighted this page right here, which we noticed pretty quickly ended up signifying that they have a new type of loan that they have on the loan platform business. Autos and SMB loans. Now, it's not talking about auto loans. They're really talking about SMB loans. They sold a massive amount of loans in the loan platform business. I don't want to give it away just yet. It was billions of dollars that they sold in a product line that they just got into a few weeks ago. Like the amount of potential earnings that SoFi can turn on like a flick of a switch happens instantly. And that's why SoFi is such a catalyst-driven stock and why their earnings can continue to surprise to the upside. And it's very hard to model sometimes is because who knows if a product like the loan platform business will end up coming up online doing billions and billions of dollars a quarter. And that billions of dollars that we saw wasn't even there 3 months ago, right? The same breath, the reason why we can end up still doing these loan platform businesses and people are still signing up with SoFi is the fact that the net charge-offs of the personal loans that we have, and the reason why you can take out $10 billion or $14 billion a quarter is because people are paying back their loans, okay? SoFi is getting better and better and better at identifying a customer aside from just Q3 of 2025, if you look all the way back to Q1 of 2023, this is the best time to give out a loan ever in SoFi's history, or well, not ever in SoFi's history, but in that, 3+ year period. That's crazy to me. And then a lot of people like Muddy Waters ended up saying, well, SoFi sells a lot of their loans off. And so the $90 million of, highly delinquent loans that they had, because no bank is perfect, you're always going to have a certain amount of people that you end up giving loans to that don't give your money back. SoFi is not immune to that, and neither is JP Morgan or any bank, right? But they show off, if we didn't sell those loans, we still dropped from 4.4% to 3.7%, even if you were to assume that 90 million is fully delinquent, which it's not. That's why SoFi was even able to sell those loans in the first place, is because there's a buyer of $90 million of highly delinquent loans that are going to call and call and call, essentially collectors, and they're going to try to make some of that money back from those 90 million. They obviously didn't pay 90 million. They probably called SoFi and said, hey, we'll give you $8 million for your $90 million of highly delinquent loans. But if they can make more than 8 million back, that's a successful business for the collectors. And SoFi, it's already a write-off anyway. They've taken it down off their winnings, but at least they can get 8 million back. So good practice there. Mind you, this is their personal loan and student loan borrowings, $150,000 to $157,000 in weighted average income, and FICO scores between 742 and 760. Wild. On top of this, they ended up comparing their lending from last quarter to this quarter, and they're showing that as these loans, these vintages, which is essentially just saying the combined total of loans during a certain time frame. So for them, they're talking about from 2022 all the way to sort of Q1 of 2026. You're taking a look at this vintage of loans that is actually way outperforming what they've did back in 2017. So these loans, it essentially is showing us that they're getting better at identifying people that are willing to pay them back. Not only that, they're willing to find people that actually want their loans and pay them back. And as time goes on, the spread between their 2017 vintage, which is perfectly acceptable because it beat that 8% life of loan loss, which is essentially a common metric for saying, hey, if we can go ahead and give out our loans, get back a payment, and we don't lose 8%, that's a good deal. Okay? 8% on average is how many people you're going to eventually say, they're not going to pay you back over the life of the loan. What we're ended up tracking for is roughly 1.75%, which is a 15 basis point increase from last quarter on the seasonality of these loans, meaning the longer we go on with this vintage, the better it looks, which is the high majority of SoFi's overall, loan book. But then we move on to financial services. Financial services grew by 28%. I was a little bit disappointed in this number. They put a lot of their effort towards lending this quarter, and you saw a lot of growth there. But this still was a record quarter for financial services, brand new high, and we ended up showing up with still continued growth. Now, one of the things that gives me a ton of certainty for financial services going forward is their deposits. Take a look at this growth. Now, you'll see that the growth rate ended up shrinking over time, but really that's because SoFi's deposit base was so low that just bringing on a couple new customers would grow that deposit base extremely quickly. Now that it's getting bigger and bigger and bigger, 27 billion, 37 billion, 45 billion, it's harder and harder to grow. Yet they've brought up that growth rate from 26% to 44%, and now even more recently, 54%. So let's go back and actually think about what the numbers are that we've seen. SoFi brings in a member to its platform, raising up from year over year by 34%. They're growing their user base by 34% year over year. On top of that, they're going to other customers within their platform and saying, hey, you already have a SoFi Money account. Why don't you get a SoFi Invest account? Why don't you get a personal loan? Why don't you get all these? And so the cross-sell ends up increasing to the highest level that SoFi has seen. And we end up seeing product growth grow by roughly 42%. So there's more products this quarter than last. But on top of that, there's one specific product, SoFi Money, which is where the deposits come in. Okay. And that ended up growing by 54%. On top of that, okay, we ended up seeing the deposits per member, like what I'm highlighting, be by far the highest we've ever seen. 54 or 5,400 per person. And the amount of spend that we're getting on a user now hits $7 billion a quarter, or roughly $887 per person. So what you're seeing is this flywheel. I'm talking about spotting a compounding business now, okay? I'm not talking about the reaction to the stock. I'm talking about spotting a compounding company. New members, the members like it so much that they're willing to take out a second one, and then the products that you have out of those second ones are being utilized more than ever on a per person basis, on an average revenue per user basis, and the customer acquisition costs are falling. That is that is the definition of an active flywheel. So big step up in overall interchange, more spend on the company. And like they said, during the quarter, we received record interchange fees up 67% year over year and 25% up from just the last quarter. This is not holiday spend. You're not spotting a big amount of spend because it's like fourth quarter and people are making a ton of purchases because it's the holidays. It's just Q2. Okay. One of the most interesting things about companies like, SoFi or Visa or any of these is that there's these aspects of their businesses that are extremely resilient to overall, like inflation risks. Because if inflation risks end up happening and, you end up seeing higher fees at the gas pump and you end up seeing higher amounts of overall just money in circulation, well, banks end up seeing that increase. And so they can be pretty resilient because their revenue will grow alongside those increases in inflation. Now, it also affects their lending and there's other aspects that is not so good, but still, it's pretty interesting to see interchange fees climb up so efficiently. They also said, we think that we've cracked the code on efficiently acquiring high-quality credit card members. Year over year, credit card revenue has more than doubled. In fact, credit card revenue is up nearly 50% and products are up 17% just from the last quarter. We're excited by this trend that we're seeing not only in the back book, but we've also reached profitability. There's been two products that I've been highlighting for years, saying that these products are not profitable yet. That's SoFi Invest and SoFi Credit Card. And the one that I was worried about the most was credit cards because obviously there's default concerns and these sort of things. That's no longer the case. So not only is it a drag, credit cards before were a drag on margin, now they're actually accretive to overall margin. This is a big change in their overall business and a very, very good sign from a product that I was really worried about. Okay. On top of that, SoFi's tech platform, this is really where we're starting to see the things that people don't like. But it's not like we didn't see this last quarter. The major sell-off didn't happen this quarter. It happened last time because we ended up losing the biggest client that was on our platform, which was Chime. Chime essentially came out and said, hey, we think that we can end up vibe coding. Not true, by the way. But they ended up building their own software stack, and they use Chime Core instead of Galileo, which is now called SoFi Technology Solutions. The overall amount of members is trying to build back up to new highs, but we're still going to have a little bit of time before SoFi's technology platform, or Galileo, whatever you want to call it, is going to get back to anywhere where it was before. So I'm including this 0%. Anything that's extra from Galileo, great, but I'm not including this in any of my estimates. It's just merely a product that essentially helps them build out products faster, like SMB, for example. Then there's a bunch of metrics like stock-based compensation or share-based compensation that also I think need to be highlighted, because back whenever we were covering this company years ago, one of the aspects that was really concerning to people was stock-based compensation was extremely high, 18%, 15%, way too high as a percentage of revenue. Now, even though stock-based compensation has climbed recently, that total amount is roughly 6.3%. Definitely in the realm of a reasonable SBC for a very fast-growing company. All right. Anyway, after you take off all the expenses, after you go through all the margins, everything like this, net income came in at about $156 million. Margin was a little bit pressed this quarter. And they said if it wasn't for their tax situation, they would roughly be guiding for 5 cents higher for full year. So instead of 60 cents, they'd be guiding for 65. Assuming that, SoFi's Q2 would see roughly 1/3 of that. It might have been 13 cents of EPS versus 12 cents, or, maybe even 14 cents or something. Who knows? But one of the reasons that they really want, or one of the things that they really wanted to highlight, and I think is really important, is how they're actually going to drive to 20 to 30% of ROTCE. And they said that they want to get to a range, which is quite exciting. Adjusted net income margins of 25%. We've heard them talk about 20% before, that they wanted to guide for 30% adjusted EBITDA, 20% net income margins. Now they're talking about 25% net income margins, and that the revenue to equity ratio will be at 1x. Okay, this is another really important point. So essentially, the math that they're doing is, hey, our ROTCE will be 25%. Well, if they do want to track revenue with their overall amount of equity, then tangible book is going to be an extremely important stat to track, because that's growing like crazy. If their tangible book is essentially, hey, how much can you lend out? How fast can you grow? What are all these aspects that, after you count out all your liabilities, how fast can SoFi go? And yes, a large amount of these two, the 2 quarters that have led us to higher and higher levels is because of capital raises. They ended up selling off shares to end up raising this capital to bring up their tangible book, which is very true, but it's not like it's staying flat. It's continuing to grow. Okay. Now hitting a new high, $9 billion. The company is continuing to operate extremely efficiently. So I don't think that this sell-off should happen. But, come on, look at this. Revenue up 8.3% versus expectations. EPS beat by 9%. Great quarter this morning. And yeah, this was the slide. I had it out of order. But this is the one that I wanted to say about tangible book. They said, based on our current operating plans and the guidance that we've provided, we feel really good about being able to operate within the confines without needing to raise capital. So they're not looking to raise more capital. They're happy where they are. And now, are they going to just be able to provide and potentially even buy back shares if they see an opportunity to do so? SoFi's CEO, at least, Anthony Noto, is buying shares. So if I look at SoFi as a whole, really, I see a company that is a flywheel, growing, beating expectations, raising guidance, all while launching some of, I think, their biggest, the biggest potential new products that we've seen in the future. This is not launching, L1 options or dark mode or some of the old jokes that we've talked about in the past with SoFi. They're launching big business banking, small business loans, like SoFi USD, SoFi Pay, SoFi Crypto. These are major businesses, essentially business lines in themselves that, we've already seen essentially like this. This is the first quarter where we've been able to do so by introducing SMB partnerships. I might have taken this out of context a little bit, but anyway, there are 2 of them. One is Base Point Capital that just signed $3 billion over 3 years. This is to get SMB loans in the loan platform business. The other is an undisclosed party for several $100 million. And we're also introducing home equity lines of credit to the mix, meaning LPB mix, as well in the coming days. In terms of the overall size and scale and opportunity of our ability to originate into that, we are just starting to originate in a meaningful scale on the SMB side. This is a major market for them to play in. Their first day out the door of talking about this new product, which launched weeks ago, is them announcing that they're going to be doing what is in the ballpark of $3.5 billion in 3 years. And then saying, hey, we're going to launch, an even bigger total addressable market, HELOCs or home equity lines of credit into LPB as well. This went past most investors, and it was like by far the biggest quote in the entire earnings call. So I'm just seeing good results. I think it's an unfavorable macro, and I'm not looking to rush in right now because this can persist for a while if Iran conflicts continue and inflation is a concern and oil prices are high. I'm not saying that SoFi is a return right now. I'm saying to the people who get frustrated with this company and call for, Anthony Noto to be fired or something like this because the stock isn't moving, realize the execution that he's doing as an operator. The company is doing better than ever, beating your own expectations, beating my expectations. What more could I want? I said I would be happy if SoFi does this. They did more than this, and then I complain because the market ends up selling off. Make it make sense. I'm very happy with this company. It remains one of the largest positions in my entire portfolio, third place right now. I'm going to continue to hold. Are they a bank? Absolutely. Are they one of the fastest growing banks in the world? Absolutely. All right. Let's jump into the rest of the news because we only have 10 minutes till FOMC. I'm not going to miss it. That's my rant on SoFi. And mind you, I'm scratching the surface of what there is to talk about for this quarter. There was so much. It really takes listening to the call twice. I'm telling you. Okay. Can I listen to this unless there's news right now? Netflix is paying $200 million for 2027 Women's World Cup. CoreWeave boosts yield on $2.6 billion loan tied to Anthropic. CoreWeave sweetens their $2.6 billion loan. Okay, wait, this stock is going to go down on that. I mean, it's down anyway. But loan terms, the spread has widened by up to 1.25% percentage points to the high of 5.5% over the benchmark. Wow. And the pricing has been cut to 97 cents from 99 cents on the dollar. Yeah. I mean, it's tied to Anthropic, but yeah, it's definitely not concerning. Okay, I need about 5 minutes to listen to this clip. Elon talks about Chinese models and who essentially is going to win and what they need to win. And I wanted to listen to this clip, but this is from The Economist, and yeah, I'll let Elon take it away.
There's also, of course, some very competent Chinese AI companies that several that are very good. The new Kimi model,
Kimi K3, yeah, the one that came out last week, because I mean it was almost as good as Fable, right? So
well, I think realistically, Fable is still clearly the smartest model. I think anyone realistically would say that that's still the case, but the Kimi model is getting quite close to Fable. Now, Anthropic had Mythos, from which Fable is derived. I think they had that ready in February, so they've got sort of what they call, I'm not sure what they call it, but Mythos 2 or Fable 6 or something much better.
This is such an important point. and Elon is not going to put enough emphasis on this, but they had Mythos ready back in February. And by the way, we haven't even used Mythos. Mythos is their model that they're sort of holding back. And the Fable that we know today is also, it's 2 downgrades. So Fable 5 was a downgrade of Mythos preview. And then also the government ended up stopping due to the whole concern that Amazon had with, it wasn't blackmail, but it was some sort of cybersecurity concern. So then they downgraded it again. That is the thing that people are talking about, whether or not Kimi K3 is on par with, let alone the preview models that Anthropic is working with internally, which is probably a Mythos 2 or something like this. That's, however many X times smarter than Mythos itself.
Better than what they had in February. They almost certainly have. Not almost certainly. They certainly have right now. So, and I think they could release it at any time.
just before we get on to releasing, how do you think about the Chinese models and the geopolitics of it? Are you worried about the Chinese catching up and getting ahead?
Given that the Chinese AI companies are doing as well as they are with a relatively small amount of compute, it seems though as that if they had a lot of compute, there's a good chance that they would be the leaders. And at some point, they probably will have a lot of compute.
So they will be the leaders.
There's a good chance that they are the leaders at some point.
I mean, this is why we can't have New York moratoriums. We need all possible places, permits, low costs, all of these things. People like whoever that basketball player that was talking about data centers recently, obviously going back to where you were in 2019 and saying, hey, there's these concerns that we have with data centers. This is, I don't like what's happening. What people are not considering is that we're not the only people trying. China is not going to stop because New York has a data center moratorium. And if they have all the intelligence and we don't, because most of the things like what we just saw with Hugging Face, the model that ended up fighting off ChatGPT's intrusion into Hugging Face's database was another AI model. You need intelligence to fight intelligence. If we see a broad-based United States moratorium, we will get crushed and no longer be the superior country, the ones that get to dictate which ones have the reserve currency. And look to the countries that don't have the reserve currency anymore, and then you ask them if that's made a significant difference in the future of those of the satisfaction of their population. But let's go ahead and listen to Elon Musk just finish out this thought, and then we'll get into the Fed decision.
You can think of like the constraints on AI are essentially electricity and AI chips. And then for physical AI, the robots. China's also got some very good robot companies. In fact, they have these like robot sporting events. I don't know if you've seen some of them.
Yes, I have. I saw them last time I was in Beijing. I saw the robots.
Well, and then they have the sort of like a boxing match or fighting match with the robots, which is quite entertaining. And I saw some video of a robot that got its head knocked off, kept fighting, even with its head knocked off. It looked pretty funny. But I mean, in fact, I think the robot battles are going to be quite entertaining to watch.
But just
so China's very strong on robots, very strong on digital AI, and if you look at electricity production, you can say like AI is a function of whatever the limiting factor is, if it's chips or electricity. China has far more electricity than the United States. In fact, China has more electricity than the United States, Europe, and India combined already, and is heading to, and my guess is China gets to 4 times the electricity production of the US, which is roughly proportionate to the population.
What should the US government do about this? I mean, if you presumably it is a little alarming if you have an authoritarian regime far ahead in the most powerful technology. And clearly what the US government's been trying to do is, with the export controls and so forth, keep China back. Do you think they should ban the use of K3, Kimi K3, for example? Well,
the US government can't, they can pass some law that prevents US companies from using Chinese models, but they can't stop the rest of the world from using them. So it's not like the US government has authority over China or the rest of the world.
That's the biggest issue, right? Like, we can only control what we're doing. How the heck do you can control everyone else? So if you put these large bans on open source and these that's not going to slow down any other country. And in fact, it's just going to give them the upper hand. That said, let's go ahead and finish that out later. We've got rate hike decisions coming out in the next minute. We're 60 seconds away from knowing. I'm going to be getting this from the Fed website, so be careful listening to what Chad has to say. There's definitely going to be some trolls out there. And then we're going to have the Fed FOMC, the actual committee meeting, at 2:30. So in 30 minutes from now. Decision now, the call in 30 minutes. And then we're going to do, right here, we're having Roy and Amit and everyone to listen to the Robinhood call. We're going to be looking at Meta's numbers, Microsoft's numbers, all of those things. And we're just going to be streaming all the way through. So I'm live all the way till 6:30 or so. All right. Let's go ahead. 10 seconds and get that decision. Okay. Let me pull up the stock market really quick. You're immediately going to see it. Did we just see a no change? Big green candle? I mean, that's pretty likely that we just saw no change. Let's go ahead. Keep looking here. Fed holds rates steady. Vote is 9-3. Wow. There we go, ladies and gentlemen. Pause, pause, pause. We are waiting. We are waiting. Now, that being said, we still have the call. The call is way more important than the actual report. Let me see if I can actually get this report as well. No, this is from February. Where's the actual? Where is it? Okay. Wow, the markets, though, markets are really liking this. NASDAQ only down 0.1% now. Really closed that gap. NASDAQ's up like $400. S&P also up roughly about $60. We're still a little bit red, but only by 0.3% rather than the much larger, over 1% sell-off that we saw earlier today. Wild. We might even turn green here, ladies and gentlemen. NASDAQ's about to turn green. NASDAQ is green. That's what people needed to see. Okay, where is SoFi on that? Okay. Garmin's up 17.9% on way better than expected earnings. Seagate flying up on that news. Snowflake, every company having a little bit of a pull up, whether that's from, people buying those individual names or purchasing the indexes, which, to be fair, SoFi is not part of those indexes, so they don't see those sort of widespread benefits whenever the indexes go up. S&P only off by 0.15%. Beth Hammock dissented in favor of a 25 basis point hike. Neil Kashkari and Lori Logan also 25 basis point hikes. Those were the three hawkish members. The other 9 were in favor of keeping rates steady, saying that inflation remains above its 2% target while the economy continues to expand at a solid pace. The Fed also highlighted strong productivity, resilient job growth, and ongoing ample reserves in the banking system. Good stuff. Now, I'm interested to see what Kevin Warsh actually has to say. Okay, yeah, they really didn't change much. Before it said that the committee reaffirmed its policy of maintaining ample reserves. Now it says the committee is continuing its policy of maintaining ample reserves. These small wording changes that people love to point out, I mean, it could not be it is the most nitpicky thing in the entire markets where people said, oh, he changed it from reaffirmed to it's continuing. The exact same meaning. Okay. NASDAQ back red here. Was there something in the report that I didn't catch here? The Fed left rates unchanged for the 5th meeting in a row. Held the benchmark at 3.5 to 3.75%. says job gains have kept pace with the workforce. Fed says it's remained committed in its 2% inflation goal. This is the longest Fed pause since 2008 cycle. Since the 2008 cycle. Wow. Wow, I would have thought there was longer pauses than this. Okay. Why mess with a good thing, you know? Well, like, we're just so bifurcated, you know? Like, inflation, yes, it's a concern, but the underlying, like, the biggest concern with inflation, likely oil prices, is not headed in the right direction. I mean, not today, but like, it's a lot better than where we were at $100 or $104 a barrel. On the other side, people are getting jobs. There's not this massive AI layoff cycle that people are calling for. It just hasn't even shown up in the numbers yet. If it ever will. Lemonade down 21.5%. Vertiv down 15.7%. That's going to hurt my stock draft. Let's see what else. Ondas down 7.4%. Dave down 7%. SoFi down 6.9%. It's going to be a long road back to flat on the day, let alone going green. But, you know, anything would help today. Anything would help ease my pain. If SoFi just guided for, in their report, they're guiding for 2 rate increases. And now this pushes off. Let's go to the Fed watch really quickly. Why isn't it loading? By the way, the call is in 24 minutes or so. This thing's just not loading right now. I want to see for the next report. Okay, it's not showing. Great. That said, we don't have a lot of meets left. How many meetings is there? 3? 2, 3? Anyway, the likelihood that they continue to pause, meaning that, you know, the expectation would be that we're going to see 50 basis point cuts or something like this later down the line, or 2 25 basis point cuts at the last 2 meetings of the year. I mean, it's definitely a possibility, but every single meet that we end up showing up and we don't get a rate hike should help the chances that we end up staying flatter for longer, help the chances that we end up not seeing rate hikes. So yeah, should be good. It was really just Citadel. There was a 33% chance that we were going to get a rate hike on Citadel saying that it was going to hike. One company, every single bank and institution said it was going to stay flat. Okay. Warsh is going to hawk. I think that there's going to be hawkish commentary. This wasn't some 12-0 like we saw last meeting. This was 9-3. That's leaning more and more hawkish. There was definitely commentary or dissents towards a rate hike. You know? Citadel wanted to buy the dip. Well, hopefully they bought it. Okay. Warsh is no way a hawk. I don't think that he is. I don't know how much he's going to speak for the entire committee. You know, 3 dissents is pretty large. 25% of the committee, of the voting committee, said, let's do a hike. Let's make it known. I want my name on that. By the way, Jesse, good to see you. Okay. Let's continue here. I want to see some more information from that report. Other than adding the names of the dissenting voters and laying out the vote count, the only thing that changed was the referm to Iskinton. Yeah, there's really not much, dude. Warsh has really changed the way that they write these reports. They're like 3 paragraphs long. Let's see what CNBC has to say about this and what they're expecting for Warsh whenever he comes out. Let me make sure I got my sound on here. Do you guys hear them using like scissors or something? It's driving me nuts. You guys can't hear this? You can't hear this? Okay. Bad at my job. Bad at my job. My bad.
Which did endure inflation that was at least in part the result of a supply shock. So he hasn't really suggested that there's that sort of out or asterisk next to his comment about the supply shock. And that's really what the market is taking, I think, him on his word here. And when he says, okay, we're running above target, we will deliver price stability. We talked about it in the last hour before the statement came out. There's a missing statement there. Okay, how do you get to price stability? And there's only one way to do it, and that's with rate hikes. I want to make one more point, which is that given if you look at the 2-year and the rally there and the 10-year and the rally there and a little bit better, there it is. And what you see is that because of the uncertainty engendered in the lack of any really explanation of the reaction function, we spent a little more time at a somewhat more restrictive rate than we otherwise should have if the Fed was not going to hike rates, and the market had to price it in. And where was it? Where was it hedged? It was hedged in the 2-year, it was hedged in the 10-year, it was hedged in equities as well as the Fed funds markets.
All right, 427 for the 2-year, as he was just talking about there. Francis, what are your thoughts?
I'm wondering if this new Fed Warsh makes my life easier or harder when we have fewer changes. Then does that mean we have to extrapolate more into the change in some form of adverb? What I think is going to happen is that when the Federal Reserve doesn't give us new information, we have to look for that new information elsewhere. We're probably going to get a core PCE that prints at 3.3% tomorrow. We're going to get more data that tells us inflation is heading in the wrong direction. Core inflation has been rising since April of last year. And so this redirection towards what's happening in the generalized economy, I think, is going to create more action. We've talked about volatility around the Fed. From my point of view, this means more volatility around the economy, and why economists, I think, will actually become more important. And perhaps this works out to more work for me.
Jim, do we change how and where we invest right now based on what we just learned?
No, I think the statement, as we pointed out, is almost exactly like the last statement. What the Fed is effectively doing is they're invoking some patience. This is allowing the economy and allowing the markets to correct a little bit. So we're seeing equities suffer a bit. We're seeing bond yields rise. What you're getting is a tightening in financial conditions. So you are getting this tightening that's taking place. However, the long-term trend, I still think, for the equity markets are positive. So what that tells me is that we can think about this and buy into some of these dips, because the Fed is telling you we're not getting in the way of this. We're likely not going to hike interest rates and kill and crush the markets.
So just to back out to a 30,000-foot view, they're not at the point of hiking to quash the bubble, whether it's the .com years of the housing. Is that kind of what you're saying? They're going to let it ride?
I think they're going to, well, I think there's been a lot of structural changes that have already taken place in the economy today with a lot of the investment through the tax code, fiscal policy, and things like that. That is the underpinnings, whether it's AI, CapEx, all the expenditures. That's the underpinning that's going to drive, I think, equity prices higher. Are we going to be volatile? Are we going to worry about return on investment and CapEx spending? Of course we are.
Right. Look at the chips again today. Yeah.
Chips again today and things like that. But I think these are blips. I don't really think that this is changing the trend. So does it change the way that we invest? No, we're still overweight equities and we're still underweight duration a little bit in bonds.
You know, Rick, you go back to inflation, you look at the bond market the last couple of years and you say, well, higher auto rates, all the stuff we just talked about. You talked about electricity, healthcare costs. None of that's going to come down, is it? I mean, unless you crash the economy, I don't see where these inflationary pressures of the last 5 years are going to come down. The bond market appears to be reflecting that sentiment. Am I reading it wrong?
No, you're reading it right. As a matter of fact, what I would like to tell Steve, if he was standing here next to me, is that the interpretation of what's happening, first of all, in the September meeting, we have PCE tomorrow. That 71% could easily be 40%. So be a little careful about that interpretation. Second thing is, and this is to your point, the market today, 2s, 10s, is steepened 5 basis points. 2-year yields down, 10-year yields up. It agrees with you. That's why the 2-year yield is down a bit. The other issue is that even if Warsh does not say that supply shocks aren't the kind of inflation I'm not going to try to control, that doesn't mean that's the correct interpretation. Once again, Sully, you're right. Because let's say he does tighten for a supply shock that hasn't really resulted in knockout effects yet. The market may do exactly the opposite. When the Fed started easing in 2025 and 2024, when they lowered rates and the market yields went up, well, if they raise rates for the wrong reason, maybe the market yields will go down. So I think there's a lot of moving parts here. Conventional wisdom always wants to be easy, look at percentages, and that's exactly what Warsh wants to get away from. So I think that the press conference will be interesting because even though there's no forward guidance, the reaction function is kind of a semantics way around that, and I think we're going to be learning how that works.
David, I think of, well, there is another way to possibly get rid of inflation, which takes longer, and it's kind of you could compete it away. In other words, so I'm just curious, when we talk about these, one of the things that makes it so hard when it's the price of oil and when it's the lagging effect of all these increases, it takes longer for the market to work in certain areas than it does in others.
But I think we're looking at this backwards. I mean, the anger that people feel is not about today's inflation. It's about inflation over the last 5 years.
For sure.
And the problem is that you can't push that genie back in the bottle. Mm-hmm. Once the inflation has occurred, people say, how are you going to get my prices down? We're not going to get your prices down.
I'm about to tweet it out. I don't know if
you can't get prices down. So
they're never coming down.
But the funny thing is, what you actually need to do is gradually push wages up. Mm-hmm. And that the irony of this is that the reason I don't think this inflation is sticky here is because wages won't go up. But the real problem is, once you have a bout of supply side inflation, the only way you bring everything back to equilibrium is actually allow the wages of lower income workers to go up and maybe take it out of the top a little bit.
Signs there. I mean, the B of A data, they're seeing an acceleration in their lower income.
There's some, but we've had 3 straight months now in which the wages of production non-supervisory workers are actually below inflation year over year. So you just cannot get prices to come back down again to where they were. That's not going to happen, sure. And the Fed shouldn't try and achieve it.
So the question is how do we make a $20 hamburger affordable again? Right. And the way that you make it affordable again is not that the hamburger is going to become less. It's just that your wages are going to go up more. And that's effectively what we're trying to do.
That's the only way you get back to an economy which feels like it's working for most people.
Although we all still feel frustrated to pay $20 for a hamburger because
it used to be 14.
Yeah, okay, let's continue. We only have about 12 or so minutes left before Warsh steps out. We'll be listening to that through CNBC as well, so then we can get some of the stock price action and all of that on screen. Yeah. Okay. That being said, let's take a look at some of our stocks, see how they're doing during this. Some of them are starting to reverse back down even before their 2 o'clock prices. So Nebius just went lower than where the 2 o'clock spike even started. Okay. As if the rate decision didn't even make a difference. CoreWeave, which is a company that actually benefits from the rate staying stable because obviously they have a ton of debt, and Nebius is starting to build out that debt as well. Oracle, another one that will have a lot of debt to pay if the basis points, or a lot of interest to pay if the Fed did hike 25 basis points, is a little bit higher since the 2 o'clock decision, but is starting to come back down a little bit. NASDAQ went green. It's no longer green. That's starting to sell off. And the S&P 500 specifically down 0.46%. So seeing some sell-off here, maybe some institutions using that bump as exit liquidity. Wild stuff. Iran asks for peace. Talks are going to be restored. Well, I'm surprised by the price action. I don't see that up on my thing yet, but Jesse's pretty fast. Okay. Fed swaps no longer fully price in a September rate cut as well. September rate now, just on the Fed rate decision, this still needs, I think, a little bit to adjust because I still see the July time there. Let me try to refresh, see if that fixes anything. No, I still see it still says there's a 3.7% chance of hiking in July. Okay, so maybe this is not fully up to date, but right now, by end year, we're looking at 11% chance of no change with a 89% chance of a rate hike. 37.5% chance of 2 rate hikes by end of year. Wild, and the market continues to sell off. NASDAQ and S&P pushing not to new lows, but lows since that 2 o'clock read. S&P, what's the Mag 7 up to? My beautiful NVIDIA down to 192. Tesla ended up falling below 300 for less than a minute. Climbing back up, now selling off more than where we were whenever the Fed decision was actually decided that they were going to stay flat there. Google up 1.8%, has not come back down. Microsoft has not come back down. Apple has not come back down. Microsoft about to. That said, we do have earnings tonight. Okay? Well, I say tonight, it's in an hour and a half. And the Fed rate decision is going to lead us for most of the way there. But by the way, we're going to be live till like 6:30 today. Not only are we on the Robinhood call, meaning I'm not just listening to the call, we can also ask a question. Both myself, Amit, and Roy are analysts on that call. But we're also going to be going through Microsoft, Meta, ARMS numbers, Qualcomm, Carvana, Starbucks, Chipotle, all of that together. Well, Amit is not home. He's going to be getting a WeWork, sort of setting up a little live stream for us, and then disconnect halfway through to then, go into the actual thing. He's there live in New York. We're not there. So I'm just going to keep the stream going, and they can join in at around 3:45. But that should give us enough time that in the next 8 or so minutes, we'll get the FOMC meet going here and hear what Warsh has to say. Now, the last meet was really exciting. Obviously, it was Warsh's first time at the podium. But this time, obviously, we're hoping for him to say a little bit more about how he's actually feeling. Might be a much better read this time. It is an action-packed weekend. I've been saying this for a long time. Wednesday is the busiest day for us. I will have been live for like 10 or so hours by the time this day ends. And then who wants me to do a stream with Steve afterwards at like 8? All right. That said, let me switch over to this really quickly. Like I said, we have Microsoft, Meta, Robinhood. I can also talk about my expectations for Robinhood, and we can do that roughly at about 3:45 or so. Microsoft, Meta, ARM, Qualcomm, all of these names, like even scrolling all the way down, there's still a ton of names. Very, very busy day. And then tomorrow is no different. We've got Reddit and Amazon and Apple and just a ton of names here. Big Bear and Rivian and Coinbase, and the list goes on and on. All right. If you guys like these sort of live streams, want to stay up to date, make sure you guys subscribe. It's all I ask of you. Let's quickly get back to that Elon video, and then we will listen to Warsh here in the next few minutes. Just want to make sure that we hear a little bit about what he said about China taking the lead in artificial intelligence.
Model. I think anyone realistically would say that that's still the case.
Okay, wait, I was off a little bit. 1 second.
So and I think they could release it at any time.
Just before we
Is that if they had a lot of compute, there's a good chance that they are the leaders at some point.
He's talking specifically about China taking a massive lead in artificial intelligence because of having, a much bigger head start in energy, and obviously trying to solve the chip problem as well. And solving those two problems is really what's going to get you good intelligence.
You can think of like the constraints on AI are essentially electricity and AI chips. And then for physical AI, the robots. China's also got some very good robot companies. In fact, they have these like robot sporting events.
We've already seen this.
With robots, AI is a function of whatever the limiting factor is, if it's chips or like.
What should the US government do about this? I mean, if you presumably it is a little alarming if you have an authoritarian regime far ahead in the most powerful technology. And clearly what the US government's been trying to do is, with the export controls and so forth, keep China back. Do you think they should ban the use of K3, Kimi K3, for example?
Well, the US government can't, they can pass some law that prevents US companies from using Chinese models, but they can't stop the rest of the world from using them. So it's not like the US government has authority over China or the rest of the world.
Do you think they should stop US companies from using them? There's talk of that right now, right?
I don't think that helps. That won't stop China from being the leader in AI. Really, it's for digital intelligence, it comes down to how much AI compute do you have? How many chips do you have, and how much power do you have? How much electricity do you have? So the constraint right now, I think, is actually slightly more on power and cooling than it is on AI chips, because the power demands of the AI chips are very, very high. We'll talk about water demands, but really the water usage of AI is negligible, or almost nothing. But
this is, they're doing surveys on this. There's constantly people coming out and attacking that point about what is the water usage of data centers. You're staring at one of the few people who have actually built gigawatt data centers. There's like, few companies in single digits who have actually built gigawatt data centers, and he's telling you that the water usage is negligible. But New York still put a moratorium on the data center, so we'll see.
The electrical demand is very high.
That's why you're thinking of orbit.
For any AI chips not being turned on in China is electricity and like power and cooling, and the electrical equipment and everything. The rate at which AI chips are being made exceeds the rate at which new electricity is coming online.
In China. Okay.
Outside of China.
Outside China, I see, yeah.
And since China, the US has banned the export of the latest AI chips to China, China is somewhat chip starved. But
they are becoming much more efficient at using the chips that they have. And that one of the striking things of Kimi K3, right, is how efficiently they...
And China is also, I think, closer than most people realize to solving the lithography problem, which would enable them to make AI chips at very large volumes. So I think there's, this shouldn't devolve into just a China conversation, but
well, it's a very important point, and I think that what Jensen's been doing, and what I think Elon's going to start to do, is continue to harp up how important it is for us to keep open models, for us to keep competition high, for us to keep the United States in the lead. And the reason why I care about that so much is obviously we're betting heavily on that happening, in the stocks like Nvidia, for example, or even a Meta, Microsoft, Google. All of these companies are betting a ton to win. You don't want to limit their ability by, not having open source models or not having access to, great accelerated permits in certain data centers. or all of these things. By the way, I have the meet up. It's on my other screen here. That's why I keep staring up into the ceiling. But let me go ahead and get ready to transfer over this. We're going to be listening through CNBC. That way we can have the prices of the S&P 500 react in real time. Okay, let's have a listen.
Hockey stick.
Let me know if you guys have audio if you just heard that.
Williams put it recently, he decided that we ought to keep interest rates steady, right? So he's going to have a lot of people worrying, not just outside the Fed, but probably within the Fed about, what is it that is going to take him over the line here and say, okay, it's time we do something about inflation.
Yeah, I know. Listen, home buyers, they don't care about interest rates, but they care about mortgage rates. And interest rates, the bond market affect mortgage rates. Should they just get used to just having a 6.5% mortgage for the next few years, David?
Again, the problem is you can't put the genie back in the bottle. In this case, it's home prices who went up too much because mortgage rates were kept too low for a long time. We are gradually working our way out of that, but that's going to take years.
Did the previous Fed screw up?
Yes, by keeping rates too low for too long. And the only way they can affect the economy is actually by affecting the housing market. They cause home prices to get to a level which cannot be afforded at normal mortgage rates, because there's nothing abnormal about these mortgage rates.
But it's fascinating to hear the president himself talk about this and wants a situation where home prices don't fall because the existing homeowners get hurt too. I think we're seeing Warsh approaching the podium here. Here comes the Fed chair for his second ever press conference.
Good day. My second FOMC committee meeting as chairman has come quickly. It's probably too early to call it a streak, but our discussions again were collegial and constructive. I'm truly lucky to work with colleagues so capable and mission focused, and so determined, like I am, to sharpen the performance of the Federal Reserve. Today, as you know, our committee decided to vote by a 9-3 vote to maintain the target range for the federal funds rate at 3.5% to 3.75%. The committee is continuing its policy of making ample reserves in the banking system. The economy is showing impressive resilience. Even with recent shocks, the trends are positive and reveal solid growth. Job gains have kept pace with the workforce, and the unemployment rate has changed little. Inflation remains elevated relative to the committee's 2% goal. The committee remains resolute. You've heard this before, but we will deliver price stability. As before, the policy statement conveys just the facts. It's steering clear of forecasting, a choice we consider especially prudent at these uncertain times. Uncertainty, however, does not mean a lack of clarity. For some households, businesses, and market professionals, 5 years of high inflation have left a mistaken impression that's hard to shake, that the Fed's implicit inflation target was somehow above 2%. Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. There's only a target, and it's 2%. Not one of my FOMC colleagues is under any illusion. We have begun a new chapter, and we understand that the 5+ years of inflation above target cannot be cured in 9 weeks or by a single month of modest price decreases. This Fed will not waver. Our credibility rests on performing our duties and delivering on our responsibilities. Americans are right to expect that because our nation's prosperity depends on it. To the regulars here in the press room, today's assessment might sound familiar, yet there was nothing inertial about our discussions, our policy, or our strategy. 2 economic developments are worth highlighting. The first is a very notable change since our last meeting 42 days ago. Nominal and real yields are materially higher across the Treasury curve. In fact, some of the increases in market interest rates between FOMC meetings are among the most significant in the last 2 decades, ranking around the top decile or so. But if the committee didn't change its policy rate, what happened? In the intermeeting period, market attention centered on real data and real economic developments. Prices reacted in real time to incoming information. and the reduction in forward guidance may have been a factor. Market participants are learning to play the ball, not the referee, and market prices will continue to respond in the direction and magnitude they see fit. This is, in my view, a change for the better, and we're just getting started. After all, the central bank need not always and everywhere be the center of attention. I understand the desire for rolling forecasts and commentary from this committee, but for our part, we need to observe market reaction to developments, direct and unfiltered. I want to stress, of course, that decisions by this committee matter a great deal. And where necessary and appropriate, we will not hesitate to act. A second economic development is one that I noted at the congressional oversight hearings this month, but it's worth repeating. The most striking feature of the economy is the strong growth of business investment. The surge in high-tech CapEx has been remarkable, but that does not necessarily make the Fed's role any easier. In the AI-related category of high-tech equipment and software, the most recent data shows four-quarter growth rates of nearly 20%. This is helping to sustain the healthy momentum of manufacturing output. More generally, CapEx is preparing the ground for future growth. Nonetheless, the precise timing and magnitude of effects on the supply side remain hard to predict. FOMC meetings produce policy decisions, but just as important is candid discussion of the big things that matter most. That too is a priority in this new chapter at the Fed. In our meeting, vigorous discussion centered on four questions, which I will enumerate. First, we talked a lot about the implications of the past 5 years of high inflation on the current policy conjuncture. To echo an old phrase, has the past really passed? Second, my colleagues and I considered the economic shocks of recent years, strained supply chains arising from the pandemic, military conflicts, energy supply disruptions, substantial increases in tariff rates, and yes, the surge in AI-related investment. These differ in their sources. Do they also differ in their effects on output and employment? Third, we took up the related question of price increases arising from shocks. The business CapEx boom, for example, is driving up prices of memory and logic chips and associated AI infrastructure. Do these changes indicate a broader inflationary dynamic, or do we just focus on them because they are under the bright streetlight? Finally, we discuss monetary policy tools and strategies for achieving stable prices. If, as the Fed has long held, interest rate policy should be its primary monetary policy instrument, how much accommodation are we getting from the balance sheet? In all of this, our work is advancing at the Fed. We're asking the right questions. And in this consequential time, we know how very much depends on getting the right answers. Of course, you've all arrived with questions of your own, so let's turn to them now.
Let's start with Steve.
Thank you for taking our questions, Mr. Chairman. You've had a couple months now, or 9 weeks, or whatever number it is, to see the markets behave in the absence of forward guidance. I'm wondering if you could tell me, what message are you getting from the markets as to where policy ought to be right now?
Yeah, so I think officially it's 8 weeks and 4 days, but I'm not counting. The message from markets is the message from markets. What I've really been trying to do, Steve, as I think you appreciate, your colleagues appreciate, is getting an unfiltered message from markets, getting a direct message, letting buyers and sellers meet at prices for treasuries, for the foreign exchange value of the dollar, and then trying to judge for ourselves, what does that mean about our remit? How are we doing on inflation? How are we doing on employment? we're trying not to interfere with that market signal. That's part of the reason why we've been somewhat spare in our words, why we pulled back from forward guidance. So they're reacting to events, I would say, much more directly over the 42 days since we last met. This is a good thing. As I mentioned in the prepared remarks, we've seen a material tightening, not just in nominal rates, but in real rates too. And we're observing it. We're trying to stay out of that because, you know, many of you might be interested in our reaction function. We're interested in the reaction of financial markets.
I get that, Mr. Chairman. And I guess the follow-up question is, if the markets are talking to you, what do you hear them saying? And if it's real rates are higher, it would suggest that that's where the funds rate ought to go.
Yeah, so
Sorry.
I'm sorry, it's your question. So interpreting markets is an imperfect business. We central bankers like market pros can think these things are overdetermined, but let me offer some speculation. First, as we said in the FOMC statement that you got at 2 o'clock, the economy output is solid. CapEx and productivity are strong. Labor market's solid, steady. The bond market, the treasury market, it seems to be saying that as well. If I were to try to break down, disaggregate the treasury market signals, I wouldn't be able to do it perfectly. But the bond market's saying many of those same things. And that's why we're seeing a tightening both in nominals and in reals. Even while at some level we haven't done much in 42 days, the markets have done quite a bit.
Thank you. Claire Jones, Financial Times. You seem to have got the family fight you were after at this meeting. We saw three dissents. Could you characterize the arguments that those dissenters put forward, please, and tell us a little bit why you weren't persuaded by them at this stage? Thank you.
So I guess I shouldn't give you their best arguments. I'll give you some others. So you're right. I asked for a good family fight and I got one. That's the purpose. That's the design feature. I come into this meeting, even this press conference, heartened by what I've experienced the last 2 days. Most of our discussion were on the big questions that matter to the conduct of monetary policy. We didn't sort of hide from them. We weren't scared of them. There was a lot more interaction between and among my colleagues. It was a real family fight. My view, which you've long heard, is that's the better way to get policy right. That's our North Star. So there was a lot of agreement that I heard that we have the powers, the tools, also the authority to deliver stable prices. No walking back from our responsibilities. There was a large majority support for the decision that we made in the room. But I also want to leave you, Claire, with one other impression. There was nothing inertial about that discussion. It was an active, robust discussion about what's in the full range of what we can do and might want to do in the period ahead. You characterized accurately, there was a disagreement about a decision today. I would say that doesn't sort of capture the full essence of the discussion. The path to central bank heaven requires delivering on our remit. These days, that means delivering on price stability. I wouldn't measure that path in 42 days or any one particular meeting. And I came out of that meeting even more confident that this is the right team to win the battle against high inflation.
How much do you think not going in July was down to the cool CPI print for June?
So in 2 words, not much, not much. I'd like to believe that the committee shares my views, which is the historic problem with data dependence is the data and the dependence. We are not relying on any one individual piece of data as cover or as an excuse or as validation. What I care about and what I think the committee cares about is trends on the data. Sure, we got some encouraging inflation data. I think at the meeting 42 days ago, I said something like 63 months of inflation above target. I didn't say 64, though the final calculation might be a close one. So we'll be watching inflation data over the period ahead. But I also don't want you to leave the misimpression that we're sort of breathlessly waiting that. I've called for a task force to revisit both the private and public data we use to make our decision making. That task force is out doing their work. I'll be checking back in with them the next couple of weeks, but I wouldn't say we overly relied on any one piece of data, including that data, which surprised some a couple of weeks ago.
Neil.
Hi, Chairman Warsh. Thanks. Neil Irwin with Axios. Thank you for taking our questions. So the Fed funds rate is now about 75 basis points below the 2-year yield. It suggests markets think you'll have to tighten eventually, about 100 basis points below most Taylor rule estimates. You're hitting your employment mandate. Inflation stays high. Why should rates not be higher today?
There's a lot in there, Neil. So rates are higher today than they were 42 days ago. Markets have made decisions because we step back in part from trying to influence those. Market judgments have moved up on what nominal rates are across the Treasury curve. That doesn't mean we take them as by dictation, but we're observing them. So I think it's a mischaracterization to say that markets haven't reacted because we didn't move today. Markets are reacting in real time. In the period ahead, we've got important decisions to make about the policy rate. Markets in the intervening period, I think, have quite a bit of decisions to make. I'll see if I can put it this way. Monetary policy matters not just by what we say or even what we do. Monetary policy matters by how it affects the real economy. And these prices that we see in financial markets is one of the many ways in which it affects the real economy. We'll be continuing to watch that market information, see how it responds to incoming events, and that can help inform our decision making when we meet in 7 or 8 weeks.
How would you characterize in the family fight the last couple of days of you and the other 8 members who wanted to hold? Was that a strong conviction or was that a hair trigger close call on holding versus tightening?
Well, I think the vote was 9-3. The broader discussion to my ear over the course of the last days showed a lot of agreement on the hard questions. The 4 questions I raised at the outset about what's really happening in the economy with the shocks and absent the shocks. What are our tools and our capabilities? What's the effect on prices on output? I heard a lot of commonality on the questions. Were there different leans on the answers? You bet there was. So could people come to different conclusions? Absolutely. But my own judgment is this is a period of watchful thinking, not watchful waiting. And I think the score on that vote was unanimous.
Colby.
Thank you. Colby Smith with the New York Times. You've mentioned that looking at the Fed's policy tools is one element of a 3-pronged strategy to address the inflation problem. So I'm curious how you view the effectiveness of those tools. If inflation is too high and not coming down, is the best remedy to raise interest rates?
So that was the discussion in the last 2 days. Is that the dominant remedy? If inflation continues to be elevated through the forecast period, interest rates could well be part of that solution. But I wouldn't say it's in isolation. I tried to describe in my remarks today the point that I made into the oversight committees a couple of weeks ago. I think there was a misimpression by some in financial markets, by some households and businesses, that central bankers like me, we set a 2% inflation target, but maybe we were more tolerable of a somewhat higher inflation target. In economics, we'd call that the revealed preference. And so might it have been rational for people to think, well, their inflation target's somewhat higher. What I heard in the last 2 days, what I've heard in 8.5 weeks is no, we will deliver the 2% inflation target. That is the committee's definition of price stability. So one way, absent the tools that you reference, to ensure that we get there is ensure that expectations are centered around the right number. And I think we've made some progress on that. I am not suggesting we're done on that. It's worth reiterating. And ultimately, the business we're in, Colby, is performance. We are going to be judged by how we perform. And that's what we intend to do. The inflation target, making clear expectations is one part of it. Making sure we demonstrate we're responsible for it, we're not blaming as another. And our policy tools, like you referenced, is the third and equally consequential part.
How are you factoring the fact that a large portion of the inflation overshoot is being caused by supply shocks, as it's mentioned again in the statement? Does that blunt the effectiveness of rate hikes in your view?
First, on the premise of your question, it was almost as if you were listening to our discussion in the last day and a half. A lot of our focus was on trying to understand and identify underlying inflation dynamics amid shocks. We take these shocks seriously. There have been a series of them that have been hitting this economy. We're not looking through them and saying, oh, they don't matter. What we're trying to understand is to what extent are these shocks broadening in their effect, broadening in their impact on prices that are quite far removed from it. Our goal is to have growth that is broadening and inflation that is becoming more limited, more circumscribed. I'll be the first to admit the shocks make this job and this policy conjuncture a little tougher, but that's among the chief questions we've asked ourselves. And around the room, people have different views on it. I tend to think in the coming months, we're going to refine that view and have a better judgment. And we're going to have market prices trying to help inform it too.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. I guess I want to drill down maybe a little bit. What specifically in your mind would be the argument then for a pause today?
So I wouldn't characterize what we did as anything like a pause. I would characterize what we did as a rigorous review of the economic situation. I would characterize what we did as a review of the big hard questions. And I'd characterize it as a view of what our own homework is to try to resolve those questions in the period ahead. If you were to try to force a description that this was a pause, I would say financial market prices would take the other side of that. Financial market prices in this intermeeting period, they didn't pause. They reacted to the inflation data in one direction, strong economic growth in the other direction. And nominal and real rates went up. Did the Fed take an explicit change in its policy rate today? No, but I think that's the beginning of the story, not the end of the story.
And if I could, I did want to ask, not forward guidance, but looking forward. Traditionally, a Federal Reserve chairman uses the Jackson Hole Summit as a sort of a reset of monetary policy. Well, how do you look at the speech that you're going to make in August?
I look at it like a blank piece of paper right now. I have not begun consideration with the incredible team here what would go into that document. I think you characterized it correctly. Historically, at least from my first tour of duty at the Fed to more recent periods, it would be sort of a setting up speech more often than not of what was going to be happening in the fall. I haven't made any judgments on that, but those are judgments we'll have to come to. If I could, in the high mountain air in Jackson, Wyoming, I'd like to also frame the big questions. There is a tendency, especially with the proliferation of meetings and press conferences, to get caught up in the myopic. Did you do this by a quarter or do that? Ultimately, whether we deliver on price stability matters some, the decisions we make in 6 or 7 or 8 week periods. They matter more. What are the big questions? What's really happening with productivity? What's really happening with demographics? What's really happening to the global economy amid the shocks? Haven't made a decision whether it's going to be a big picture speech or whether it's going to be a more traditional setup for all the action we're going to have between September and December. I will tell you one other thing that I am doing between now and Jackson Hole, so I'm checking with those task forces. My first principle of establishing a task force is find the best subject matter experts anywhere in the world and put them together, especially put them together with other people who might disagree with them. In the next couple of weeks, I'm going to be doing a check back in. I've given them time to sort of think hard about their agenda, their debate, their schedule, and when they might be ready for prime time. I'll be doing a little bit of that checking, and that may or may not inform anything I have to say in Jackson.
Nick Timmeros of the Wall Street Journal. Chairman Warsh, I want to follow up on Colby's question about policy transmission. You've said there's no cruel choice between stable prices and full employment. Rates bring inflation down by cooling demand. It's generally thought that can show up in the labor market. If that's not the channel you're relying on, what is?
Yeah, so let me go back to first principles, Nick. I don't believe that either part of our mandate is generally at war with the other part. I do not believe that price stability and full employment is an either or proposition. There have been policymakers over the last several generations who have thought that there is a strict trade-off there. That isn't my judgment. In fact, my judgment is if and when we deliver on our remit, we're going to be satisfying both prongs. We're going to have price stability and full employment. And in fact, if you want to do the most harm to the labor markets, you would run a period of high inflation that's variable such that employers, businesses wouldn't really know what's going on. So I think the two parts of our mandate are equally important. We have no legislative orphans here. I've been talking mostly about price stability because we're doing pretty well collectively as a country, as policymakers on the full employment side. But we're doing considerably less well on prices. That's why we describe them as elevated, and that's what's taken most of our discussion. In terms of transmission mechanisms of monetary policy, I think different tools work through different transmission mechanisms. The interest rates work through lending channels and credit channels, maybe confidence channels and foreign exchange. The balance sheet probably works through some other channels like signaling and portfolio balance. We're keeping full abreast of all these tools in making policy. But if the suggestion is somehow we're going to be fine-tuning aggregate demand so it catches supply, that's not my mental model. I don't think we're great in the fine-tuning business. We're trying to get supply and demand in broad order. But really what we're doing as we sit here today at this press conference is I think we've got a reasonable sense of what aggregate demand looks like in this economy. We're inferring aggregate supply. We're making a judgment about what productivity is. And in some sense, there's a race between supply and demand. And the surge in business CapEx in and around AI, it's making that calculation a little harder to judge. But in the period ahead, we're going to be trying to judge just that.
And if I could ask, where exactly was the disagreement today? Was it about the inflation forecast, or was it something more around the risks, the tactics?
Yeah, so I'm going to I'll let the dissenters speak for themselves. The way I heard it over the last 2 days was overwhelming agreement on objectives and authority and commitment. I didn't hear anybody walking away from it. The judgments as to how best to achieve the price stability, that was probably the question that we were trying to answer. What's the best move? What's the best strategy? What's the best way to achieve it? And a second question that was asked is, when do we need to make those harder calls? When do we need to make those decisions? And like I said to one of your colleagues, I was comforted that markets in the intermeeting period weren't reacting to us. They weren't reacting to dots or to speeches. They appeared more than ever to be reacting to real-time events. So they're gauging themselves how restrictive the Treasury curve should be. And that, I think, has been a useful development. We don't endorse any particular market move, but I'd also suggest we observe them with keen interest.
Janelle Marte with Bloomberg. Following up on that, there was more uncertainty in the markets about what the Fed would do at this meeting. To some extent, you might think that's what you want to see. But my question is about, is there a point at which you would not want to surprise the markets if they were pricing in something with higher certainty that was opposite of what you were intending to do? What are the risks that you see associated with that?
Yeah, so it's a good question. Surprise is not the objective function. Surprise is not what we're solving for. We have a clear North Star. What we're solving for is how to make the best decisions. Almost everything else should be in service to that goal. by not spoon feeding markets, by not previewing our decisions, by not sort of giving nudges and leans, my colleagues and I have found in the intermeeting period, what we're getting is the views from a very accomplished economist. That's the internals of financial markets. Instead of just repeating or echoing what we were saying back to us, they're giving us somewhat, not perfect, their own judgment. Surprises are not the objective, but at the same time, I would say we didn't come into this meeting feeling constrained by the full range of alternatives we had in front of us.
So some of your peers have continued to discuss how they think about policy decisions. And if you don't offer your reaction function or your way of thinking about it, how concerned are you that you're ceding control of the narrative?
So not very concerned. That's a short answer to the question. When some people that follow the Fed say, well, we don't want your forecast. They don't want your dot. We just want your reaction function. Part of me hears what we really want is your forecast. What we really want is your dot. In terms of reaction function, let me sort of disabuse people of a question that may or may not be real and be out there. Any central banker, especially a central banker where the labor markets are more or less at equilibrium. Any central banker, when he or she sees underlying inflation moving higher, he or she is more inclined to tighten policy. Again, when you've achieved the other side of your mandate and you see underlying inflation falling, he's more inclined to loosen policy. That's my reaction function, and I don't suspect it will cause people to not continue to pry for more, because the truth is, for a very long time in a lot of countries, coming out of the 2008 crisis, we're in crisis mode, we were purposefully providing a lot of information, trying to provide a lot of assurance, trying to tell people exactly what we're going to do, offering forward guidance with clarity as if we're tying our own hands behind our back. Well, in crisis mode, that strikes me as a very prudent policy. But in more benign conditions, it strikes me as worth revisiting. But markets and market participants and reporters have learned to devour all that information. So I take seriously that the pullback of forward guidance requires some transition. Reform isn't easy, but our general judgment is going to help us make better decisions, and in so doing, satisfy our remit.
Paul Weissman.
Thank you.
There's a mic coming.
Thank you. When you talk about the 2% inflation target, what measure are you relying on?
Yeah, so I'll give two answers. First, let me give the proper standard answer. The Federal Reserve every January outlines a statement of purposes and strategy. And in that strategy document, which I believe was dated January of this year, it describes a measure of PCE inflation as the objective function there. I have enough of my own, so that's our number, we're sticking with it. Who knows come after next January what we might say about strategy. I suspect the task forces might have something to add. But I'll say this, some version of the Lucas critique, some version of Goodhart's law in economics should remind us that when we talk about measures of inflation or something else, and we describe those measures as being consistent with our objectives, we might make them such that they're not very good measures or very good objectives. Broadly, if you said to me standing in front of you, I abide fully by the strategy document, we're going to deliver 2% inflation and not a whisper more. But to achieve that, I'm looking at a broader set of inflation data than PCE. So without sort of fully revealing my cards, I'm trying to understand, like my colleagues, what's the underlying generalized change in prices that are happening in the economy. It is not a perfect science. I might have said 42 days ago, I've got a task force for that. But we have a data project that's trying to look and see whether we can't separate the noise from the signal. And so if you would hear a message from me, yes, I care about what the PCE prints are. I care about what the contributions are from CPI and everything else. But my lens is broader than that, even though the remit is quite narrow.
Mike McKee.
Michael McKee from Bloomberg Radio and Television. I'm struggling a little bit with some of what you've said today, and maybe you can help clarify this. You've said over and over again that your job is to bring down prices, to get prices stable, to hit your target, and that you will hit your target. The market says you're not there yet because they've raised rates, but all you've talked about today is talking about it. And it's not like members of the committee weren't there before you talking about it. So I guess what the American people might be asking is, what are you waiting for?
Yeah. So believe it or not, this press conference is not all I've done today. We have spent an inordinate amount of time in the last 2 days, 2 weeks, looking at our monetary policy strategy, evaluating our tools, thinking hard about the sources of data that we have at our disposal and we wish we had. We've also thought hard about the period ahead. What among these questions will be answered with more clarity, certainly not certainty. So the decision we made today, the discussion we had in that room, was the farthest thing from inertia I can imagine. As a point estimate at this very moment, in a choice between two alternatives, you heard the results of it. But I would tell you that this discussion was far more robust, and our thinking about how best to achieve that target is advanced. And over the coming months, I expect it to be advanced much more significantly. If you were to if I were to steal a follow-up question, I won't let you, you won't be giving it up. If I were to steal a follow-up question, well, what's the world think about what you've done? I would again reiterate, what we do isn't just about what we say. It's not just about what we do. We're in the performance business. And so if I look at the Treasury curve, if I look at the dollar, if I look at a lot of things that are internals inside of financial markets, I think what they're broadly saying is that this committee does own it, has the credibility to deliver it, and they believe, like I do, that we will. But I don't want to leave you with a misimpression. We've got no magic wand. This isn't something that we're going to be able to carry out in days or weeks, but we're going to deliver on the responsibility that Congress gave us. And today's meeting and the preparation for today's meeting was an important step towards that destination.
I'd like to follow up on the task forces as well and ask, what vetting did you do of the people that you appointed to the task forces? In particular, given Mark Andreessen's substantial political spending, $25 million in just the past year to back candidates who oppose stricter AI regulation, how can the public be confident that a committee he co-chairs will provide an independent assessment of AI's economic effects rather than one aligned with the interests of the AI industry?
Yeah, so I selected 15 incredible subject matter experts to tackle 5 of the most important questions that if we get the answers right, we're going to do a far better job in delivering. And if we get the answers wrong, we have a problem. The comfort that I can give you and your listeners is we're the decision makers. The chairman of the board of the Federal Reserve and the members of the board and the FOMC, we will be the consumers of the outputs from 5 different committees. The judgments we're making will be informed by, but not at all determined by, these outside groups. My theory of the case in establishing the task forces were to pick people with extraordinary talent, depth of expertise, and a divergence of views inside every committee, so they too can have a family fight. This is not outsourcing to people that aren't known and haven't been vetted. This is seeing whether new ideas can catalyze a broader, better, more informed discussion inside the room. And I'm very confident that we're going to be able to do that. I am impressed by the credentials of these 15 people. And full disclosure, I've known almost all of them for a very long time. And I think they're going to give their best views on the subject. But ultimately, these are decisions we're going to make, and we're accountable to our oversight committees and to the remit Congress gave us to deliver.
Hi, Ann Saphir with Reuters. Nice to see you again. So I need a little help here too. You've said repeatedly you have no tolerance for inflation, and yet we are seeing above target inflation repeatedly for 5 years and through your term so far. And sure, you have no magic wand, but you have not taken action. You just gave us a little peek at your reaction function as well. You said that if underlying inflation is rising, that you would tend to think that you might need to tighten. And with the exception of the most recent inflation print, that is what we've been seeing. So could you explain what you mean by no tolerance for inflation and what you plan to do about it?
Sure. So, Ann, I hear from you what I hear more broadly from households and businesses: impatience. Deliver it already. This is not an excuse. This is a fact. This FOMC, this board has been in business for 8.5 weeks. The patience, the impatience that households and businesses feel have been going on for 63 months. We are on the job. We will deliver. We are focused like a laser on making sure we can do it. But the suggestion that we're going to be able to do it with our magic wand is one I want to disabuse you and everyone else of. But the discussion in the last 2 days give me more confidence even than I had 8.5 weeks ago. This team that we have at the FOMC, the support that we have from board staff, and the new hard questions we're asking, we need to resolve those. And as we resolve those questions, get smarter on those, we're going to deliver on the remit. You don't have to take my word for it. If you look broadly at market prices, they are certainly not saying all clear, but they are working in concert to keep us on our toes. And they have tightened financial conditions in this intra-meeting period. And that has given us, that has provided us some comfort that we've got the ability and capability to deliver.
And is your read or your, I guess, faith in markets' ability to sort of make a judgment and then you to take signal from that judgment, how does that affect you when you come up on the September meeting and markets are seeing a near 100% chance of a rate hike as they see now? How does that feed into your decision making and your thinking?
So we're not going to be constrained by market prices. We're not going to be constrained or take verbatim from what the market's doing. But I think it's useful and to understand that markets can be a very good source of information, not a determinative source, not a perfect source. But if we're trying to land the plane and deliver 2% inflation, and we take a very useful source of information and we get it all fogged up by giving it our own forecasts, by providing rolling commentary, I can assure you that we're going to have less information, less ability to land the plane successfully and deliver price stability. We're just trying to make sure that that source of information is as direct and unfiltered as possible. It isn't to the exclusion of data sources and opinions and other surveys. But if you're hearing from me, we wanted to make sure we were getting a better source of information. I think in a relatively short time we are.
We'll go to Brian Chung for the last question.
Hi, Chairman Warsh. Brian Chung with NBC News. So you said you'd be open to having press conferences when there's news to make. So today, no change to rates, no forward guidance. For the average household, I guess, what was the news today?
So apparently it was news that I had a press conference. Let me just see if I can offer some clarity on that. between now and year end, my predecessors and the Federal Reserve committed to press conferences this year. I'm committing to press conferences this year. That might be news to the people in this room and of no particular interest to your viewers and your and your readers back at home. What I can offer as assurance is that the Fed's on the case, that this Fed chairman feels better about this board and this committee's ability to deliver than I did when I showed up here on the first day. And I showed up pretty confident. I've been heartened by the reception that I received. No doubt in some of your commentaries today, you'll talk about a divided Federal Reserve. Well, that's not the feeling I felt the last couple of days and the couple of days before it. What I felt was a group of professionals, all with different perspectives, different views, different judgments, but eager to roll up their sleeves and have a family fight, and eager to reform the way in which the Fed does policy, a keenness and open-mindedness and curiosity about that. So we have a far better chance to deliver on the remit that Congress gave us. And so I want to leave you with the optimism of a new central banker that we're committed as ever to deliver and to offer an assurance we will. Thank you all very much.
That was Kevin Warsh. I actually think I'm going to go back to that and listen to CNBC just to hear some of their thoughts. But it's pretty weird to see. Like, what do you want him to say? He comes on here. He's forced to come out and do press conferences, as he said, at these exact dates. There doesn't need to be something new that ended up happening during those periods. He said it's like we're monitoring the situation. We haven't felt a need to move just yet. Next question. So it's a little bit just stable right now. That said, let's listen to CNBC really quickly react to this, and we'll get back to the market close.
This is the move in the NASDAQ, which has now gone positive, albeit slightly, but nonetheless, it is now green and has been trading in the red for the better part of the day. Now let's bring in Jeffrey Gundlach. He is the CEO, CIO, and founder of DoubleLine.
Nope. Okay. That said, the market had quite the reaction at 2 o'clock all the way to 2:30. And honestly, for the most part, definitely loving what Warsh had to say at 2 o'clock. The S&P 500 was obviously lower than where we are today, or lower than where we are right now. So it has gone up a bit, but not obviously very linearly, especially as the last couple of questions were questioning whether or not that he can give correct guidance, or if he's doing this for political reasons, or, questioning the Fed's integrity. And that, wondering what he needs to see. And I forget who put it in. I think it was AD in chat earlier, but he said, it's nice to see a Fed chair that trusts a free market system. And I agree. Like, let the system try to figure itself out. At least that's the way that I understand it. You're supposed to be there for an emergency, not in absolute any single thing that leads us to higher inflation or worse jobs outcome needs to be immediately solved by a one lever solution that can pull a dual mandate in, continuously bifurcating directions, whether that's increased inflation and better jobs, or, improving inflation and worse jobs. So we'll see. But overall, I think the report was okay. The market's starting to sell off. We were green a second ago. Trump just said that, we got some new Grok models that just came out here too. Well, the Fed was talking. But Trump just said that Jensen Huang was in the Oval Office. So he's there talking about potentially open source policy right now, trying to push that along. And Elon just ended up forwarding this tweet talking about how Grok Voice Think Fast 2 is putting up some amazing metrics on speech-to-speech quality indexes Big Bench Audio. Very interesting. Speed as well, very low. All right. Grok and MetaMuse, Spark, and Gemini, these are always the ones that are considered like, falling out of the frontier level in the AI race, only to then bring it right back and them do extremely well. But let me get a little poll from you guys while we have you in the chat. What do you guys think about delivering on this 2% inflation goal? Do you think that this is possible for Kevin Warsh without just, obviously leaning to a bunch of rate hikes? Because obviously they did take an opposite position versus those three dissenters. So are they saying that inflation will come down on its own? Get your moon boots ready. Yeah, markets are now selling all the news. But that's the thing. Like Kevin Warsh literally came out and said there is no news. Okay. He can't deliver 2% while Trump is in office. It's not going to happen. The Fed only has one. The Fed only has one real tool, but they got some balance sheet tools as well. But yeah, controlling rates is definitely how they steer the ship for sure. Okay. By the time the Fed wants to cut, the market doesn't believe a word that they say, and the market will tank, ignoring any good news. Well, that's the interesting part is like we're in the midst of an earnings season that seems extremely strong from my view. Obviously, there's a lot of spend, but spend is usually good for economies and might not be individually good for Google or something like this to increase CapEx, but it's usually pretty good for construction jobs and data center buildouts and all the component companies and, all of these things. So, Google might need to fire some people for their amazing amount of overspend. Micron and SanDisk and, Bloom Energy might be doing some of the hiring on the other end. Now, as long as we continue to see large amounts of buildouts and better than expected earnings, I'm very positive on the S&P 500. Obviously, in the very short term, like right now, the market can sell off, but it's not always a great way to sort of signify where the markets are going to be 3, 6, or 12 months from now. And that's just in the near term. Okay. In 20 minutes or so, we're going to be joined by Amit and Roy. Let's see. Just double checking. Okay. And we're going to be going through earnings at 4 o'clock. That's going to come faster than you know. Might be selling the news, but SoFi keeps putting in higher intraday bottoms. Oh, no. Higher bottoms. Why do you say higher bottoms? I see what you're saying now. I got you. Okay. Amit's in New York getting ready for the Robinhood event. He'll be there in person, likely to ask a question on the stream. And they do a video stream, so we'll see them. We'll likely see him on stream. That'll be fun. It's hard with oil prices the way they are. Let's take a look at oil prices. I think I checked right before the meet, and we were at something like 82, 83 bucks a barrel. We are at 84, 84.66. Gotcha. Okay. Did you guys hear this story? The Pentagon is moving to build hyperscale AI data centers on at least a dozen U.S. military bases. And, you know, we sort of thought about this, that the data centers are going to become so important that they're almost going to need to be protected militarily. You know, think about terroristic attacks, not just attacking or you know, in war efforts and stuff like this, hitting utilities and bridges and all of these things. Data centers are going to be a very, very big part of that going forward. Not only do I think that there's going to be AI data centers for military purpose, but also regular data centers that are also being protected, which I think is a pretty, I don't know if that's dystopian or not, but it's definitely a wild future. Okay. Iran bombed Amazon data centers. Yeah, they did actually. That was, they did. It was a AWS in, oh, I can't remember now. Was it in UAE? Something like this. Nebius is dumping right now? Okay, let's take a look. What are we at for Nebius? Wow, you weren't kidding. 151. You know, you never think you're going to see this company under 150 again. And here we are. Yeah, it was UAE. I'm pulled that out of my hat. Micron selling off. Let's take a look at my AI watch list here. Cypher Digital down 11.6. Iren down 11. Nebius down 10.5%. Cerebras. Is that lower than IPO price? I think IPO was like 189 or something. Yeah, wild. Almost all-time lows for them in public markets. CoreWeave, $62. You've got to be kidding me, man. I'm looking 1 year out. This is 52-week lows. This is the lows that we've ever seen, the lowest that we've ever seen since May of 2025. Like more than a full year of erased gains. That's wild to me. Like, what was CoreWeave's revenue and earnings last year? How many data centers did they have a year ago that now they have fully built out and recurring revenue on them? Like, just the chips are running, contracts are being paid, customers continue to show up, and people are calling for CoreWeave $40. If this is a time to be in a concentrated portfolio, I'm going to have to frickin' I'm going to have to buy some more CoreWeave. Okay. President Trump said that NVIDIA CEO Jensen Huang is in the Oval Office discussing open Chinese AI models and chip sales to China. Important. Someone said in the chat that, and they were spamming it, so probably, you know, has ulterior motives, but that Meta is pausing CapEx. I don't see that story anywhere. Not saying it can't happen. Anything can happen, but I just don't think that would line up to anything that we've seen, nor do I see it on here. I think potentially the scariest news today is the CoreWeave sweetening their debt offering, that people are not picking it up as fast as they'd want, and so they're making the offering even better. Another scary part of the story today is that Chris Patel is starting to get bullish on SoFi. When me and Chris agree on a stock, scary things happen. So, you know, a few dollars ago, this dude was telling me that it's just a bank. And now he's like, man, this bank looks good. Okay. Disney is dropping Microsoft's GitHub Copilot and several other AI tools for OpenAI's Codex in August, Business Insider reports. The company plans to adopt OpenAI's Codex while retaining access to Anthropic's Claude Enterprise and Cursor. Oh, wow. Dropping Microsoft's GitHub Copilot. What would I sell to buy CoreWeave? I don't know. I'm not sure. I'd also like some Nebius here, though, too. 154. Like, I'm aware it's not the cheapest price that we've seen in a year, but their performance has been spectacular. They don't have this unbelievable looming debt. I think they're going to take out some debt for sure. But there's quite a large difference in the growth rates that these companies are expecting as well. Okay, Micron's also down below 770. The AI sell-off continues. There are positions that are looking fantastic. Lumentum down to 619. The craziest part is some of these are the component names like Micron and Lumentum. Do we really think that these companies are not going to benefit from increased CapEx this cycle? I mean, of course they do, but they just think that it's not going to last very long. Okay. Trump also said that we will be hitting Iran hard. It's our turn to. Uh-oh. Okay, let's see what else is going on. No reason why U.S. debt should be downgraded, said Kevin Hassett. Looking back on all these people saying about the hike, funny. Now that we didn't, does their investing strategy change? Or do they just stay bullish or bearish?
National Economic Council Director Kevin Hassett joining us now in a first on CNBC interview. Kevin, it's great to have you on to kick off the coverage. I learned something today. I learned what a vestigial bone is. So I guess
Is that audio too much? That sounds crazy to me. I don't know if I want to listen to that. Might be too much. That's all right. Okay, let's go through Robinhood's numbers, and I might have to do this again later on. But Robinhood's about to report, and let's sort of theory craft what we're about to see, and I'll show you guys why my thought process leads me in this direction. Okay. So, and I've not revised these up. I honestly probably should. This might even be low now. Here, wait, let me bring up Wall Street forecast as well. They probably have it higher than mine because I have not put them up yet. For Q2, they only have 1.2 billion and 41 cents of EPS. I'm at 1.3 billion for Robinhood. The reason why I have it this way is, well, we have to break it down by revenue segments. Okay, so this is how I like to forecast this company. We look at transaction-based revenue, net interest revenue, and then other revenue, and I'll talk about each one. So transaction-based revenue falls into a few categories. Options revenue, like from options contracts, cryptocurrency, equities, and then other, which is things like prediction markets. Okay. Prediction markets, if I scroll down here, these are all, taken from their actual numbers. So Robinhood posts monthly metrics. And what we ended up seeing from April, May, and June is that they were putting up these levels of numbers. And then so we can look all the way out to June to estimate how much that'll be. And actually, I didn't update this. Wait a second. This could be higher or lower based on my numbers. So let's go to Robinhood, because I remember they did a second June color. They've done 2 June colors in that month. So let me just see. Selected June metrics. June 1st through June 25th, equities was approximately 343. No, that's what I have. Okay, maybe I did change it over. No, that's AO. AO. Oh, no. Okay. Sorry. I switched it over. Sorry, I did switch it over. 25th. I was reading the 18th and I was like, okay, that was the first time that they did their color, which was based on these numbers here. Anyway, it is updated. But the interesting part about this is a little bit about guidance as well. Oh, is the NASDAQ crapping out right now? NASDAQ's almost down 1% before the market ends up closing. Uh-oh. I saw your frenzied messages in chat. VIX just spiked. Wow. Okay. Trump looking at AI controls. Okay, wait, let's get a Trump live stream. I didn't even realize he was talking while Warsh was talking. Okay, Trump. Is he live? Okay, yes, he is. Okay, enjoy.
Very little they can do about it. It was a different group than we're dealing with. They've already apologized, but we got to smack them a little bit.
Mr. President, that's going to hit back when they strike.
Will I always hit back? Yes. Pretty much.
Mr. President, just want to put clarity on that, sir. Is that in response to the attempted ballistic missile strike on Jordan last night? When you say it's our turn to hit back?
Yeah, I think more so that, because it was another smaller event. But no, they sent 8,000-mile-an-hour missiles at us. And fortunately, we had our people operating the greatest equipment in the world, namely the Patriot system. Think of it, 5 missiles going 8,600 miles an hour, big ones, coming right at us, and all 5 were shot down. How about that, right? Pretty good. Nobody else could do that but us, yeah.
How was your meeting with President Vladimir Zelensky yesterday?
It was good.
Do you see a time scale for getting
No,
that?
it was good. Look, he's out doing his thing. I'd like him to end the war. So it's very simple. I get along with both. I get along with President Putin. I get along with President Zelensky. Like I told him, I want to end the war, get the war ended. Thousands of people, 25,000 people died last month. That's standard. And it's not acceptable. So I said, just end the war.
Mr. President, on the war, do you want the House to come back before August 31st to act on the Russia and Iran sanctions bill after it
Well, if
clears
it's
the Senate?
necessary. I mean, it shouldn't be necessary, to be honest. But if it's necessary, I'd like to, are you talking about the Lindsey Graham?
Yeah.
So I'd like them to add Iran as tariffs, not just as sanctions. I think it's important. That's what Lindsey wanted. because I heard that they have tariffs on Russia, but not on those 5 countries with having to do with Iran. I'd like to see tariffs on Iran. It would make it much stronger. So perhaps you're very good at this. You can maybe tell them. I think they should put in for Russia, but I think they should put in for Iran. And that's really what Lindsay wanted. Yeah.
And on Iran, one more, sir, sorry.
Good job at the dinner the other night.
Thank you.
Did a great job.
Thank you, I appreciate that. President Xi told you that China would not give or sell Iran any weapons. And there's a new report that Iran's about to get 400 rocket launchers from China going through Pakistan to Iran.
Well, that would be surprising. I mean, things like that happen, but that would be surprising. He told me very strongly he wouldn't partake, and he knows I'd be quite disappointed. Yeah, please.
Mr. President,
And he's coming here, I think, on September 24th.
2 questions. First, we're coming up on the 25th anniversary of 9/11, and a good number of 9/11 families have called on New York Mayor Zohran Mamdani to not attend a number of these memorial services. What are your thoughts on that?
Well, I think they're having a hard time with Mamdani. The people having to do with anybody having to do with 9/11 right now, on the victim side, and there are a lot of them, they're very unhappy with what's going on in New York, and they're very unhappy with the mayor. I understand that. Yeah, please.
Thank you, Mr. President. Senate Republicans are underway negotiating the budget. Would you sign a CR without the Save America Act protection? That's something you want to see?
I'll have to look at it, but they should get to Save America. How simple can it be? Voter identification, proof of citizenship. I mean, now you have to understand the Democrats, not one Democrat will sign because they want to cheat. There's no way they can get elected if they don't, if that happens. But we should have unanimous Republican support. And if we don't, people should look at those Republicans. But think of it, who would not sign voter identification with photo? And who would not sign proof of citizenship? Only people that want to cheat. Thank you very much, everybody. Thank you. Thank you.
Thank you, everybody.
Okay. Just got the tail end of that, but still. As you guys can see in my post there, the 30-year U.S. Treasury yield now just hit 5.21%, the highest level in nearly 19 years. This is why markets are falling. If there is a lack of purchasers for U.S. debt, rates will go up to find find buyers. If there is a ton of buyers for long-term U.S. debt, then rates will fall because there is demand, right? So it's a little bit of like a bet on whether or not people are bullish on the United States right now. And so the actual NASDAQ and the S&P 500 are falling even after potentially good commentary from Warsh, or at least as the market was taking it at the time. So, yeah. Micron, less than $750 a share now. CoreWeave, $61, but to head back to intraday lows. Super Micro, down to intraday lows as well. Even companies that reported yesterday showing off amazing numbers are selling off. It's a big uh-oh for sure. A little bit worrisome, but hey. It is Trump, but am I joining Roy and Amit? Yes. Yeah. They'll be joining here as well. Streaming themselves as well. But we're all going to be listening to this call together. And you're correct. I'll actually change my background here because got some other people joining. In fact, want to hear Amit's thoughts? Some people are saying, welcome the man himself.
What's up, man? How are you?
Oh, man. It's SoFi earnings coupled with, this falling apart macro. And I'm just, it's hard to go through sometimes,
And now we got Meta, Microsoft, and Robinhood to save the day, right? So,
I don't think rising CapEx is going to save the day.
yeah, dude, this is ugly. This is it's one of those days where you sit back and you're like, oh, there's a lot of selling that's happening right here. I know you were talking about Warsh. I am struggling between two things. Number one is this forced deleveraging on an institutional level that is exacerbating the level and the velocity of the sell-off, or is this a structural thing that has changed with the AI trade? I don't know. It feels more like forced deleveraging because there's a lot of evidence that the AI trade is fine. The evidence is just the earnings and the CapEx that eventually goes back into the AI trade. But it feels like,
and I think we're also seeing a lot of evidence in that with South Korean markets, right? Like forced deleveraging. A lot of these companies are selling off, and but margin levels are correcting. So who knows? Maybe it's a very healthy sell-off then, if that's such a thing. You buying anything?
I've not bought anything. I mean, I bought the dip in July, but at this point, everything feels like a falling knife, and I would like to see some recovery on a lot of names without having to time the bottom. So,
yeah.
I traded some things today, took some shorts, but
really,
the few $100s you make on an intraday short doesn't help the tens of thousands that are going down in the long-term portfolio. So
yeah. Roy, how are you?
Good to be with you. I've got the low quality setup on here, so I apologize, but yeah, here nevertheless. Low quality setup for high quality earnings, right?
Both of you guys. I'm dealing with WeWork solutions and office mics, and it's unbelievable. Show up for your A game, okay? This is Robinhood earnings.
So for everyone watching on my channel, I'm going to be at the earnings in person like last year, so I'll be leaving at around 4:30, so the stream will still be live on my channel. But I'll be there in person. And yeah, I think having said that, we should get into Hood. I mean, Roy, let's start with you, bro. What are you thinking? You think we crush it?
Oh yeah. I mean, like we're looking at all-time highs for equities, all-time highs for options. Of course, for predictions markets, the revenue for that alone will surpass crypto. There are some measures in there that won't even be accounted for, but I'm sure that they'll talk a lot about Rothera and how successful it was during World Cup. We'll have to see. I'm really curious on the pivot between having the predictions market back-ended with Kalshi to instead their own platform. And then that Robinhood chain, like it is just taking no prisoners. Like the volume there, number of users, total value locked, even stablecoin, the velocity of money that's on, like it just, even the fees, like it's doing really well. That won't reflect in the earnings. We have most of the numbers as always going in, and they're just going to be really, really strong and good. So yeah, it should be very good.
Have you factored in their merch sales into their Q2? Because see Amit there, he's been spending some money at the Robinhood store. Maybe we got to factor that in.
Yeah.
No, in reality, event contracts is going to be, I mean, the really, really exciting part. And I hope they give us some July color here too, because the World Cup finale was way, way bigger than a lot of the main games, right? So hopefully they can give us a little bit of forward guidance that way. I know they don't actually do guidance, but they have said a few times in the past that, you know, we're on track to do our best quarter for equities, for options. Will we see any color on event contracts? I think that could get the market very excited. But for the most part, predicting their actual earnings is quite easy because we have only something like 4 or 5 days missing, you know, from the color.
I think there might be like two possible upside surprises. So one is related to predictions markets, Rothera in the World Cup. So they didn't really charge much in the way of fees from the Rothera platform itself, but it looks like most, if not all, the World Cup traffic might have actually been on the Rothera platform. I think I was initially wrong on that. And if so, that means that they basically get double the amount of revenue for each of those contracts that are sold because they didn't reduce the price in app. And so as a result, that could be a nice upside surprise. And the other place is with stock lending, the securities lending specifically. Usually in a very robust IPO season, you see very good numbers from that, like we saw last summer. It was a little disappointing last quarter, but I think that those two might be the numbers that we don't know. Of course, margin book also looks really good. That end up surprising to the upside. But yeah, overall, we know most of this stuff.
Can I quickly ask the chat? Because Vlad tweeted out that the event contracts, you would get 50% off if you were a gold member and you were trading World Cup event contracts. Did any of you guys see that in app or no?
I didn't look for it.
Okay.
Yeah, I'm curious if somebody in the comments did.
I did not trade a single World Cup event contract, to be honest, but you know, the platform had billions, literally billions of contracts traded. So that should definitely be good for what's been going on with Hood, even though we'll see some of those results in Q3. My only fear for this earnings is that, like, Tanner, did you get a final revenue number in your projections?
1.315, 1.3 billion.
So that was, I'm at like 1.307, and the street's expecting 1.28. So I'm like, I don't know, dude. Even though that's a beat on a day like today, I mean, SoFi had massive beats and market didn't care. ASML massive beats, TSM is Robinhood special enough to get the pump? And honestly, I don't even need a pump. Like, let's just not go back to the low 80s and 70s. If we could just stay around this 88 to 90 range, I'd be happy on a day like this. But I don't know. I don't know how the market's going to interpret these numbers. But we know the numbers are going to be amazing because Q2 obviously was a record quarter.
Yeah, yeah. I mean,
I think.
Go ahead, Roy.
Oh, you go ahead.
No, I was just going to say we've definitely seen some pretty large surprises, especially on EPS. They've definitely have shown way higher margins than I would ever have expected in previous quarters. So if there is going to be a massive surprise, it's going to be their take rate. But obviously, we know how much volume that they've actually done. Like, it's hard to be wrong on a lot of that. It's just what's the take rate on crypto? What's the take rate on, their options contracts and then event contracts? I think we kind of know. Pretty flat rate, but because of the recent changes, is this much better for them because it's their own platform, or are they just passing on the savings to the consumer?
Yeah, and I think the other big thing right here is, as Roy said, their crypto chain, as valuable and as cool as that is, I don't know if we're going to see an economic impact of that in the coming months, maybe not even in the coming year, right? Like, they're building this massive crypto ecosystem, super bullish, but it's not what they make money off of. They make money off of the transaction volume. So that's something that's super bullish, just like the Trump accounts are super bullish, but it's not necessarily revenue generating or earnings generating in the short term. And, this market is short-term focused right now.
I think it is, though. I mean, so we can see, you don't have to go on Artemis for this, but if you can throw this up, I'll show you these metrics real quick. So, of course, daylight. A lot of this is, we're just looking at 1 month. If we look at 1 month instead of 1 year, but like you said, fees. This is what they've been making. It's real money. They peaked out at 350,000, which, I mean, like, that's not a ton, but for 1 day, it's quite a bit. We also need to remember, although this is actually pretty low, surprisingly so. Usually over weekends, these don't do quite as well. Just the way the crypto does. But it's a decent bump in terms of revenue. Now, I don't know going forward, because this just started, so for the next quarter, if this is going to be broken out in addition to the crypto numbers, or if they're just like, hey, cryptocurrency transaction numbers. And what's going to be really interesting to see is, my guess is, because of the way that this is vertically integrated versus what they've done before in the past with crypto, this might actually end up being a higher take rate overall.
That's fair. It probably will be a higher take rate. No, you're right. But the thing is, that's Q3 though, right? We didn't get any of that.
Yeah, this is Q3.
Okay. Yeah, it's a fair point. Look, if Robinhood Chain ends up flipping a lot of the decentralized exchanges volumes, I mean, it's definitely bullish. Question is, what's the take rate on that? Because if it's not a good take rate, it's not going to come down to the bottom line. But there are things to be excited about. The Trump accounts, we had to spend $100 million on that, so that was more OpEx. But the Trump accounts are super bullish for long-term AUM accumulation. So, that future of finance story on Hood, speed, innovation, that's not slowing down. It's just they have really tough comps from last year. Which is
yeah. Do you think that they're expanding internationally? Do you think that they're actually going to start seeing meaningful market share take? Like, I think the UK, Singapore, some of these launches have been okay, but I've been very surprised to the upside on how good of a launch the Robinhood chain was.
Dude, people like trading meme coins.
it's incredible. It's incredible.
And people can trade it internationally, right? Because it's crypto. So
Yeah. But when do you think the next, 5 million members ends up coming onto Robinhood's platform? Or do you think that's just gradual? Or is that catalyst driven?
I think it's gradual. Yeah, I mean, the biggest catalyst for them, they added like 10 million members in 3 months when you had the GameStop squeeze.
Mm-hmm.
If we get a catalyst like that, maybe, but they're not expected to get 10 million members tomorrow. They're expected to get, a couple 100,000 every quarter, as they've been doing.
Yeah. So the 2 quarters that we know, or 2 months that we know about, I believe it's 0.3, so 300,000 net that they've increased by. And so we'll have to see what the last month looks like. But it doesn't hurt to have major IPO events like SpaceX, certainly. And also, like, the big factor is going away from the pattern day trading rule. It's Stephen Quirk's fireside chat seemed to indicate, like, hey, they've lost a lot of users in the past, that this might be a way to reclaim them and also mitigate some of the loss going forward. But yeah, international, I think it is going to be, like Amit said, that it's just going to be that they'll slowly take market share. But the one pushback in the back of my mind is they did this big senior convertible note raise, not because they needed to. It's not because they're running out of money or anything like that. They have plenty of the balance sheet. It's optionality, but we don't know exactly what that's for. And so is it like, hey, we see this great opportunity out there, we just really need to ramp up our marketing? Is there an acquisition in play? What is that exactly for? And I'd love to hear that in the earnings call.
By the way, SPY just lost 730. Tanner, you can show the sell-off that we are experiencing here.
Yeah, we're at new daily lows right now. Look at the NASDAQ, down 1.6%.
The worst part about this is it's been every day for the past week and a half. I think there's maybe been one green finish, and that was like barely. It's just been 3%, 4%, 5%. In the case of Micron, it's been like 7% every other day. And at this point, it's just feeling like the market legit is afraid of this AI bubble popping, or there's a forced deleveraging event. Even though SaaS is up, as Chris says, which it should be up, because if SaaS names can't go up, as the semis are down, Palantir being the exception here. So
what's going on here, man?
I don't know, dude. There was some sell side report that said they're going to miss their U.S. commercial numbers yesterday, and that kind of tanked it. But the other SaaS names are getting some momentum.
Yeah.
The ones you didn't buy.
Yeah.
I was just trusting you guys. You guys are the Palantir boys. I follow in, and now all of a sudden the tides start to change. I don't know what this is.
You guys are a bit more bigger in terms of analyzing the neoclouds than me. I'm assuming nothing in your thesis has changed for both of you. Roy, I know you're big in CoreWeave. Tanner, big in Nebius. Like, do you think, again, this is just momentum drawdown, or it's just like they're going to get hit if the semis get hit, and it's kind of inevitable? You have to deal with it if you're if NVIDIA's down 3%, obviously Nebius and CoreWeave are going to be down more.
Yeah, it seems like more than that. I especially with CoreWeave, like the way that they're looking at this debt is, I don't think I think the hardest thing right here for CoreWeave is that the analysts that cover the data center plays in CoreWeave are not usually associated with energy and energy trade stocks. And the challenge there is with CoreWeave, they have these take-or-pay contracts, which are known and basically guaranteed revenue. It's very hard to get out of those, that are longer term. And so, like, when Meta announces like this whole data center thing, we'll see, what that ultimately looks like. But they're like, the thing that's not going to happen is them exiting their contracts earlier than the December 2031 or December 2032. They have two different ones. But anyway, like, if analysts that were covering the name and investors as well understood, like, these are take-or-pay contracts, there's no threat of losing them. And even if they did somehow, like, they right now could just come out and also announce longer-term contracts for higher money than what they currently have. But with the take-or-pay contracts, the reason why you get the loans that you do is this is just how it works as far as these energy infrastructure plays. Massive contracts that cost a lot of money, guaranteed revenue, and then you take lending against that. So it's very easy to actually project and see what that revenue curve looks like if there is a threat to this debt, an existential threat. The only possible threat is massive delays in their data center projects, and that's one of the areas where CoreWeave actually really excels. They've had one single data center, I believe, out of all the data centers that they have, and they're huge, that had a delay, and then that was quickly rectified. Now there are some credible bear theses, but for the most part, like it's just, oh, there's debt, and it's the debt is higher than present revenue, and we're just going to ignore the future. Okay, and we're also going to pretend like that the future with the take-or-pay contracts is not happening. It's like that's really strange too. It's just odd.
Sorry, my mic was muted. What do you think about this story, Roy?
Tanner, the market is closed.
Do you have a bell?
I do not have a bell.
I got a water bottle.
Okay, there you go.
How'd
All
I
right,
do?
So Tanner's controlling the stream, so he will have the stock prices up. But just to give everyone a glimpse of the earnings, we have Microsoft, Meta, Hood. Obviously, those are the top three. Whoever gets the numbers out of me, Tanner, and Roy, whenever we get them, we'll just stream them out. You have Starbucks, you have Chipotle, Lam Research, Fortinet, Carvana, EA Sports, Teladoc, Equinox. So we have a lot of stuff, but Meta, Microsoft, Hood, we're going to try to get those as soon as possible and see what the market says.
I forgot I was controlling, so give me a second.
Yeah, Qualcomm as well.
Yeah.
Yeah, paying higher rates on your debt obviously is not a bullish thing, but it doesn't destroy the thesis at all.
Okay, I have Qualcomm. Adjusted EPS, 221. That was in line. Revenue, 9.9 versus 9.6. That's a beat. Fourth quarter adjusted EPS, 205. The street wanted 235. That's a miss on the guide. Qualcomm says we are seeing unprecedented increases in memory pricing. Supply constraints made cyclical headwinds for global smartphone industry in fiscal year 2026, which means it looks like they're saying the smartphone market, which is their biggest market, is not necessarily recovering. Which they kind of hinted at the investor event.
Wow, just lost that. Up 3% to down 2%. Microsoft's up 2.4. You got the numbers on that?
Microsoft is, I don't, but I have Meta. Meta missed EPS by 14%. Street wanted 720. They came in at 618. Revenue, they beat by 1%. Street wanted 60.29. They came in at 60.8 billion. Oh boy, you can't miss on EPS.
That's surprising.
You can't miss on EPS.
Microsoft pushing higher, up 2.4%. I got their numbers here. It says revenue is up, beat by 3%, up 18% year over year. And EPS, the street wanted $4.24. They got $4.81. Beat by 13%. EPS is up 32% year over year. Do we have CapEx numbers for these companies just yet?
We do not have CapEx yet. We should be getting that very soon. We don't know if they're actually going to. Oh, no, Meta gave it. Meta says, whoa. Okay. This is not that big of a deal. So Meta is keeping it at 145. They increased the lower end from 125 to 130. They are not giving 2027, which is what I thought I saw, but they're not. So 145, Meta's keeping it for 2026. We might get it on the call, folks. We're probably not going to get it on the print. Microsoft is also, I'm not seeing CapEx.
Meta's down 7.5% now.
Oh my goodness.
Them not raising their CapEx on the top side is strange if they're actually going to be serious about the data center build out for themselves.
That's correct. They did not increase their CapEx for 26 on the top end. You're right, Roy. So I think the market's more upset about the EPS miss. Tanner, can you pull up ARM? ARM, we have 45 cents versus 40. That's a beat. Revenue 1.29 versus 1.26. That's a beat. Q2 revenue 1.38 versus 1.34 guide. That's a beat. EPS guide 47 cents versus 43 cents. ARM has a triple beat. You're getting a little bit, but
wild.
Yeah, obviously still taking a hit. Wow, 7% on Meta.
Yeah, Meta's down now 8.7%. And Qualcomm's down almost 6% right now. By the way, both of these companies were down, like Qualcomm was down 4.4% during the day to only follow it by another down 5.2%.
Tanner, you can share my screen right here.
Yeah.
A little more coverage on Meta right now.
You're working overtime, eh? No setup, still can't perform as fast.
Now, Meta revenues did beat estimates at $60.8 billion versus estimates of $60.17 billion. Now, we are always focused on CapEx for Meta. Meta raising the bottom end of its CapEx range to, for this year, fiscal year CapEx between 130 and 145 billion. This is a slightly narrower range than what they had previously forecast to of 125 to 145 billion. So not moving the top end of that range, just bringing the bottom end of that range up higher. The company also guiding to third quarter revenues of 61 to 64 billion. The estimate is 63.15 billion. So we're going to continue to dig through these numbers. We see shares now down 8%. But
yeah, it feels like the EPS beat the street is upset about. Is Hood out? I don't see it yet. Nvidia just lost 190.
Hood's numbers must be out. They're
tanking? They're
no,
up
3%.
Oh my goodness. Can Hood actually, can we do it? Can we do it, Hoodie? In one of the worst macros we've seen all year.
Oh my gosh.
Hood's at 92. Even if we stay in the 90s, dude, I'd be happy. Robinhood 1.31 billion versus 1.28. That's a beat on revenue.
Dude, I hit the freaking thing on the head.
You got it right on the
I said 1.315. I was off by $50 million or something.
Tanner, you got to share screen. Crypto revenue 100 million versus 86. They beat. EPS, whoa. We beat by 44%, folks. Street wanted 43 cents. We came in at 62. How the hell did they get 62 cents a share?
Maybe the Rothera, the World Cup stuff, just
yeah, they can squeeze out margin like crazy.
The analyst got it wrong then. The analyst did not see the pricing power on World Cups. EPS is up 50% year over year. Revenue's up 32. It's not, 100% like last year, but 32% is pretty damn respectable.
Fortinet's up almost 10% right now, and Lam Research is up 9%. I don't see their numbers, however, but these companies are also moving very big right now. Carvana down 10. Nothing new there. That happens every time, it seems.
Real quick on Meta, the guide is 64 for next quarter. The street one is 63. That's a beat. CapEx, we talked about 148 billion. Advertising revenue was up 27%. Their operating margins went from 43 to 31 because they had 3 billion in legal fees and 1.2 billion in severance costs with the layoffs. And then they're blaming AI infrastructure investments. So their operating margins took a big hit, which also the street might be upset about.
We lost the Robinhood pump. It's now flat. Microsoft still up 3.5%.
Microsoft, I'm waiting for more numbers, but they beat operating income by $1 billion, 40 versus 39. Revenue, they beat by almost 3 billion, which is a pretty big beat for a company like Microsoft. And then EPS, 13% beat. That's also not bad at all.
I don't know why Carvana's down. They did a pretty decent double beat here. So maybe there's something else in the report. Sure,
so
we'll
Carvana,
see here.
Yeah, you already mentioned it. Double beat, right?
Yep.
Yeah. Yeah, that is. We got to see what's going on with that. Fortinet, 20% beat, 90 cents versus 75 cents EPS, 2 billion versus 1.89 billion on revenue. Revenue's up 26%, EPS is up 41%. Fortinet cybersecurity theme, market's really loving that. Starbucks, they beat EPS by 31%, 85 cents versus 65 cents expected. Revenue 9.3 versus 9.1 billion.
Carvana down 20.
Dude, what the hell did they say?
Oh my gosh.
What did they say?
Is there maybe guidance? Do they guide?
Yeah, I don't think many of us follow this company, so
maybe people aren't buying cars as much.
Down 21%.
Well, if AI wins, who needs a car, right? Wait,
that's like what Elon was talking about in his last interview. He was like, "Hey, by 2036, we're not going to need money."
Yeah, so if you're down a lot of money today, just remember, we don't really need it.
You don't even need it.
Tanner, you can share my screen.
Yeah, sure.
Compare this one. It's $4.74 adjusted for the quarter on EPS. That does exclude an impact from OpenAI. There's also a $3.2 billion gain related to Anthropic. So the EPS number a bit messier. We're not going to comp, but $4.74 there. Azure growth better than expected. That was 43% growth on Azure revenue, better than the 40% Street was expecting. Want to read you a quote from CEO Satya Nadella. He says Azure revenue surpassed $100 billion for the first time. Also mentions Microsoft 365 Copilot seats surpassing 30 million paid seats. That's a key number. He says it reflects some confidence in customers placing us to power their AI transformation. And that is
that's software revenue. Like Microsoft really needed to prove that enterprises weren't canceling seats. And it looks like they did that, even if it's slightly, but that might be why the stock's actually up 3% right now.
Latest, guys. I will keep digging through this for some more.
Okay. You got the Robinhood thing? I was just about to.
Oh, you got the.
Yeah, I got everything. So let's.
Okay. Yeah.
Good.
Okay, so let's get in the numbers. Revenue is up 32%, 1.3 billion. Net deposits record 22 billion. Gold subs almost 5 million, 4.8 million. Robinhood now has 13 business lines that have reached 100 million or more in revenues. Vlad, whether it's Robinhood Chain, Robinhood Ventures, or Trump accounts, our product velocity is focused on one goal: making everyone an owner. Broad ownership is essential to a free and stable and prosperous society. CFO Shiv says the business is firing on all cylinders. We delivered record revenues and drove new highs across equity, options, event contract volumes as we continue to win market share. Our product velocity continues to deliver new products for customers and drive a more diversified business, with Robinhood Legend and the credit card business joining our growing roster of now 13 different business lines that have reached 100 million plus in annualized revenues.
Can I switch it over to the presentation?
Yeah, go ahead.
We added 940,000 new members with a 17% attach rate on Robinhood Gold.
I think that's the highest we've done sequentially.
Yes, but it's through acquisition as well.
That's fair.
Yeah. I'm sure there will be a lot of prediction market ads as well, and hopefully they break that out. Dude, actually, you know what? They did break it out last quarter. They said it was 300,000 was supposed to be from acquisition. I think it was WonderFi. So we're looking at around 640,000 new ads, funded customers that were probably coming in organically.
Very nice. Yeah. SpaceX effect, I guess, in part.
Yeah.
And international adoption. That's good. Yeah.
Event contracts.
I would love to know how many are international. I might note that if we get a chance to ask a question.
They bought back 4.4 million shares at 94. So they spent about $414 million on buying back stock. ARPU is now $187 per user. That's up 24% year over year. OpEx, they decreased their guidance on OpEx.
Wow.
That's also probably why the street's not really hurting the stock after hours. They're actually going to spend less money versus more.
Oh, you know what? No, this is not including Trump accounts, is it? No, it can't. That was millions.
Yeah, no, it's not.
Yeah. That was a big part of the OpEx, wasn't it? Was building out Trump accounts?
Yeah, 100 million towards that.
Yeah.
Okay.
Yeah, I'm not sure why that decreased, but we'll probably find out. Margin, 21.6 billion. That's a record. Retirement accounts, 34 billion. That's a record. Equity volumes, 956 billion, almost $1 trillion. That's up 85% year over year. Options, 740 million. Crypto, 40 billion. Event contracts are up 1,000% year over year, 13.6 billion as Microsoft starts to go red. Now, Robinhood's actually moving 3%. Robinhood in this macro where Microsoft and Meta are getting hit, going up, it speaks to the tenacity of these results being resilient.
The sheer tenacity.
In the middle of crypto winter. Doesn't matter.
Crypto winter, dude. I mean, 22 billion in net deposit, dude. To get $22 billion in 90 days to leave bank accounts and JP Morgan and Bank of America to go to Robinhood is unbelievable.
The Robinhood retirement asset under custody on page 8. That's a huge leap.
Which one? Sorry, is it this?
Yes, yeah, that second figure. Boy.
Yeah. Oh, yeah. Yeah, it looked like it was slowing down. I wonder what the big pop was there.
It's certainly not portfolio performance. Maybe there's a lot of people holding Micron or something at quarter 2.
No, I think it might have been portfolio performance. End of June. We have a way of doing. They show this off. Wait, let's see. Changes in total platform assets, net market gains, 39 million. It was a big quarter for gains.
5% on Hoodie after hours.
Sorry, I said million. $39 billion were made in Robinhood accounts. Yeah, stock is up 4.5%.
By the way, Microsoft did about 20 billion in positive free cash flow this quarter, so they are not free cash flow negative yet.
Wild. And Azure picked up, right?
Azure picked up 43%. It was like 39 point something last time. 100 billion. Nadella says we are advancing the frontier on the cost to outcome curve, ensuring every customer can turn tokens into business results. This year, Azure revenue surpassed 100 billion for the first time. Copilot reached over 30 million paid seats, reflecting the confidence customers are placing in us to power their AI transformation.
What about buybacks? Are they still doing buybacks?
They bought 10 billion. Yeah, 10 billion worth of stock and dividends.
Wow.
Dude, if Microsoft keeps up the buybacks, doesn't go crazy with the CapEx, and keeps the software business growing, it's already down 25%. Like, does it really need to go back to the 350s?
Yeah, well, mostly every chip that they have is going towards customer allocation, right? You don't have what Google or Meta is trying to do, where you're also trying to train your own frontier models. And so, Google kind of has to buy 2 chips for every customer that wants one, because they want them themselves for large training clusters. So I don't know. Maybe the unit economics right now for Microsoft just fits.
Agreed. Tanner, let's show Qualcomm and then we'll get back into Microsoft here.
Revenue beat at $9.95 billion, with both the chip and licensing units topping estimates. Auto posted a record quarter, but they are calling a bottom, specifically in China smartphones for Q3. The guide, though, a little light, midpoint earnings of $2.15 below the street. The CEO and CFO that I spoke to just earlier said the smartphone mix is shifting. Qualcomm leans more premium, and that's really helped them in previous quarters, but they're starting to see buyers trade down within premium, driven by higher memory costs. And because of that, they're hiking prices double digits to offset it on September 1st, though they say gross margins still dip just below.
That's not good for inflation. I mean, it's the weird nuance of these memory prices going crazy, which are forcing chip makers in the consumer electronics space to put the cost on consumers.
Their usual range next quarter. We'll probably get those numbers on the call. They also now see Apple revenue falling faster next quarter. That's Q4, more than the 20% they had guided before. So that is a concern. I asked the CFO about it, and he said he's happy. It frees up supply to use elsewhere. Lastly, the company is diversifying away from smartphones and reiterated that non-handset chip sales should jump from 24% to more than 60% next fiscal year, becoming the majority of Qualcomm's chip business for the first time. So you can see shares, though, reacting negatively, down 5%. Now for ARM, that's a different company. Beat across the board. The chip designer earned 45 cents adjusted. Revenue came in at 1.29 billion, a record for a first quarter, driven by both licensing and royalties. The guidance slightly higher, sees current quarter revenues of 1.38 billion on EPS of 47 cents, which was just 4 cents higher than estimates. Big driver is ARM's new AGI CPU, so an actual chip, a real chip. CEO saying demand has exceeded expectations and that confidence in beating its $1 billion CPU target has climbed just over the last 90 days as the company works to lock down more manufacturing capacity, which means it's preparing for more demand. I know Sibo is ringing the bell, so I'll let you guys go, but you can see shares down slightly, guys.
Let me do a quick update on prices right here. Fortinet, like they said, up 8.9%. Lam Research up 6.2%. Fair Isaac Corporation actually down 6.8% as well. Wow. Did we get FICO's numbers?
No, I didn't see them. I'll try to find them.
Starbucks up 8%. Chipotle up 6%. Carvana now down only 14.9%. Qualcomm down 2.7%. Microsoft, one of the more green days today, yet only up 1.8%. Meta down 5%. Robinhood flat.
FICO beat EPS by 3%, 12.18 versus 11.78. They missed on revenue by 0.38%. Revenue's up 26% year over year. It seems like obviously the market's reacting more to Microsoft and Meta. So we talked to SPY's down after hours again, 0.23%. We talked a bit about Microsoft. Headline numbers look fine. Guys, we get CapEx for Microsoft at the end of the call. That happened last time as well. So we don't have any updates on CapEx. I mean, I feel like Meta is still a little bit of a mystery. Why did they miss on EPS? Was that a tax thing? Because that's confusing for them to miss by 15%.
Let's see if they have the report out. If you're okay with going through it, we got a little bit of time before this call. What time do you leave, Amit?
In like 15 minutes.
Okay.
Operating cash flow was $31.9 billion. Wow. Free cash flow for Meta was $800 million this quarter, which obviously is a lot lower than what it usually. It's signaling it's going to be negative pretty soon.
It's actually shocking whenever you put it into perspective how well Microsoft did from a free cash flow perspective while doing massive amounts of buybacks.
I don't get how Microsoft did $20 billion in free cash flow. I don't get it because Meta would have done $32 billion in free cash flow if they didn't spend $31.1 billion on CapEx. So how did Microsoft get?
Well, what's Microsoft's CapEx this quarter?
I'm still trying to find that. By the way, RPO for Microsoft, $678 billion. A lot of that still is OpenAI, but it is up 84% year over year. CapEx was $41 billion.
I have a different number than you.
You have 35?
Yeah.
CapEx including leases is 41.
Okay.
I don't know if the leases tend to be included or not, but
yeah, I've got 35.8. But still, that's the highest that they've ever shown. Huge jump up here.
How the hell did they get 20 billion of free cash flow left? Or is that number wrong? But I don't think that number's wrong.
No, I have that same number. What's their?
Oh, well, no. They made 3.2 billion on Anthropic, but I think that's still unrealized.
Yeah, that's not cash flow.
That's not cash flow, right? Meta's operating margin is down to 31 from 43.
They did $55 billion in cash from operating activities.
Oh, so they spent 30 on CapEx? Okay, so you're left with around 20.
Wait. They did $55 billion on how much revenue? On $90 billion, they did $55 billion in cash from operating activities. And this stock is flat, up 2%?
That's crazy. Good report by Microsoft.
The margin there is insane.
The problem is Microsoft's levered to OpenAI.
You kind of sounded like Trump there, so I'm going to need you to say it again. The problem is, just say how you were going to say it originally. Go.
Microsoft has a big OpenAI stake, dude, and the market is really getting sour on the private AI labs right now. So maybe, I don't know how else you explain Oracle getting hit this badly. Maybe it's just that. But those numbers are unbelievable, dude. Unfreaking believable.
It is wild.
Well, I do hear that they're going to vibe code Teams and Microsoft Word now, so that nobody needs software.
Vibe code some Windows.
Yeah.
Guys, what are we thinking in the chat? Does it make sense? This is weird. This is similar to Google. The restaurants are having the best earnings. Chipotle double beat, Starbucks double beat. Micron's down 11.
Not in after hours. No way.
It's down another 2 after hours. Dude, is this going to lose 700?
725. The Qs are down another 0.25% point here.
So if Micron goes down to 300, what do you guys do? Just all Micron?
I might have to. I was even looking at CoreWeave and I'm like, what do I start selling?
Yeah, I've sold some things that I didn't want to sell just to buy more CoreWeave at higher levels than we are right now. And it's like,
yeah, I might even have to dip into a little bit of NVIDIA because the price has actually stayed pretty stable versus a lot of other names that have trimmed down 60%. It's just, I'll be increasing my risk. And no, it's not that there can't be worse to come. There absolutely can be.
If Robinhood gets a bid off of this, and it continues, it's a great report, and it continues, if we see it go back into the hundreds and the rest of the market keeps going the opposite way, It's my number one holding. I have not sold any Robinhood shares, I think, ever. I've sold Leaps. I might trim some, even though it's like a great business. I don't want to do it, but man, number one position looming large there. So,
I mean, Hood being flat on this to slightly down is you got. I mean, if the semi names are falling another 2-3% after hours, and Hood, never mind, Hood goes down 3%.
Oh.
Yeah, the problem with Hood is the semi trade is what's led to all the trading volumes, and so if that dies out, the trading volumes too. I mean, like Robinhood doesn't have record quarter without people buying Micron calls.
Dude, honestly, you can paint such a bearish story. Like the stock market's crap, crypto's crap. There's no World Cup anymore. Sell it all.
But money's not going to matter in 10 years, dude. Like, we have to remember that. Elon told us we don't really need the money.
Well, this is nice. The majority of the remaining gold deposit boosts earned by customers prior to the end of the program, this was last year, we paid out over the next 5 months. So that'll no longer be a overhang either.
Yeah, this is it's not even Robinhood's fault right here, guys. But if semis are going to dip like this, now granted, I think this is some after hours shenanigans happening right now. I don't really think there's I mean, it's the forced selling from the forced selling after FOMC. So we actually saw this last night with Micron, and then it fully recovered, into the pre-market. Obviously had a bad day, but a lot of this seems to be compounding on itself. Where's Nebius after hours? We are at 140. See, that's actually a little green, which usually follows Micron, so that's going the opposite.
Yeah.
Meta's still down 7, dude.
But Meta should be red right now.
Yeah.
It should.
Why?
Well, growth slowed. 28% growth is not what people want to see. They want to see 30% for the full year. I'm not saying that the company is not oversold, but if you're going to give them this multiple and then you get worse than expected earnings, and they did raise CapEx. Well, they didn't raise the top line. The midpoint of guidance went up. I could be okay if I saw a little bit of red in Meta. That stuff makes sense to me. The part that doesn't make sense is whenever Robinhood's down 4% and Microsoft, I mean, it's not red right now, but like if this turns red, which could absolutely happen, it should be way up more than up 2% here. Micron being down another 2.3%. We're going to get close to 3 times forward PEs again here.
Two things that are kind of smaller in the Robinhood report that are interesting. They said the Trump accounts, that they are on path to get the number of Trump account signups to tens of millions. That's plural tens of millions. And also that they're now serving over 1 million customers outside the US.
But just what does it mean for them? What percentage of their revenue is showing up from Trump accounts? How do I even gauge it as an investor?
Yeah, it's so they're probably it's a margin plus contract, so they're making a very small margin on that. I think that the interesting way that they can leverage that is the question that I asked Vlad last time on if they're getting interest from other states, other governments as well, and it was pretty clear that they were. And so those could be like, this is one of those line items where like brokerage is as a service, I guess we could call it that. They might be the one that ends up building a lot of this out. So once you do it once, I would imagine the next iterations are probably not as complicated.
You can share my screen. We'll get a little update on Meta right here.
Costs and expenses, which was a 55% year-over-year increase, includes $2.4 billion of charges related to legal proceedings and $1.18 billion of severance expenses in connection to the May 2026 headcount reduction. So just flagging those two factors there. As we look ahead to the call, which starts in about 10 minutes, we are expecting Mark Zuckerberg to share more on the enterprise business. He did say in the quote in the release here that AI is accelerating the core business, powering our next generation of products, and opening the door to entirely new enterprise opportunities. So looking to hear more from that about him shortly. Back over to you, Melissa.
Hold on. Do we want to listen to that if it starts at 4:30 for 30 minutes or something? What do you think?
It's up to you guys. I'm going to leave in like 5 minutes. Yeah, I mean, you can.
I would be interested to listen to Mark rather than myself, to be honest.
You guys want to hear it? Put in the chat if we want to hear 30 minutes of meta, but then it's going to go to Hood at 5.
It's going to go to Hood at 5 regardless. So we're not going to hear Q&A. We're going to hear Mark talk about some of the things that they've been working on.
I don't know whether to root for Meta because I have it in the stock draft, or root against it because I don't like it.
I can't believe you picked it for the draft. I forgot about
I was
that.
surprised. Roy, I was like, Roy hates meta. I don't know how he picked that. But
On paper, I can own it, but like it's when you see like, okay, it's a
like when I saw
stupidly
Roy
obvious
buy
opportunity.
it, I was like, okay, it's cheap. If Roy was ready to pick it in his stock draft.
Roy's selling his soul to win the draft. Okay. We should have the Mark or the meta call here. The Mark call. We're going to be listening to it for 30 minutes, then transitioning over to the Robinhood call, where hopefully we see our friend Amit here in the audience. Hopefully get to ask a question as well. That should be quite fun. Do you have any idea what you're going to ask?
I was going to ask about Robinhood chain, but usually I think of a question on the spot. So, but yeah, Robinhood chain. I'm really curious where they see the future of that going. It was a great quarter. We got a lot to analyze tomorrow. It was a great quarter, but unfortunately, Meta and Microsoft, broader market, FOMC, it's going to be tough if the semis go down in junction with Hood having a good quarter. So can't complain about the quarter.
Currently right now for us.
No, I'm not going to do it again. I'm not going to do it again.
I mean,
maybe I will. I don't know.
Maybe.
I don't know.
Okay, let's switch over. The operators talking. Amit, see you later, brother.
See you guys.
Okay, enjoy.
Into a private mode. Amy, waiting on your begin. Okay, so we are going to go live momentarily. There will.
Okay, I guess they're not live just yet, and I just kicked Amit out of here.
That'll teach him.
Overall, though, I mean, what is the most surprising earnings call for you? Like Robinhood being down almost 4% is mind-blowing to me.
I mean, they're really good earnings, and the stock can do whatever. Like right now, the macro is just rough on like after hours. It's a lot. Other names are down even more, and they've not reported earnings. So
Good afternoon.
Okay,
My name is
call
Chris.
starting.
I would like to welcome everyone to Meta's second quarter 2026 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question, please press star, then the number 1 on your telephone keypad. To withdraw your question, again, press star 1. We ask that you limit yourself to 1 question, and this call will be recorded. Thank you very much. Chad Heaton, Meta's Vice President of Finance, you may begin.
Thank you. Good afternoon and welcome to Meta Platforms' second quarter 2026 earnings conference call. Joining me today to discuss our results are Mark Zuckerberg, CEO, and Susan Li, CFO. Our remarks today will include forward-looking statements, which are based on assumptions as of today. Actual results may differ materially as a result of various factors, including those set forth in today's earnings press release and in our quarterly report on Form 10-Q filed with the SEC. We undertake no obligation to update any forward-looking statement. During this call, we will present both GAAP and certain non-GAAP financial measures. A reconciliation of GAAP to non-GAAP measures is included in today's earnings press release. The earnings press release and an accompanying investor presentation are available on our website at investor.atmeta.com. And now I'd like to turn the call over to Mark.
All right. Hey, everyone. Thanks for joining today. We had a strong quarter for our community and business with 3.6 billion people using at least one of our apps each day. We reached several milestones. Instagram reached 2 billion daily actives. Threads crossed 500 million monthly actives, making it the fastest growing conversation app ever. Facebook has reached more than 2 billion daily actives for a while now. WhatsApp just hit an all-time messaging record peaking at 30 million messages sent per second during the World Cup final. And also, Kunal Shah just joined as our new head of WhatsApp. He built one of India's most important payment companies and will be a great addition to the team. We also shipped some strong new models from Meta Superintelligence Labs and released new glasses. Overall, the scale and reach of our community across our apps is pretty remarkable, and it gives us a strong platform for delivering new innovations to billions of people. The opportunity in front of us is massive. First, we are now at a point where our investments in AI are accelerating every major part of our core business. They're improving the experience for people using our apps, driving better performance for advertisers, and helping our teams build new experiences and ship faster. Second, we are developing new personal agents that will be the foundation for our next wave of products and revenue lines in the months and years ahead. And third, we see a large enterprise opportunity to sell to businesses, including APIs, business agents, potentially selling compute directly, and other services that we're building for large customers. And I want to spend some time today laying out exactly how our investments are delivering results today and the opportunities that we see over time. For accelerating our core business, we are seeing strong and promising results in several areas. In Instagram and Facebook, I'm very optimistic about our work to integrate large language models into our recommendation systems. LLMs add a first principles understanding of what the content is about and why it is compelling, as well as a deeper understanding of what people are interested in and what their goals are when they're using our apps. So this means that we can show more relevant and engaging content that better reflects people's goals and interests. Our new Muse image and Muse video models will also dramatically expand the universe of content that people can discover across our platforms. There are already two large sets of content to draw from, first from your friends and the people you follow, and second from creators that you don't follow. But now there's going to be a whole new and nearly infinite universe of personalized content. This is going to make our services a lot more useful and engaging for people. For ads, we are using LLMs to improve how our systems predict and rank the ads that we show. We've expanded the context that we can take into account around a person's organic and ads activity to determine an ad's relevance, driving significant increases in relevance and conversions on both Facebook and Instagram. And on a dollar basis, our ads business is reporting faster year-over-year revenue growth than any other company's reported ad business. So these AI investments are paying off. We are also seeing a lot of demand for our new AI-powered creative tools. 9 million small businesses on our platforms are now using at least one of our AI ad creative tools, and we're rolling out new end-to-end creative solutions that help advertisers translate performance data into their creative decisions. Muse Image is going to supercharge this. The model can analyze images, improve its own work, and produce better ad variations based on advertiser input. We're getting great feedback on this so far. We also just launched Meta One, a new subscription offering that provides more tools and AI features across our apps. As demand grows, we're going to offer a variety of different tiers and pricing options there as well. And I'm also excited about how AI is helping our teams speed up product development. Earlier this year, we shipped Instagram Instants. We also just launched Forum, a standalone groups app, and Seller, a standalone marketplace app. And I expect it to become a lot easier to ship new apps. So we are planning to build out more ideas and use our recommendation systems to scale them to the people who will find them interesting, as we've done with Threads. It's been a little more than a year since we launched Meta Superintelligence Labs, and our trajectory is strong. In the last month, we shipped Muse Spark 1.1 and Muse Image. Since we rebuilt Meta AI and integrated Muse Spark, we have seen a 60% increase in the number of people interacting with the assistant each day, and that continues to grow quickly week over week. Muse Spark 1.1 is a strong agentic encoding model that is very efficient and excels at computer use, tool use, and multimodal understanding. It's available through our new public API, and we are ramping up distribution through partner channels and more coding agents over the coming weeks. We are also building out features to make it easier for enterprises to adopt Muse Spark, and that is an area that we expect to continue focusing on. One reason that we are so focused on making MuseSpark great at agentic capabilities is that we think that there's a very big opportunity to ship a few types of agents that are aligned with our mission and business. The first, work 24/7 on your behalf to help you achieve your goals and improve your life, your health, your relationships, your finances, whatever you want. The first domain that agents have really taken off in is coding, but engineers are more technical and willing to spend time making those agents work. So to build great personal agents, this needs to be a great consumer product that just works out of the box and is easy enough for billions of people to adopt and use. I'm very excited about this, and we're going to have more to share soon. As we move towards a future where we're all interacting with multiple agents, I think that WhatsApp and our other messaging surfaces are going to become increasingly important. WhatsApp is already the leading surface where people engage with Meta AI. And as we build out a platform for more agents across our messaging apps, we're going to innovate on how to deliver a private and secure AI experience. We launched incognito mode this quarter on WhatsApp and the Meta AI app, allowing people to have private conversations with their assistant that even Meta can't see. We're planning to make strong privacy and security a fundamental part of the agents that we're building as well. I'm also very excited about our progress with business agents. We made Meta business agents available globally this quarter on WhatsApp and Messenger, and there are already more than 1 million businesses using them to talk to their customers or complete sales every week. We're rolling business agents out on Instagram now too. One interesting thing about having an agent talk to your customers every day is that it learns over time and can bring all of those insights back to you. So we're building more agentic capabilities to summarize all of these conversations, digest what happened overnight, and surface what customers are asking for. And soon it'll go further, including suggesting ways to grow your business, giving you competitive intelligence and real-time insights into what's working and what's not. And over time, we'd like to build this into a business-in-a-box service that can help you start and run a whole business using Meta's platforms. In terms of how we will monetize these, we have a mix of subscriptions, volume-based pricing, and I expect that we're going to continue to evolve more of these products to be like our ad systems, where businesses only pay us when we achieve results for them. Over time, that will let us run an efficient auction over our compute, similar to how we do that for advertisers today. As AI usage in our products and businesses continues to ramp, we continue to invest aggressively in infrastructure to meet the demand. Yesterday, as part of our Meta Compute effort, we announced a new strategic venture with BlackRock to develop a new 1 gigawatt data center in El Paso, Texas. Overall, we expect that a significant portion of our compute is going to go towards training our models, growing our core business, and delivering personal agents and new products. But we also expect to grow a large business serving large customers as well. We've built our API, we're rolling out business agents, we're getting a lot of offers for compute at a significant premium over what we paid for it, and we have more coding and productivity tools on our roadmap as well. And we'll have more to share on all of this soon. As we get closer to personal superintelligence, we are also going to need hardware that allows you to seamlessly interact with it. Glasses are the ideal form factor since they can be with you throughout the day and they can assist you without pulling you away from the moment. Our glasses remain one of the fastest growing consumer electronics of all time, and we continue adding to the lineup. We just released our own line of Meta glasses in collaboration with EssilorLuxottica, including a style that we designed with Kylie Jenner. They're the first glasses to ship with MuseSpark out of the box so that they can understand what you're seeing and give even more helpful answers. Early sales have been strong, exceeding our expectations, and we're going to have more to share on our glasses lineup at this year's Connect conference on September 23rd, so I encourage you to tune in then. Before I wrap, I want to mention that I just published an op-ed about why I'm so optimistic that we are building a positive future for everyone. At Meta, we have always built technology to put power in people's hands so that they can connect with the people they care about and shape the world in the ways that they want. It's why we've always focused on making our products affordable and accessible for everyone, and it's a strategy that has served both our community and our business well. As we enter this next chapter, that same philosophy is guiding how we approach developing AI. We're the only major company building AI with the primary goal of putting superintelligence directly into people's hands. Rather than centralizing superintelligence, we are focused on distributing it widely and giving everyone the ability to direct it towards what matters to them. That's the way that society has always made progress. I think that these are the right values for building a positive AI future. And if we help build this, then I think that we will continue to build a very strong business as well. So that's everything I wanted to cover up front today. AI is improving our core business. It's making our apps more relevant and delivering better results for businesses. We're starting to deliver more novel products, and we'll have a lot more there soon as well. And we are investing aggressively because the potential is huge, and we know that there are many ways to deliver value here. As always, I'm grateful to all of you for being on this journey with us. And now, here's Susan.
Thanks, Mark, and good afternoon, everyone. Let's begin with our segment results. All comparisons are on a year-over-year basis, unless otherwise noted. Q2 total Family of Apps revenue was $60.4 billion, up 28% year-over-year. Q2 Family of Apps ad revenue was $59.4 billion, up 27%, or 26% on a constant currency basis. In Q2, the total number of ad impressions served across our services increased 14%. Impression growth was healthy across all regions, driven by growth in engagement and users, as well as ad load optimizations. The global average price per ad increased 12% year-over-year, driven by ad performance gains, improvements in macro conditions relative to Q2 of last year, and currency tailwinds. This was partially offset by strong impression growth, particularly from lower monetizing surfaces and regions. For the first time, quarterly Family of Apps other revenue reached $1 billion and grew 73% year-over-year, driven primarily by WhatsApp paid messaging and subscriptions revenue. Within our Reality Labs segment, Q2 revenue was $431 million, up 16% year-over-year due to strong growth in AI glasses revenue, partially offset by lower Quest headset sales. Moving now to our consolidated results. Q2 total revenue was $60.8 billion, up 28% or 27% on a constant currency basis. Q2 total expenses were $42 billion, up 55% compared to last year, and included $2.4 billion in charges related to legal proceedings and $1.2 billion in severance expenses in connection with the May 2026 headcount reduction. Year-over-year growth was primarily driven by increases in employee compensation, infrastructure costs, legal-related costs, and third-party AI token costs. Excluding the previously mentioned severance expense, growth in employee compensation was driven by technical hires we've added over the past year, particularly AI talent. The growth in infrastructure costs was driven by higher depreciation, data center operating costs, and third-party cloud spend. We ended Q2 with over 75,000 employees, down 3% from Q1. This total includes approximately 8,000 employees impacted by the May 2026 headcount reduction. We expect the majority of impacted employees will no longer be captured in our headcount by the end of Q3 2026. Second quarter GAAP operating income was $18.8 billion, representing an 8% decline year-over-year and a 31% operating margin. Excluding the Q2 legal charges and severance expenses, our second quarter operating income would have increased 9% year-over-year. Our tax rate for the quarter was 16%. Net income was $15.8 billion, or $6.18 per share. Capital expenditures, including principal payments on finance leases, were $31.1 billion, driven by investments in servers, data centers, and network infrastructure. Free cash flow was $784 million. We ended the quarter with $90.3 billion in cash and marketable securities and $83.7 billion in debt. Turning now to the business performance. There are two primary factors that drive our revenue performance: our ability to deliver engaging experiences for our community and our effectiveness at monetizing that engagement over time. On the first, we continue to see significant gains from our content recommendation initiatives. On Instagram, global time spent this quarter grew double digits year over year this quarter, largely driven by improvements to our feed and Reels recommendations. On Facebook, video time spent increased 9% globally year over year and over 10% within the US and Canada, where it was driven by ranking improvements. We are finding that LLMs are increasingly capable of delivering ranking and recommendations gains. First, they make our existing systems smarter by understanding what the content is actually about and generating better training data. Second, LLM-powered agents are also helping with engineering development by evaluating content quality, detecting trends, and testing ranking changes. Earlier this year, we reached a milestone of every public Reels and feed post on Instagram being automatically processed through an LLM and analyzed across dimensions from topics to tone, and we're working towards including more surfaces on Facebook as well. These signals can then be passed to downstream applications across ranking, recommendations, and content policy enforcement, which is a key building block toward greater personalization. This quarter, we also began using our Muse family of models to conduct content understanding across signals like video topic classification and summarization, and we've seen positive early results. Finally, our recommendations are also becoming more personalized, surfacing more fresh content while giving people more direct control over what they see. On Reels, we shipped our largest single release ranking improvement to date, combining faster inference with a new architecture that draws on deeper user history to improve predictions. This drove a 15 basis point increase in sessions on Instagram, with particular strength in reshares and time spent, which are both strong indicators of better content to user matching. We are now bringing this to feed where early results look comparable. We are also getting new content to people more quickly. Investments we've made in more real-time infrastructure and modeling improvements on new videos are allowing our largest ranking models to now identify high-quality new reels at creation. On Instagram feed, over half of all recommended content is now less than 1 day old, more than double from a year ago. We're also giving people more direct control of the content they see. Today, Instagram users can visit the Your Algo page, which lets users write natural language prompts to tune their recommendations. Similarly, on Facebook, we launched Shape Your Feed. Early results show over 80% retention among users who engage with it. Looking forward, we're executing on our longer-term efforts to develop the next generation of our recommendation systems. This includes building foundation models that are designed to power organic content and ads recommendations simultaneously, as well as developing LLM native recommender systems. We hit our first research milestone this half by continuously pre-training a large-scale model with recommendations data and observing healthy scaling laws in the process. We're encouraged by this milestone and expect continued progress in the second half of the year. Turning to the second driver of our revenue performance, increasing monetization efficiency. The first part of this work is optimizing the level of ads within organic engagement. Here, we continue to enhance our systems to show ads at the optimal time and location. In Q2, we also expanded availability of ads on our newer surfaces, including completing our global ads expansion on Threads. On WhatsApp, we have introduced support for more types of ad destinations and advertiser performance goals in status, and continue on track toward our global rollout. Moving to the second part of increasing monetization efficiency, improving performance for the businesses who use our services. Within our ad systems, we're delivering performance gains as we deploy more complex and predictive models. This quarter, we introduced Meta Generative Recommender, a paradigm shift in how our ad system works. Rather than scoring every possible ad individually, we are now using LLMs to reason about ad content and user preferences together and predict the best ad for each person. This makes our ad match.
I saw a bunch of comments saying they're all dying of boredom and a bunch of people are leaving. So I don't think everyone's on board the Meta train here.
I'm certainly kind of tuning it out. So.
No, all good. I'll listen to it another time. That said, we have Robinhood earnings coming on at in about 7 minutes. It's usually a longer call. They have a ton of people either in person, Say Technologies, over Zoom. Roy and I will also have the opportunity to ask a question. I'm not even sure I will this time unless I see a comment in chat that might grip me. But most times I'm honestly looking for a question to say to Robinhood rather than actually needing it answered by them. So, all right. Overall, going into Robinhood's call that we're about to see, they're down 3.3%. The markets in general are having a major sell-off. Why can't I bring this up? What the heck? Wait, something's going on. Okay, there we go. They're down 3%. Microsoft's up 3%. Meta seeing a little bit more of a sell-off, now down 7% again. Fair Isaac Corporation down 11.8. Fortinet up 12.5. Roy, what's caught your attention right now?
Honestly, it's not even earnings. It's an interesting thing on Figure Technologies, which hasn't reported yet. But yeah, they had an announcement with the CEO, Mike Cagney, or he's the president, excuse me. And on chain, boy, like there's been some massive batches of loans that were sold in a fairly new product category with a new partner. So, but yeah, I know most people don't really care about Figure right now and with rates and everything. But you covered going back to your coverage. You've been on live forever. Did the FOMC event surprise you at all in any way?
No. I mean, there was a 33% chance of a rate hike. It was only Citadel. Every other bank, financial institution said that we were going to stay steady. That's where I would have put my money. Now, I'm surprised by the market's reaction, but the 30-year yields are at something like 18-year highs or something. Pretty wild.
That's certainly a factor there. I would have guessed just because we were at 33%, there was some uncertainty going into this, barring some very hawkish comments, despite the lack of raise, which wasn't really what we got, that markets would actually really like it and be quite green. And that's why I'm not a day trader.
Really quick, for people asking about Amit was with us. He is going to be at the Robinhood event. So he's likely to ask a question there in person. So we'll see him on the screen. He was streaming with us a little bit ago, but obviously he needs to work his way from where he was recording to he's probably getting seated right now for the call. But yeah. So overall, it has been a long day. I've been streaming practically since 6:55 a.m. But I mean, it's never a dull moment in the midst of earnings season and FOMCs and a lot of macro data that we're going to see in the rest of the week as well.
For sure.
Okay. Let me make sure that I got Robinhood's call up. Are you shocked by any of the AI spend commentary? I even checked X while that call was going on, and there's been a lot of people voicing their concern for the amount of spend that Meta is still doing and just saying that, hey, why don't you just make a comment to say that CapEx is going to peak out in 2027? And I think the reason why you're not seeing those types of comments is because they're not entirely sure that that is going to be the case.
Yeah.
You know, Micron is booked out for years. For years. That's going to be a telltale sign of what, you know, AMD looks like, what NVIDIA looks like, what a lot of the photonics names look like, because you're not buying memory in a bubble, right? It's the entire chain. The surprising thing is how much free cash flow Microsoft just put up while being one of the largest buyers in the world.
Yeah, I was going to say Microsoft, the free cash flow really surprises me. And then Meta not raising the top line of the CapEx, given what seemed like pretty big ambitions with the data center play. This at least indicates to me that no, they're going to build out their own capacity. And if they're surplus, then they're prepared to sell it. I think we'll have to see, what they say in their earnings call. I'm sure that they'll get asked about it.
Okay.
Is that the way that you're reading that top line increase or lack of increase
For Meta?
Mm-hmm.
Honestly, I don't know what it is. I haven't looked too deeply into the numbers. I think that they'll likely be fine. The interesting thing that I think is funny about Meta is that they really don't have any diversification in their revenue. It's just advertisements. But in the future, we're likely to see massive amounts of either Meta cloud compute or whatever they're going to name their new cloud business, like selling GPUs that are in excess, similar to what SpaceX did, or MetaMuse Spark APIs really start to take off because they might have a frontier model. People don't know this, or it's not often talked about, but the level of compute that Meta has is on par with the levels and future outlook of what OpenAI and Anthropic have. There's really three things that you need to make a frontier model. It's great talent, great data, and great compute. And Meta has all three. So MetaMuse could be unbelievably huge. Their cloud space could be really big. I don't know which one needs to pop off, but a nice new catalyst, I think, would be a good sign for the stock.
It's starting.
Okay, ladies and gentlemen, enjoy the call. You're on Zoom, Roy. It hasn't started in the...
Slightly ahead. Yeah, it's starting very soon.
Okay.
Whether you're tuning into the live stream or here with us in person.
It's a little quiet. One sec.
With us today are...
I can turn it up.
Opening remarks and then open the call to Q&A. During the Q&A portion of the call, we will answer questions from the audience, which include...
Really quick, it sounds a little bit quiet right now. Really hoping, I already have it at 150%. Really hoping that Vlad's mic and Shiv's mic is a little bit different. In case it does come on a little loud, I apologize for blowing out your ears. So for the earbud holders, just be a little bit safe.
we continue to monitor are described in the press release we issued today, the earnings presentation, and our SEC filings, all of which can be found at investors.robinhood.com. Today's discussion will also include non-GAAP financial measures. Reconciliations to the GAAP measures we consider most directly comparable can be found in the earnings presentation. With that, please welcome Vlad and Shiv.
I just have to mute that song really quick. Gosh. They love the theatrics. Okay, we'll jump in. I'm so sorry. I can't play the music.
Wow. Thank you guys for joining. Thanks for the warm welcome. And it's awesome to see a packed house in here. We're back again at NASDAQ in New York City, taking a big bite out of the Big Apple with Shiv here and Chris. Largest audience yet for an earnings event. I remember, Shiv, last year it was when we did the first event with analysts in person, and we were worried, would anyone come? And not too many people did, but the people that did had a lot of fun, and now I'm glad to see the word has spread. So it's really great to see shareholders, analysts, buy side and sell side, content creators in the audience here. It's been about 5 years, actually I think exactly 5 years since we rang the bell at the NASDAQ. And in that time, we've really accomplished significant growth, and we've delivered for our customers. In that time period, since IPO, total platform assets have quadrupled, and adjusted EBITDA has more than 8x'd. But one thing hasn't changed: why we exist. Robinhood exists to make everyone an owner. And I think that's a unique vision. I don't think a lot of companies are going after it. It's a powerful vision, not just for each individual customer, but I think also for society at large. I think that a society without ownership, broadly distributed, is very fragile. And we think broad ownership is essential to a free, stable, and prosperous society. Because when more people have stake in the outcome, more skin in the game, they're literally invested in the outcome. And we want more people to be invested in the companies of our great country. And I think we've just scratched the surface for what we can do there. To achieve our aspirations of making everyone an owner, we're focused on three things. Number one, being number one in active traders, which will allow customers to own any tradable asset. Number two is being the leader in wallet share for the next generation, bringing ownership to the entire family. So the whole family and really lifelong ownership. And then number three, building the leading global financial ecosystem, which is really about expanding the ownership that we've been able to contribute to in the US, worldwide. Billions of people around the world could benefit. So in Q2, our continued product velocity across these three arcs led to a bunch of records. On the active trader front, core business is humming, which drove market share gains and record volumes across not just equities, but also options and prediction markets in the quarter. Also, have to highlight, Rothera started supporting Robinhood prediction markets and has rapidly become a top 3 DCM, so top 3 designated contract market in the US. We also launched the first version of agentic trading, which allows customers to build AI agents to trade equities, options, and crypto, and to have access to Robinhood tools and features. We're very excited about that. So looking at wallet share, Trump accounts have officially launched, which is a historic step towards enabling broad financial ownership from birth. We're honored to serve as broker and sole initial trustee, helping millions of American children become owners of our great economy from day one. We also crossed an exciting milestone for the Robinhood Gold Card, 1 million cardholders. Yeah, that's a number we're very excited about. And actually, the Gold Card is now driving over 17 billion in annualized purchase volume. So it's being heavily used. I think a lot of people in this room maybe have them. Plus 3 billion. We broke 3 billion in banking deposits since we began rolling out just last November. And all of this put together contributed to record net deposits. Customers are continuing to trust us with more and more of their assets, which in turn help drive total platform assets to record levels in quarter as well. Finally, global financial ecosystem, we closed our acquisition of WonderFi in Canada. We received our capital market services license in Singapore, and at our crypto and international event, The World is Flat, we introduced a suite of products, including Robinhood Chain, which is the first chain purpose-built for real-world assets. And we've been seeing a lot of great initial traction on all these products, but in particular the chain. So we saw over 12 billion in DEX volume. So that's over 12 billion in trading volume on decentralized exchanges after launch, which made it one of the largest chains by transaction volume over the past week. It was also the fastest chain to get to 100 million transactions. I think we're well north of 150 million transactions at this point, which is very, very cool. Also, customers have deposited over $200 million into Robinhood Earn. So remember, Robinhood Earn is our stablecoin lending product that's powered by Robinhood Chain and our stablecoin USDG. So now it allows customers to earn 7% APY, which is a competitive rate. So 200 million so far, and it's just been a few weeks. Stock tokens, which I'm perhaps the most excited about. We're very excited about bringing ownership of real-world assets to everyone in the world. Stock tokens are available in more than 120 countries, which allow many people around the globe to experience the idea of ownership. Tokenization makes it possible to expand exposure to high quality assets like US stocks to every single person with an internet connection. So if you have a smartphone, you have an internet connection, you can connect to our blockchain, you can get exposure to US stocks, and that's very exciting. Overall, we're now serving over 1 million accounts outside the US, and very much at the beginning there. So continued product velocity across these three arcs led to record results in Q2, record revenues of 1.3 billion. That's up 32% from last year. Record net deposits of 22 billion, which is a 28% annualized growth rate, and record gold subscribers of 4.8 million, which is now 17% attach rate relative to our net funded accounts. Now I'll hand it over to Shiv to discuss our results in more detail. Shiv?
All right. Well, thanks, Vlad. Before getting to the results, I wanted to share 3 big takeaways from the quarter. To start, the core business is going strong. So net deposits were a record 22 billion, a 28% growth rate, and we drove new records across equities, options, prediction markets, and margin. It's also great to see top of funnel growth picked up as we added nearly 1 million funded customers in the quarter. Second, this led to both record revenues up 32% year over year, but also another quarter of strong profitability with 57% adjusted EBITDA margins. So we're continuing to drive strong top line growth and profitability at scale. And lastly, we're dialed in on expenses. So we're lowering and tightening our outlook, even as our core businesses grew to new highs and we layered on new products. So let's review our Q2 results compared to a year ago. As we said before, revenues grew 32% to a record 1.3 billion, and this was driven by strong growth across the business. So transaction volumes increased to record levels across the majority of our asset classes, and we drove market share to new highs. Interest earning assets also grew, and we had records across margin, our credit card book, and also Robinhood Banking. And finally, other revenues were up as gold subscribers reached an all-time high of 4.8 million, and we started generating revenues for our work on the Trump accounts. And while product velocity continues to increase and revenues continue to grow to new highs, we also stayed disciplined on costs. So adjusted OpEx and SBC was 641 million, as we managed expenses well below our prior outlook range, all while including costs related to 2 new businesses, Rothera and WonderFi, that were not included in our prior outlook. As we look to the rest of the year, while we're adding costs related to Rothera and WonderFi, we also continue to get even more efficient in how we operate. And this is allowing us to both self-fund Rothera and WonderFi costs, but also remove additional costs from the system. So we're lowering and tightening our 2026 outlook for adjusted OpEx and SBC to a range of 2.675 to 2.775 billion. We believe it is a competitive advantage to not only be a growth company that can invest for the long term, but also leverage our lean and disciplined operating model to self-fund a meaningful amount of these new investments. So you take it all together, the strong top line growth and expense discipline we drove in Q2, it flowed to the bottom line. So adjusted EBITDA was 741 million, up 35% year over year, and a 57% margin. And earnings per share was 62 cents, up 48% year over year. So if we turn to capital allocation, there's a few top of minds. In June, we opportunistically raised 2.2 billion of capital to give us even more flexibility to invest for future growth. We believe we have a massive opportunity ahead of us, and the capital gives us even more capacity to go after it. And we raised this capital at attractive terms for shareholders, with both a 0% coupon and no net dilution until our share price exceeds $300. And even while raising capital, we are prudently managing our share count. Year to date, we've repurchased 7.5 million shares for 664 million. And as we said before, the denominator matters. So overall, we're really proud of the results we drove in Q2, and Q3 is also off to a good start. July average daily volumes compared to a record Q2 are in a similar area for equities, options, and event contracts. And July net deposits are tracking towards the $4 billion area, And this does not yet include deposits into the Trump accounts. So stepping back, we feel great about all the products we're shipping and the growth that we're driving. But we've also heard from some investors that it can be difficult to know which growth areas to focus on. So I wanted to share 3 areas that we think are important for measuring progress and success on our long-term vision. First, net deposits. Customers continue to trust us with their hard-earned deposits at over 20% growth rates. As we drive strong net deposit growth, assets compound, and this leads to strong business growth. Second, Rule of 40. We're driving double-digit revenue growth with strong adjusted EBITDA margins, a combination that has made us more than a Rule of 80 company for the past few years. We think it's important to be both a growth company and a company that operates with strong margins. And all of this at our scale of over $5 billion of annual revenue, which is quite rare. And third, $100 million ARR businesses. We're excited to share we're now up to 13 businesses that have reached this level as we rapidly ship for customers, including 2 new more that we added just this quarter, Robinhood Legend and the credit card. As we build out a family of financial apps, we plan to add even more 100 million ARR businesses in the year to come. So if we keep making progress on these areas quarter after quarter, year after year, the financial results should follow and take care of themselves. And as we've shared before, our financial North Star remains the same. Maximize earnings per share and free cash flow per share for shareholders over time. So before we move to Q&A, I'm actually going to turn it back over to Vlad to show us a few of these great products that we've recently built. Vlad?
Thanks, Shiv. I want to try something a little bit different, if I may. So a lot of you are probably familiar with our main app, but over the past few years, we've really expanded from a single trading app to a broader system. So what I wanted to do was just give you a little tour of some of the other family of apps that we've built and we've really been improving upon very recently. So here they are, our four apps. I won't show you the main one, but why don't we start with this one here, Trump accounts. So again, this has been an incredible collaboration between Treasury, National Design Studio, Robinhood, our teams, and BNY. And I believe it's the best digital experience the government has ever delivered. Actually, Secretary Besson a couple of days ago said this was like the best product launch that the government has ever done. And I think that's high praise because, I mean, NASA, I think, would be in that. Anyway, this is my kid's Trump account. So if you notice, you can select your kid there. One of the things that I think we've done really well, and maybe you'll recognize some of the design language and inspiration from Robinhood, is showing the magic of compound interest. And that's front and center. So you not only see the account values today, but you can see what happens by age 18. And you can even simulate, okay, if I add, $50 or $130 per month, what can we expect to happen with compounding to age 18? You can even see, age 60. So you extend it to retirement age. And what we really wanted to do was kind of illustrate how magical it is and get people thinking long term. You can scroll down here and you can actually get a feeling for the companies that are in the low cost ETFs. And then this is my favorite thing, contribution flow. So we have this awesome illustration and we make it super easy to contribute. So if you want to do $5, my Robinhood checking account is linked and you have this like coin animation that fills up your piggy bank. You can make it a recurring contribution. And actually the level of the coins in the piggy bank, this is a nice little detail, corresponds exactly to how close you are to your annual giving limit of $5,000. You can also share here. So there's a QR code you can easily share with friends or put on a registry or have for birthdays. You can share this link at the bottom directly too, and folks can just contribute without even having an account through Apple Pay, which I think is cool. Here's the educational content, and we try to make it easy to just go through and learn the basics about the stock market and investing, and that's the idea. There's plenty more coming. We think it can be the best charitable giving vehicle, so we're working hard on that. Michael Dell, as you guys know, gave a very large donation with his wife Susan and many others as well. We're working to make it easy for employers to donate. So there's a $2,500 tax-free employer limit per year, which Robinhood is participating in. And so if you guys don't have it, I definitely recommend picking it up and getting it for your children or grandchildren. And you should expect that it just continues to get better and better. So that's the Trump Accounts app. And again, great collaboration between Treasury, National Design Studio, BNY, and our team. Let's take a look at the banking app. That's the second one up here. We believe we're building the best digital banking experience in the market. You can get a sense of like the premium Art Deco feel. And we wanted to build a banking experience with no compromises. So usually other neobanks have sacrifices that you have to make from the experience being purely digital. But we want it to be a true private banking product. One of the things people love about it most is your APY. So we've now made it so that you can earn high APYs on both checking and savings just by setting up direct deposit and being a gold subscriber. So no minimums. And people really love not having to think too hard and concentrate on moving their funds back and forth to make sure the bulk of their money is earning the highest yield. So we just give you 3.5% automatically on every account. And customers love it. So far, about 40% of customers are signed up for direct deposit, which is a great attach rate. You can also see down here, we've got the rewards menu, which we've done a redesign to make it easier to get into. So 3% cash back, you can see you can upgrade to the gold card, and we have all sorts of other reward redemptions. And then down here, that's the family tab. So you can add family members. This is really the first banking product where the family is the first class citizen. And then all of your transactions are down here. So really, I think this is a key part of building a financial ecosystem for our customers. Customers direct deposit into banking. They can spend with their credit card. Cashback flows back into brokerage, which kickstarts or turbocharges their investing. And we make it incredibly easy to do that. Also, just one note, I'm not going to show this, but we just started rolling out the Platinum card, and it's looking really good. I think we've gone through a lot of the feedback that we had on launch, and I encourage you guys maybe after earnings to check out the website because it's looking really good. All right, let me show now the third one, which is the Robinhood wallet. So as part of our announcements that the world is flat, we launched Robinhood Chain Mainnet. And of course, a robust chain like Robinhood Chain needs a robust wallet to match. So let me show you how customers are using it. Now, I'll do a caveat. I'll show a lot of features that actually aren't available in the US. So these are really just ex-US products. So think of it that way. They're not available here, but people in over 120 countries outside can actually use them. So you'll see right away, similar design language to Robinhood, but everything is powered by crypto technology. One of the tabs we have on the bottom there is perpetual futures. And this chain, the wallet itself is well integrated into Robinhood Chain. So the chain is a first-class citizen. So here through our partnership with Lighter, you can, if you're an active trader outside the US, get leveraged exposure to not just crypto perps, but also commodity perps and single stock perps as well. And we make it easy to add funds, deposit and withdraw, and place trades. The other thing I'm very excited about is stock tokens. So here I'll show you what they look like. This is NVIDIA. So if you're a customer outside the US, you can get exposure to NVIDIA through stock tokens. And they have certain advantages over traditional stocks even. So they're tradable 24/7, including Saturdays and holidays. And you can even send it on chain. You can see the address. You can receive just like you would any crypto. And this makes it really easy to expand ownership worldwide. All you need is an internet connection and to be connected to the blockchain. And looking ahead, we're going to continue to push on this. We're working on adding lots more stocks and really pushing on tokenization of other real world assets. We have a lot of momentum here, so a lot to do. And there's plenty of other products in the pipeline. So we have our 3rd annual Hood Summit in a couple months. The Engines of Creation live from Houston, Texas. So stay tuned for that. I think that will be very exciting. With that, Chris, unless you want me to show more apps, we can go to Q&A.
Thank you very much, Vlad and Shiv. For the Q&A session, we're going to start by answering shareholder questions from Say Technologies. And after the Say questions, we'll turn to live questions from our audience and then go to the dial-in participants. So I'm going to kick it off with our first question from Say, who should be joining us live. Zach, are you joining us?
Zach? I don't see him. Well, I do see a blinking cursor.
Hello, do you guys hear me?
Oh, there you are.
Hey, everyone. Happy to be here. Just wanted to know, what is the goal of Robinhood Social and when will it go live to the general public?
Thanks for the question. I also noticed you are on Robinhood Social, if I'm not mistaken. And there was some discussion on Robinhood Social about this question. So it's very full circle. Yeah, the goal with Robinhood Social is actually Robinhood up until now has largely been a tool to place the trade, but the idea for the trade would typically come from outside. So you'd get the idea somewhere from the real world and then come and place your trade. And so we asked ourselves, can we actually help customers learn from one another? Can we take advantage of the large community that we've built? And can we make it so that we can help you with idea generation? And so far, we're seeing great early signs. And one of the advantages that we have compared to other social media platforms is since we have the trading data, we can make sure that everything is validated. And when you say you've made a trade, it's actually real. And you can see that the customer actually has the portfolio that they claim they have. So we're adding more and more features. The goal is to get it out to everyone by the end of the quarter. And what we're doing is we're just iterating and making sure everything like the feed ranking algorithm, all of the functionality in the posts are tuned before we make it available to everyone. But we like what we're seeing, so we feel pretty good about rolling it out before the end of the quarter.
All right.
Wow, yeah, thank you so much.
Thank you.
All right, thank you for your questions, Zach. Next question is coming from John.
Hey, John.
Hey, guys. Hey, Shiv and Vlad. Thanks for taking my question. Mine's on the Clarity Act, and I understand it's still moving through the Senate, so things could change. But could maybe if something similar were to pass, could you give an idea of what would be the most impactful aspects of that to Robinhood, and if there are delays, any impacts as well?
Yeah, totally. I'll field that one. So I think the Clarity Act is very, very important because while the current administration has been great and really is the first crypto forward administration that's embracing the new technology, we want the foundation of the industry in the US to be durable. So we don't want the floor to be shifting out from under us every 4 or 8 years, and new rules to be put in place. Or so I think that in order for the industry to really grow, stability from regulatory stability is necessary. And that happens through legislation. So we saw that with Genius. I think Clarity takes it one step further. And in particular, one of the things that we've been pushing hard on, as you saw earlier, is tokenization. We've been investing in our tokenized offerings. We think that's going to be a big industry. We're pushing that outside the US. You see some of the advantages already just in the past year, from like V1 of our tokenized products to V2. It's like now fully on chain. Now it's 24/7 trading. It's like you can send and receive, fractionalization by default. So there's lots of advantages. And we think it would be a shame if the US didn't get to benefit from all those advantages. So we're excited about that, all of the aspects of it. And we think Clarity helps take us one step further. But also, we're not standing still. We're pushing hard on our on-chain and traditional centralized products. And we're making sure we continue to innovate overseas in some areas, but otherwise, with Robinhood Earn and other on-chain products in the US. So we think we'll be good regardless, but of course, Clarity is going to be very, very important to making the most out of all of these products that we've been building.
Cool. Thanks for taking my question.
All right. Thanks, John. And the last question from Say comes from Joe.
Hi, Vlad and Shiv. Can you
Joe.
give us an update on early traction with Trump accounts since the July launch? Specifically, the number of accounts opened, assets flowing in, and how you're thinking about long-term contributions to net deposits and assets under custody?
Oh, yeah, great question. Yeah, we've been very pleased with the progress thus far. So 7 million children have signed up. We've seen over 1.5 billion in, or nearly 1.5 billion, I should say, is the number of contributions into Trump accounts already. And again, that's before a lot of the philanthropic contributions have started flowing in. So yeah, we think that this is going to get to tens of millions, and we're working aggressively to do that. And obviously, contributions we believe will continue to grow very rapidly from here. And it'll take continued hard work. I think the great thing about programs that have success is people want a lot more things. They want them quickly, and I think with our partners, we're working hard to deliver. So on deck soon, making it so that employers can fund the Trump accounts of their employees, making a great philanthropic experience. I think for folks that want to donate and to be philanthropic, there's actually poor options available right now. There's not great options. It's kind of, there's no default option, at least. You have to evaluate charities. You have to figure out, are they being wasteful with their fees? Is the money actually getting to where you want it to get to? And I think this can provide a default, great, low-cost mechanism. So we're excited about that. And it's just the beginning.
All right. Thank you, Vlad. And that concludes the Say portion of our Q&A. So we're now going to go to Q&A from our live audience. We ask that each person limit their questions to one, and please raise your hand if you'd like to ask a question. All right. Can we get mic to Dan Dolev?
Hi, Dan Dolev at Mizuho. Congrats, Vlad. Congrats, Shiv. Amazing quarter. I think what surprised us the most on the positive side was the amazing growth in the funded accounts. Maybe you can shed some light on what part of that is structural, what are you doing, and maybe a quick update on the progress in Europe and how that is going. So very impressive there. Thank you.
Yeah, I'm happy to start with that one, Vlad, give you a little
Absolutely.
break.
Thank you.
So we said on the last quarter, we were making a concerted effort to regrow top of funnel. And as you mentioned, really great to see the progress. 1 million funded customers, the most we've added in a quarter in nearly 5 years since the IPO. There was a variety of different vectors. So it wasn't any one thing. Really strong market backdrop, that definitely helped. We had a lot of new products that came out, banking, credit card, for example, those contributed. Strong organic growth. We also had the SpaceX IPO, which helped. We had an acquisition in the quarter, which provided a couple 100,000 accounts, and we continue to grow overseas. And so what it's showing is just the power of the ecosystem or the financial apps that Vlad was saying. And any given time, there may be a couple different vectors that are growing. And this quarter, we saw a lot of them hit at the same time. And we're going to keep focusing on this. So whether it's through new products or marketing, it's going to be one of our top KPIs going forward.
More to do.
Oh, sorry, Vlad.
Oh, I just said there's more to do. So.
All right. I think moving from the front row to the second row, Dan Fennon.
Yeah, thanks. So wanted to talk on prediction markets and how you're thinking about sustainability as we exit the World Cup, bridge to football season, just how you think about the long-term durability of this kind of asset class and what you're seeing outside of maybe some of the sports stuff related to macro or bigger events.
Yeah, absolutely. I mean, I think that the great thing about prediction markets is there's events all the time. I mean, you mentioned football season, that's coming up. There's also the midterms, which I think are extremely important. I mean, they're going to be a topic of discussion, and of course, customers are going to want to trade them and hedge their portfolios. Yeah, and there's events just on a consistent basis. So we're gearing up for that. We're making product improvements constantly. We're making pricing improvements. Rothera has gone live, and I think the World Cup was really a proof of concept there, and we're looking to scale that rapidly and make it much bigger, with the goal of providing great pricing to our customers. That's really how we think about it. Can we route to multiple venues with the goal of making sure, as a customer, you get the best deal possible on Robinhood?
All right. Thanks, Dan. Let's next to Dan, and there are a lot of questions in the room, so we'll keep the mic moving around. So David Smith, do you want to take the next question?
Hey, thank you. In the past, you've spoken about how it's typical for new customers to come to Robinhood based on interest in one particular product and engage with you for more products over time as they become more familiar with your offerings. With the really strong prediction market engagement we saw in June and seemingly continuing into July, can you help us get a sense of how much came from existing prediction markets users, existing Robinhood customers who maybe were new to prediction markets, and also from new customers who joined Robinhood in the past month or two to transact with you in this product?
Shiv, how do you feel about that one?
Yeah, I'm happy to take it. So we've said before, when you come to Robinhood to do one thing, you tend to do more. A couple things we'll point you to. New customers still sign up for gold about 40 to 50%. So customers come in, their journey is they come for something: equities, options, prediction markets, crypto, banking. They discover gold, then they discover other products. What we're seeing is, regardless of what product you come in for, you tend to sign up for gold and you tend to adopt others. So one thing we looked at, if you're a prediction markets customer, for example, you're actually more likely to have a retirement account with Robinhood. And so any vector you come in, whether it's banking, prediction markets, credit card, you tend to adopt others. And so I'd say it's just one of them that we saw were strong in the quarter. Banking was really strong. That's been a really nice new vector that's been coming in. Credit card as well. We said we have over 1 million customers there. Q1 and Q2, you still have a little bit of retirement season, so you saw some people coming from there. And then whether there's new events in the prediction market, such as the World Cup or the midterms coming in, they come there. The last number we shared was we had about 1.5 million people that have used the prediction markets. That number is now closer to 2 million, so continue to grow nicely there. But I think the main takeaway is it's across all of the different products, and people are coming in and adopting multiple products at the same time.
Yeah, on the marketing side, we continue to see strong ROIs, and it's diversified. So strong ROIs on prediction markets, but also gold and some of the active trader offerings as well. And I think we're in the fortunate position of having it be working really, really well across multiple fronts.
All right. Thank you. Next question, maybe Devin Ryan back in the front row.
Thanks so much, Devin Ryan, Citizens. Hey, Vlad. Hey, Shiv. Question, Vlad, you mentioned version 1 of Agentic, and obviously is still fairly new, but can you talk about like what you're learning with customers that are using that? How is their investment performance? Is there anything else interesting that you're seeing with their behaviors? And then how does that then map to version 2.0? I know you guys are very focused on bringing these capabilities to all of your customers, and that's probably where this becomes a much bigger deal for Robinhood. So how do we think about mapping that out and what that will look like and when? Thanks.
Yeah, I mean, since we're the first major platform doing this, we wanted to start fairly conservatively, right? So we started with stocks and also started with the Agentic account being separate from your main account. And so what you typically see there is customers fund it with a relatively small amount of money and link their agent. Of course, we've expanded it since then. So now options are tradable with Agentic as well. And we've seen customers do really interesting things, like they can put together really complex and sophisticated strategies. Crypto is coming soon as well. And you know, we're going to expand the toolkit to cover as much as possible from the entire Robinhood ecosystem. We've had over 100,000 people actually integrate and open up Agentic accounts, which has been very cool. Yeah, the AUM in Agentic, or the trading volumes, have also been growing, and that's been good to see. If in terms of friction, I think one piece of friction has been that not everyone loves, surprisingly, going to a Codex or a Claude Code and kind of stitching together these two apps. You have to have quite a bit of sophistication in order to do that. So, you know, we're thinking, how can we make that even easier? And also, in many cases, the models themselves aren't familiar with being used for trading. So sometimes they'll fight you and they'll say, well, I don't know, I don't really want to trade. And you kind of have to work hard to get it to do what you want to do. And yeah, we're hard at work addressing both of those things and other things.
All right. Thank you, Vlad. Next, let's go to Christian Blue, sitting next to Devin Ryan.
Thanks for the question, Christian Blue, Autonomous. Vlad, I think you called out Rothera as a top 3 DCM. So I'm just trying to think through longer term how your vision around having a DCM, having retail distribution. Is there a possibility here that you could further build that out, whether it's perps or traditional futures, to take on maybe the top 2 DCMs out there?
Yeah. I mean, obviously, we're top 3 after 1 month, but the goal would be to keep growing that, right? We're not satisfied just with where we are after just a couple of months. And yeah, I mean, I think the roadmap on the Rothera side, not speaking for them because it is a joint venture, is to continue to grow, add more capabilities. Of course, you know, they're definitely focused right now on the prediction markets event contracts, but over time, you should see that expanding. And in terms of, you mentioned perps, we also have perps, not just on chain like I showed you, but through our Bitstamp exchange overseas, where we've been rapidly increasing the scope of the perps offerings, now offering, you know, commodity perps. You should see that inventory should expand and grow over time as well. So I think our customers, through the Robinhood retail apps, will have access to the best products from multiple exchange providers. And, you know, our job will be to stitch that together, make it really clear what the costs are, and also make those costs as low as possible for the customers. But you should assume that it's multi-homed and that, you know, the customers can get the best of everything.
It can also be a B2B business over time. So we can onboard additional FCMs. So right now we're laser focused on making sure the Robinhood customer gets a great example. But when you think out longer term, there's no reason why this can't be a large institutional business as well.
Christian, if you'll hand the mic right behind you to Ramsey, that'd be great.
Hi, Ramsey LaSalle from Cantor. Thanks for taking my question. Now that building on some of your comments and some of the prior questions, now that Robinhood Chain is live and thriving, how should we think about the broader DeFi roadmap for you guys? You've got obviously tokenized assets, Robinhood Earn, Perps in your wallet I saw. What other on-chain services could be the next sort of growth opportunities? I'm thinking maybe like lending and borrowing or other yield generating type products.
Well, we already have that through partners. You could build, lending and borrowing pools on chain. People have started building really interesting stuff. I think one of the really cool things about seeing so much volume, again, fastest chain to 100 million transactions, is a lot of other chains have to do a lot of work to get third parties to integrate. I mean, we were fortunate to get pretty much all the major wallets and protocols to integrate with us over the past couple of weeks because they saw the volume. And then that in turn, when you're a developer thinking about what chain to build for first, you're seeing all this momentum, seeing all the wallets, and we've gotten a lot of developer activity too. We've been among the top chains in terms of developer activity. And yeah, some of the interesting things are developers building things that compose with the real world assets, the RWAs. So all kinds of things that utilize the stock tokens in interesting ways, in ways that we haven't thought of. And our roadmap will be, of course, making the infrastructure better and better, making the APIs cleaner. The block speed and block times are quite good. So it's a great chain for developers, but could continue to get better. And just adding in more RWAs, more stock tokens, expanding to all kinds of other asset classes as well, which we're already hard at work on. And we think that the unique thing is us supplying the RWAs as a key primitive of the chain, making sure those work really well, and then seeing what other developers can do to compose them.
All right. Thank you, Vlad. All right, so Ramsey, right behind you, James Yarrow has his hand up.
James Yarrow, Goldman Sachs. Thanks for taking the question. I wanted to touch a little bit more on perps in the US. What's the appetite to add them in the US brokerage? What are the hurdles to rolling them out? And I guess, are you looking to roll them out in the near term, CFTC approval permitting?
Yeah. So as you can imagine, we've been in conversations with CFTC and they've been constructive. And yeah, we are making progress. So I don't have specific things to share, but I think we feel really good about our customers having a great perps experience. And we already have it in Europe, so the work is not a large amount of work.
All right, thanks. James, can you pass the mic immediately to your left?
Hi, I'm Daniel.
Checkers we're playing.
Are there plans to add support for foreign stocks? Right now, investors have to buy ETFs to get exposure to certain foreign companies.
Yes. In short, yes. Obviously, it's on our roadmap. And over time, you should expect that as a Robinhood customer, you have, we not only want to give US stocks to customers all over the world, but we want to give foreign stocks to customers all over the world, including to the US. So we're going to build out a marketplace and a real, I think our common infrastructure could be a real asset there. Yeah, unfortunately, it's not one of those things I can just snap my fingers and we're connected everywhere, even though I try. But yeah, it's definitely top of mind for us. Yeah, and it's great to see customers always, the active traders always want more things. So we're always busy and we love that.
All right. If you could pass the mic to your right and back one row. All right, thank you.
Hey, Vlad. Hey, Shiv. Trading volume, 2+ million of monthly transacting users, I think close to 500 million of stablecoin supply.
Yeah.
What could go right with Robinhood Chain? Because you could
offer the opportunity of having the Robinhood app to everyone globally, like what could go right?
I think a lot could go right. And thank you, by the way. I've been enjoying your content and your analysis.
Thank you.
Yeah, on X, it's been really good. Yeah, I mean, I think that we built Robinhood Chain to be purpose-built for real-world assets. I should clarify, I like memes as well. I'm like, yeah, you know, they always get a little upset at me. You know, Robinhood was one of the original, I mean, we kind of created this market in so many ways. So whatever it is you want to build, Robinhood Chain can be the permissionless home for that. Our unique contribution is the real world assets. And I think we're doing really the difficult work on the liquidity side, on the regulatory side, to make sure we safely bring all of these assets on chain and make them useful. So we started with a first set of stock tokens. We're going to grow that over time, make them fully DeFi enabled. And then we're already hard at work thinking about other types of real world assets that we can add. And I think you're already starting to see some of the activities. Developers are doing really interesting things that I hadn't thought of. And yeah, I think our job is to give them better and better tools to do it. And I think the enthusiasm has been great, but there's obviously much more to do. And we're never mistaking and confusing enthusiasm with complacency. So we know that we just got to keep building and making sure that it's the most useful chain for developers and all of our traders.
All right, thanks, John. Can you pass the mic a couple of rows up to Craig? Thank you.
Hi, Craig Moore with FD Partners. If I could just ask a question about the quarter. You had a disclosure in the deck showing that you're trending toward roughly 4 billion in net deposits. That's down quite a bit from June, and it's the lowest of the year. So I was wondering if there's any commentary around that, and does it have anything to do with, well, I was also want to ask about the health of investors considering the drawdown in semis and what's been happening in the market. Thanks.
Yeah, I'm happy to take that one. So our goal, as we've said, is 20% on an annualized basis. I don't look at any particular quarter and month. There will be things that change from time to time. If you look at year to date, including July, we're still well north of that 20%. As you mentioned, we had a really strong Q2. Great to see the engagement. It will fluctuate from time to time, but I don't read anything into it. Net deposits have a variety of factors. It's what's going on in the macro. It's when do we launch new products. There is some seasonality. Summer tends to be a little bit slower. What promotions were going on. And so what we're focused on is, can we keep delivering for customers? Can we keep doing these new products? And then over the fullness of a year or even longer, we should be growing at about 20%. And everything we're seeing is that's still happening. In terms of the health of the customer, very healthy engagement. And so our customers tend to be techno optimists. They tend to be younger. They tend to believe. And so they use some of these drawdowns as ways to buy. And so on down days or down months, we tend to see really strong net buying. That's what we saw in Q2, and we're continuing to see that. As I shared July, the average daily volumes are very similar to the Q2 average. So continuing to see strong net deposits there. And everything else that we're seeing is the health of the customer is very strong.
Yeah, and I'd say we have some good long-term tailwinds to that growth. So it's not just, you know, the short-term things like promos and the macro, but we're building more durable engines of net deposit growth. I think banking has been a great success thus far, and it's still early. It's not yet fully integrated into the main app or the ecosystem. So I think we have more room there. Advisor network. I think that's the beginning of what could be a really, really strong RIA integration. And as you probably know, the RIA channel is a good, durable, consistent source of net deposits. We've been seeing good growth from multiple brokerage accounts. And then, of course, trusts is rolling out. So, you know, there's a lot of people of higher net worth that use trusts and that have all of their wealth there. So I think as we keep adding these things and keep supporting, that should just be a long-term durable tailwind for our business and net deposit growth.
All right, Craig, would you mind passing up one row to Alex?
Hi, Alexander Baton here. Thanks for taking my question. So Peter Thiel once said when asked if he regretted selling Facebook at 100 billion valuation, that each 10x up to 100 billion he saw as equal difficulty, but 100 billion to a trillion he imagined would be significantly harder. In hindsight, Facebook's move from 100 billion to a trillion may have been its easiest 10x because it had already reached scale.
I like where this is going.
As Robinhood approaches that $100 billion market cap, how do you think about the difficulty of the next 10x? Could getting from 100 billion to a trillion actually be the easiest because the scale and operating leverage you've built? What will it take for Robinhood to surpass market caps of legacy financial institutions? And do you see AI supercharging your global domination plans?
I've got some board members in the audience too. I think getting to a trillion will be very, very difficult. I don't think a financial company has ever hit a trillion market cap, but I think it can be done. As you mentioned, there's a lot of new things that are changing rapidly that I think we're on the forefront of. So it's not just growing our brokerage business and expanding it internationally, but it's also agentic finance. And can we build great tools for agents? And can we see a world where that just a lot of the activity, if not the majority, goes in that direction? We're building for that. Can we use the early success of Robinhood Chain to actually make all assets, make everything that you have in the U.S. available to billions of people worldwide, and then we benefit from the tailwind of the rest of the world getting wealthier, and the rise of the global economy as well, by giving them access to things. Private markets, I'm very excited about, and we've seen Robinhood Ventures Fund 1 and now Robinhood Ventures Fund 2, which is beginning the roadshow. So we have the prospectus live. That one focused on early stage. And the goal really with Robinhood Ventures is for us to be there for individual investors to have exposure to companies at the earliest possible stages, but really across the entire life cycle, including early stage. And so I think putting all these things together, I see multiple axes that the company could 10x, and I think we're going to pursue all of them.
Yeah, we don't comment on the stock price specifically, but if what we've said before is we believe we can 10x the business over the next 10 years, and that's through a lot of the vectors Vlad shared. When you look at assets are the greatest predictor of what's going to happen in financial performance. We're super excited. We're nearly 400 billion today. But if you look at some of our competitors, they've got to tens of trillions of assets. So there's no reason you can't do that. And that's just the core brokerage. Then you go to retirement, which is even a multiple of that. Then you go into banking and crypto, which is even multiples of that. Then you go international. Then you go to B2B. And so everywhere you look at it, it's pretty unique. When most companies go to their adjacent businesses, they tend to be smaller TAMs. For us, it's actually the opposite. As we go to some of these adjacent businesses, they're actually larger. So that allows us to grow. We actually build a 10-year roadmap. And so we have, we look at what we want to do, not just over the next 1 year, the next 5 year, over the next 10 years. And if we execute on that, we have a really cool opportunity in front of us.
And I'll just add that it wasn't long ago that Apple was the first company to hit $1 trillion, and we didn't think it was, that all these companies would be. And now there's $5 trillion companies, and soon we'll have $10 trillion companies. I have no doubt Robinhood will be a $1 trillion company.
Well, thank you.
All right. Let's see. Ahmed, do you want to take a question?
Vlad and Shiv, congrats on a great quarter. I don't know how I'm going to follow up that question.
Congrats on a great hoodie.
It's a nice one here. Very, very nice. Yeah, I mean, look, I think what I'm observing in the quarter, especially as someone who's been kind of looking at the business and the trajectory over the past 5 years, is just really strong engagement. AUM at almost 400 billion. You're seeing the gold attachment rate at 17% of subscribers that are their all-time high on gold subscribers. I guess my broader question is, why do you think the engagement is becoming so strong? Why do you think customers are so willing to adopt the credit card, agentic services, try out meme coins on the Robinhood chain? Like, what about the flywheel is working? And what do you think you can do to sustain that flywheel working for the next 10 years to hopefully get to that $1 trillion market cap?
Yeah, I think that's a great question. I think that first off, the products have to be good, right? I mean, we've rolled out a lot of good products. I think the credit card has been really great. Value props hard to argue with. 3% cash back on all categories, great UI, virtual cards experience is really, really good. So, and you know, it hasn't always been not all of them. We haven't batted 1,000, right? We've had many versions of the debit card and cash management. If you remember McDuckling, we called it. It had various iterations before we found success there. But I think what we found is there is a flywheel, right? We get a customer in, they become a gold subscriber. They after they become a gold subscriber, they look out at all the different products we offer. If those products are competitive with what's on the market or better, they'll adopt them. And then a decent chunk of their earnings, if we get the direct deposit, go into Robinhood. And you know, they spend time on the platform. They use us for a lot of our customers use us for everything. And so when we add something new, they're likely to see it and take advantage of it. So I think what we have to make sure that we do, and this is not an easy problem, is putting the right products in front of the right customers at the right times, making sure the entire experience is coherent. And that's actually becoming a hard problem because the app is constantly changing. And so the orchestration of all of these things into one story, into one financial tool is becoming an increasing source of focus, because I still think we could do better there. And making sure that all the individual pieces, even if you're not using 10 Robinhood products, each individual one should be world-class as well. I think if we can deliver that, all the individual pieces, and then stitching them together nicely, there's plenty more room.
All right. Thank you, Vlad. As much as we've had a lot of great questions in the room, there are even more people on the phone. And so we're going to start now and shift over to the Zoom Q&A. So the first person asking a question on Zoom is Steven Chubak from Wolf.
Steven.
Hey, good evening, Vlad and Shiv, and thanks for taking my question. Sorry I couldn't be there in person.
You're missing out, man. Look at the.
I know. It's always a fun time, so sorry I couldn't be there. But wanted to ask on the updated expense guidance. At the start of the year, you guided to 18% expense growth, of which 10% or a bit more than half of the growth was really earmarked to support new product launches, 5% to support the core business, 3% for acquisitions. There have been a lot of moving pieces underpinning the new expense guidance. So just wanted to better understand how the buckets have evolved under the new guidance, and whether it still contemplates a similar level of investment to support some of the more nascent growth initiatives.
Yeah, great question. I think the really exciting part is we are able to self-fund a lot of the growth initiatives, so we are still growing. That is not changing. You know, Vlad just shared a lot of the different products and apps we're working on, and so we are still a growth company. But the nice thing is, because we run lean and discipline, we can self-fund a lot of these. And so you mentioned the 3 different buckets. The short answer is the savings are coming from all of them. So a little bit's coming from the M&A. We're being a little bit more efficient. The new M&A actually wasn't even included in those, so we fully self-funded those. On the core business, the teams are really working hard to make sure they're delivering fast, but also doing it efficiently. So we had some savings there. And then in the new seeds, not only are we making sure that we invested what we started the year, but we've actually added some even relative to where we started. But we put it all together. We're halfway through the year. We're trending well. Our lean and disciplined nature is showing through. So we thought it was the right time to do it. But I think the takeaway is we are still growing, but we're just able to do it more efficiently. And so now is the right time to lower our outlook.
All right. Thank you, Shiv. The next question is from Craig Siegenthaler at Bank of America.
Vlad, Shiv, hope you guys are doing well. And Chris, nice job on emceeing this event.
He's a star.
Thank you, Craig.
Robinhood just received the MAS license in Singapore, so congrats on that. I think you also have 2 small brokerages that are live in Indonesia. So, you know, the question is, where are you in the product rollout in Asia? What will the rollout look like relative to the US offering? And also, what countries can you passport into from Singapore?
Yeah, and again, just to clarify, this is for our centralized offerings. Now that we have the chain and all the DeFi offerings, we're live in a lot of countries with that. But for the centralized brokerage offerings, we did get the approval in Singapore. We are working hard to bring everything that we possibly can within obviously what's permissible by regulators over at MAS over there. And I think what we've learned from the UK is it's better to get more at once rather than just launching equities, following up with options, then launching margin. So I think what we're trying to do in subsequent launches is get more of the overall Robinhood ecosystem live at launch. So the team's been working hard on that. They're getting close. And I think that's generally the strategy you should expect us to take in other regions. And again, Singapore, we anticipate to be the Southeast Asia and the APAC hub. So we'd be able to passport there from there to lots of other countries in the region. And some of them, like Indonesia, will get direct licensure, depending on just where we see opportunity to go even deeper locally.
All right, thank you, Vlad. The next question is from Alex Markgraf from KeyBank.
Hey guys, thanks for taking the question. Maybe one for both Vlad and Shiv on Robinhood Chain and the DeFi product expansion. I'm curious how you think, Vlad, about how the effort to engage with customers and the touch points change in DeFi products. Does it sort of force you to reevaluate how you interact with customers and capture the minds and wallets of customers? And then Shiv, just on a related note, would be curious if there's anything you can share from a monetization standpoint on how we should be thinking about those relationships versus the sort of CeFi relationships that exist today. Thanks.
I guess I'll start with how to engage with the customers. I mean, my observation is a lot of those customers hang out on Twitter and listen to podcasts, which are two areas that I'm somewhat active in already, much to the chagrin of the great comms and legal and compliance teams that we have. Yeah, so I don't really see a problem. But we're always looking out for more. I'm not so active on TikTok. I don't really. Maybe I'm too old. Maybe I'm too boomerish for that. But if I have to, I'll do it.
No, it's been fun.
I'll do the little dances or what are they?
Yeah, sure. The engagement, as Vlad said, it's actually coming from developers themselves. So when you build a great product, people have to find it. That's one of the beauty of Robinhood. If we launch a great product, just given our scale and distribution, they tend to do well. And then this has just been another example, whether it's DeFi or permissionless or centralized. On the monetization piece, per transaction, we make a few basis points, not per volume, it's per transaction. Now it varies depending on the size of the transaction, but just think about it as a few basis points on average. And then we do share, approximately half of it with Arbitrum, who's the level 2 that we built on top of. And so when we starts to get larger and it goes through a couple quarters, we'll break it down more specifically, but think of it as a few basis points on transactions and then a 50-50 a rev share.
All right. Thank you, Vlad and Shiv. And we'll see some of those dances later, Vlad. So the next question comes from Brian Bedell at Deutsche Bank.
Great. Thanks. Good evening, Vlad and Shiv. How are you?
Doing well.
Excellent. My question's on Rothera, and with specifically the company financial KPI contracts with SIBO, filing with the SEC to launch these potentially in the near term. What's the interest in Rothera launching these, in the near term? And then also just in terms of migrating more of the event contracts at Hood now to Rothera, such as NFL, how are you thinking about that game plan for the rest of the year?
Yeah. So on the CBOE financial KPI contracts, so my understanding is those are under the securities-based regime. So I don't know if Rothera would be launching those right now, but obviously, Robinhood is able to connect to a wide variety of counterparties. We have a brokerage business. We also have our FCM business, and of course, Rothera is, a great joint venture that we have with SIG. So that doesn't necessarily mean that we're not going to make all of these products available to customers. I think the products in general are useful. There's interest, and so we always evaluate opportunities for adding new things to the platform.
And then in terms of the flow, what we've shared is, you should expect in the near to medium term, more than the majority or a good portion will flow through Ethereum. We're still making sure it can scale, and after 1 month, it's already doing tremendous volume. But yeah, you should expect that more and more of it will start to go through there.
All right, thank you. The next question is from Patrick Moley at Piper Sandler.
Yes. Hi, guys. Thanks for taking the question. Vlad, I just wanted to follow up on your earlier answer to James's question on perps. I'm just a little confused why you all are not being more aggressive with launching perps in the US. I think a little over a year ago, you submitted a comment letter supporting, CFTC allowing perps in the US. They've opened the door now on a number of products. You have a few of your competitors who are either live or they're moving in that direction. And what they're really trying to do is become more of a multi-asset class platform so that they can compete, more closely with you. So could you just elaborate on what the source of hesitation is with perps in the US? Are you worried about leverage? Is this, are you worried about cannibalization of other products, or is this a deliberate choice to let others take a regulatory first mover risk? Thanks.
Well, no, I don't think it's any of those things. I think we're in some ways in the fortunate position of having lots of great products that we see huge opportunity in, right? And so the roadmap, just a couple of weeks ago, we launched 13 new products that we're in the process of rolling out. And as Shiv mentioned, we had 2 new businesses just in the past quarter get to 100 million ARR or more, and we see a lot more coming. And we have perps live in overseas as well, both through our DeFi offerings and through centralized. So I wouldn't take that to mean that we don't like perps. In fact, we like them quite a bit, and we intend to offer them to our customers. I didn't give you a timeline, but I wouldn't take the absence of a timeline at earnings to mean that we don't intend to be aggressive. I just don't like giving timelines in earnings. That's what our events are for.
All right. The next question is from Ben Budish at Barclays.
Hey, good evening, and thanks for taking my question. Shiv, I was wondering if you could unpack the July commentary a little bit more. You said ADV was trending similar to Q2. I guess on a product by product basis, equities, options, should we assume that that's equities similar to Q2, options similar to Q2? And then any color you could share on the take rate. I know particularly for options, that one bounces around a little bit. Crypto, you didn't include in that commentary. Curious, not to make this a multi-parter, but what drove the fee rate improvement in Q2, and then similarly what you're seeing in Q3. So sorry for squeezing a bunch in there, but yeah, any color there would be helpful.
Yeah, happy to, and I'll try to make sure I hit all of them. First, the way you read it was correct. So for July, the ADVs for equities, options, and prediction markets are all in the similar area of Q2. So those are seeing pretty healthy engagement on all of those. In terms of crypto, it's probably a little bit slower than what we saw in Q2, and so it's early in the month, but that's what we're seeing to start. And then for take rates, for July, they're in a similar area to what we saw for the Q2 average. So I would use that as kind of your starting point. For what drove the improvement, take rates are an output metric. There's a lot of different things that go into them. And so, for equities and options, it's mix shift, it's volatility, it's the type of contract. For crypto, it's institutional and it's what tier. So lots of moving pieces, but big picture, July is off to a similar zip code for take rates, and then for most of the asset classes to the Q2 average.
All right. Thank you, Shiv. The next question is from Ed Engel at Compass Point.
Hey guys, thanks for taking my question. We know that you're pretty focused on bringing more of the volumes onto Rothera within prediction markets, but we did see some news reports that you're exploring some partnerships with some other exchanges as well. Just kind of high level here. I mean, do you see any opportunity to kind of improve your economics by partnering with different exchanges, or is the focus more to bring more activity just onto Rothera?
It's both. And I think, we're invested in Rothera, and we think that the economics there are great, and we intend to push more flow there. At the same time, we've always been connecting to additional counterparties. We first connected to ForecastX, which is IBKR's DCM. Then we went to Kalshi, then of course Rothera. And so we always are on the lookout for diversifying, making sure our customers have access to multiple options, and we're not reliant on any one individual counterparty.
All right, thank you. The next question is from Andrew Hardy at BTIG.
Hey, Vlad and Shiv, thanks for taking my question. Sorry, I can't be there in person. My wife's due next week, so probably
Congratulations.
here, but looking forward to setting up a Trump account very soon.
Got to do it.
Just wanted to follow up on the top of funnel question. Vlad, you said earlier there's more to come. Would love to just kind of hear areas you're focusing on for customer acquisition strategy and focus areas, just generally speaking, going forward there. And then just another part of that, with the pattern day trading elimination or rule elimination, did you see any benefit in the quarter? And is there anything you're doing to try to draw back customers that you might have lost in the past? That'd be great. Thanks.
Yeah, maybe I'll hit top of funnel. You can talk PDT. I think there's a lot of improvements to the product, making sure onboarding is really clean, particularly as we get more and more products, and you can sign up for multiple accounts, multiple assets. I think we've been spending a lot of time investing in that, getting customers to share the product with other customers. There's always opportunity there. And of course, we're also looking into, as banking is scaling and we're seeing traction there, as the card is getting north of 1 million card holders, can we make it even easier for folks signing up for brokerage to get the card and turn that into an active driver of growth in the other direction, meaning customers that are getting the card and coming for banking, can we get them into brokerage? And yeah, a lot of those are opportunities that we haven't really explored up until now. So there's just a lot of things that we have conviction in that remain in front of us.
And in terms of the PDT, as a reminder, we're very pleased that the SEC removed the antiquated rule where small balance customers were penalized for the way they're trading. And so really excited for customers there. It was a nice tailwind in June when the rule went through. I think what we're seeing is it's broader across the whole industry. So for regardless of what brokerage, we probably had an outsized benefit relative to our peers, given our customers have smaller balances. And what we're seeing from customers is they're still continuing to come back and adopt it. And so I think it's going to be something that we continue to see a tailwind for, not just this quarter, but in coming quarters. It's too early to tell what's exactly going to be, but big picture, customers are using it, they're coming back. And we're already seeing it in NPS surveys and other methods like that, where customers who had left are really pleased they're allowed to trade again.
All right, thank you. The next question, I think, is from Mike Cypress at Morgan Stanley.
Mike?
They were just loading and connecting. Oh, sorry. Sorry, I was my mistake. Chris Allen at KBW. or perhaps not Chris either. All right, we'll try one. We'll try one more and see if we can get into the Hall of Fame. So going 1 for 3. Next, we have Gav from Wolf Financial.
Hey, Vlad and Shiv. Great to see you
Gav.
guys.
Hello.
What's up, dude?
What's going on? My favorites. Doing well, doing well. Super excited to be on here. I wanted to talk for just a second about AI agents and agentic trading. This to me is one of the most fascinating things that you've rolled out in a long time. I've already hooked it up. I've got Claude in there trading, and I could really see this driving additional volumes as it goes on, right? People set up strategies. Now it's trading with them and not even having to be there. And I'm really curious, milestones that you're looking forward towards in terms of agentic trading, and if you think that this could truly swell volumes really beyond the human side of trading. And then in a second part of that, I am curious if you are going to give the AI agentic trading access to prediction markets.
Yeah, I mean, on the product side, the goal is to give it access to all of the tools that you would have as a human trader using Robinhood. So it's interesting for us because Robinhood's been kind of traditionally pretty closed off. We've been constraining access through our interfaces. Now we're opening it up. So traders and developers will get access to all of the capabilities where it makes sense. And yeah, I'll just say that the team has really been cooking on the agentic stuff. I mean, we're just, yeah, we've got lots and lots of things. We were early to market, but I think there's so much more that can be done. So we look forward to sharing more, including at the active trader event that we've got coming up.
Looking forward to it.
All right. I think we can finish strong here. So Vlad, would you like to offer any closing remarks?
Well, first off, thank you for all the engagement, both from institutional, sell side, retail, and our content creators. I'm really proud of the community here that's coalesced around the company. And you should know, as always, the team's been working incredibly hard. The roadmap is really full, and there's a lot to do. So hopefully see some of you at the next Hood Summit in Houston, Texas. Thank you.
Okay. I was a little bit taken back by I got a message that pulled me out of the thing. So I'm curious your thoughts on the call.
Yeah, on Robinhood itself, like we looked at before the call, very strong. A lot of things going well for them. A lot of questions asked, and I had 3 questions lined up. They're all asked, so that's why I didn't ask a question because that's
Yeah.
in the queue. But yeah, nothing is really concerning me there. It's tremendous speed, especially on EPS, and it's clear that they have a long-term vision. No matter what's happening in the markets, they're just positioned so well. The thing that distracted me in the call is Microsoft.
Microsoft.
And can we? Do you have any thoughts on Hood? And then let's just touch on, because we have to talk Microsoft here just for a second. I got to go.
No, dude, I don't have too many comments. I didn't even join the call because I didn't have any questions. I thought
you hate Vlad. Come on.
Okay, let's.
No.
I love Vlad, man.
Yeah, he's awesome. So Hood, Amy Hood, Microsoft CFO, she saved the markets. Microsoft came out, and we already saw the strong report, not increasing top line of CapEx. That's significant, but Meta, same thing, although they did increase the lower end. But beyond that, they had said, or she said, that they are not, that they will be free cash flow positive all the way through 2027. So they're somehow balancing pretty incredible growth with an incredible opportunity. They are building CapEx, of course, with insane free cash flow this quarter, and they're free cash flow positive all the way through the end of the year. So, man.
Yeah, it's incredible, man. Microsoft looks like a juggernaut coming out of this quarter. Azure growth accelerated to 43%, and they can do this while remaining profitable. Dividends, buybacks, all going strong. Somehow they're going to stay free cash flow positive.
And I really think this is bigger than Microsoft too. Like we can see that now low volume, so we can't like overly commit or anything. But right then, Nvidia started inflecting. Right then, all these little silicon photonics and supply chain and the AI started inflecting. Micron's probably up. I haven't looked at Micron. CoreWeave is actually green after hours, like CoreWeave, which only knows red. It has not seen green at all. No signs of life. Hardly any. Now, this could easily fade, but like it's a pretty strong move for a lot of these names off of where they had bottomed out. So,
Yeah.
do you think, am I reading too much into here, or am I like legitimately thinking like, this calms a lot of fears that people had related to the accelerated CapEx
Well,
build out?
I think that it, at least to me, what it does is it makes you realize that you can't bucket all of these names into one basket, right? And that there will be execution differences. Some will put all their chips on growth, and you're going to end up seeing that. There's a big difference between 43% and 82%. That is a big difference in growth on cloud. Azure is doing it from a much larger base, but obviously Google is spending a lot and they're willing to go into, free cash flow negatives. But I think Microsoft's being very advantageous here because there really hasn't been a big tech cloud name that's willing to stay profitable and grow and get customers. Making sure that their customers are happy, making sure that their investors are happy, and drawing that fine line. And I think that that's a great way to play this. I don't know if I want to go in and buy the dips on some of these names or just go in and buy Microsoft, because even after this draw, like run up, it's $418, for a full year of high free cash flow. So, maybe buying the winners here is just the way to play it. Now, you said that you have to go. I have to go. If I could also make an announcement here, I am likely not going to be live till earnings tomorrow. I'm going to have to cancel my live stream to do a special recording. This one's going to be a big one, ladies and gentlemen.
Yeah, I'll tell people what it is. Tanner's actually getting into opera and opera music, so you're going to get to hear him at a very high level. No, just kidding.
Well, I got a text during the thing, and they said, "Are you available tomorrow?" I was like,
"Nice."
Yep. Okay. Ladies and gentlemen, that's it from us. If you guys have enjoyed the channels, make sure you subscribe to myself, Roy, Amit, for being at the actual event. Until tomorrow, see you guys next time. Bye for now.
Later.